Let's begin CMA Inter exclusive marathons for June 24 or December 24 exams. This video, this introduction of mine is going to be a common intro for all the CMA marathons. So here I just want to give a couple of instructions. Please kindly watch these instructions and then only start watching from the respective timestamp. Don't hurry up. I know you are thinking to skip this introduction and want to directly go and watch. Please have patience. If you want to succeed in life, you have to follow certain instructions. That instructions I'm going to give you. The first and foremost instruction, kindly watch these marathons at standard speed. Don't increase the playback speed. Please, when you are listening to the class, your purpose is not to finish the class. The purpose is to absorb something, to get something, to connect with the subject, to absorb something. Absorption is important. When you listen to the class at standard speed, you require very, very, very less time for revision. When you listen to the class at higher playback speed, you require lots of time for revision. Getting it? And when you listen the class at higher standards, higher playback speed, generally you will not get that command on the subject. Getting it? That's it. Now we are going to upload for all the CMA Inter, all the 8 subjects related marathons. So we will be uploading it from 11th of May onwards. Will be uploading for June exams. Even for December students also can absolutely use these marathons. So until May end, we will be keep on uploading whenever one marathon is completed, we'll be keep on regularly uploading. So P5, our faculty Subramaniam sir will take this marathon, law, and Radhika Gelot from Pune. So she'll be handling industrial and commercial laws. Company law and ethics, Subramaniam sir will handle. And P6, financial accounting, will be by Sai Babu sir. By the way, you can just open our YouTube channel, see a Harsha. Inside that playlist you open, you see the playlist, first playlist, CMA Inter June 24 marathons or strategies. So CMA Inter playlist you will find like this. So inside this preparation strategies, 3/4 preparation strategies. What is 3/4? Very simple. A student need not study 100% of the entire syllabus to qualify. In order to get 50, 55 plus, if you are very good at 3/4 of the syllabus, that's more than enough. So for every subject, the faculty has given guidance on which 3/4 syllabus you must be very strong at. So you watch that, you will understand. So, and coming to, by the way, in this marathon, we have used materials, right? These materials that we used in this marathon can be downloaded from Open Srestha CMA website. Inside the CMA Inter, you open PDF resources. Just click on the PDF resources, open CMA Inter. So below group 1, you just see here. So law, taxation related, accounts related, tax related, and cost accounting, everything, even marathon notes and all also. If at all we have a marathon notes, that also we will insert here. You will find it here. Getting it? So there you can download the materials. Financial accounting by Sai Babu sir, direct taxes by Bhaskar sir, IDT by Pavan sir, cost accounting by Ganesh Bharadwaj sir, and the same Ganesh Bharadwaj sir will handle management accounting as well. Paper 11 part A, financial management by Funny sir, analytics by Mahmood sir, P10 auditing by Mahmood sir, corporate accounting by Sai Babu sir of our Srestha faculty, and operational management by Subramaniam sir, who is actually handling corporate law, and strategic management by Harish Krishnan sir. We will be uploading all these marathons as and when completed, and we try our level best to upload all these marathons, within this May month itself. Getting it? So make use of it. And even RTP videos also we will be uploading very soon for each subject. So just make use of these resources and do well in the exams. And while you're listening, just post your appreciation, whatever. After watching the marathon, please post your appreciation, whatever, as a comments, and like this video, especially importantly, because it will recommend to other CMS students as well. All the very best. Thank you. Continue watching, by the way.
Now let us see redemption of preference shares chapter. So you can definitely expect 1 or 2 MCQs from this chapter, or 1 practical question also possible. Now, I have divided this chapter into 2 parts. The first part is the legal compliances part. The second part is accounting for redemption of preference shares. See, first you need to understand what is preference share and what is redemption of preference share. And when a company is going for redemption of preference shares, what are the applicable legal provisions, and which sources company can utilize for redemption of preference shares. And the most important concept is the concept of capital redemption reserve. So these are the important things. And then finally we end up in learning the accounting entries for redemption of preference shares. See here, The first part is basic understanding about the preference shares and redemption of preference shares. The second part is accounting for redemption of preference shares. So in basic understanding, first we should understand what is preference share. Of course, what is preference share is actually a basic thing, but which we already covered in introduction chapter, types of shares. But once again, we will quickly learn what is preference share and what is the meaning of redemption of preference shares. And the most important part is legal provisions. See, whenever you are going for redemption of preference shares, definitely the Companies Act will prescribe some procedure or some provisions. So the sources from where you can utilize. So for redemption of preference shares, we have to learn. And when you're doing the accounting for redemption of preference shares, all these legal provisions must be applied. Okay. Now see, uh, first, what is preference share? As you all know, preference share is a share which will have preferential right in two areas, which is having preferential right. The person who purchased this share will have preference over equity shares in two areas. One is payment of dividend. So when it comes to dividend, to whom dividend will be paid first? Always preference shareholders. Dividend will be paid first. This is the first preferential right. Second is repayment of capital at the time of liquidation. See, at the time of liquidation, as you all know, before discharging the amount to equity shareholders, company should discharge the amount to preference shareholders. That means preference shareholders will get priority over equity shareholders. So if any share is carrying these two preferential rights, so we call them as preferential shares. See, equity shareholders are the real owners of the company. What about preference shareholders? Preference shareholders are also owners of the company. But when compared with equity shareholders, preference shareholders will have less voting power because the risk taking so is more in case of equity shareholders, because equity shareholders doesn't know whether their amount will be share capital amount will be paid back or not. There is no guarantee that they will get fixed dividend every year. But as far as the preference shareholders are concerned, so somewhat better position they are in when compared with equity shareholders. So if it is, in case of preference shareholders, generally they will get a fixed amount of dividend every year. And then at the time of liquidation also, they will get priority over equity shareholders. So therefore, when it comes to the risk, equity shareholders risk is so high. That's why they are called the real owners of the company. And when it comes to preference shareholders, the risk is less. See, less risk means when compared with the equity shareholders. So that's why, so they will have less voting power. Less voting power. So as you see, as far as the voting rights in the company is concerned, equity shareholders have the right to vote on all resolutions placed before the company. But whereas preference shareholders will have a right to vote only on the selected matters. So that itself is the evident that they are the owners, but they are not real owners of the company. So they are contributing the capital, but they are taking less risk when compared with the equity shareholders. So what is preference share? It will have preferential right in two areas. One is payment of capital. Second one is payment of dividend. And what is equity share other than preference share? Now, see, actually, we are not bothered about the issue of preference shares. This chapter is all about redemption of preference shares. See, what is redemption of preference shares? Simply nothing but giving the amount back to the preference shareholders. Whatever the amount we have taken from them, so for a fixed period of time, once that period is over, we need to repay the amount back to them. So that process is called redemption of preference shares. So meaning of redemption of preference shares. Redemption is the process of returning the preference share capital to the preference shareholders. So at a fixed date or after a certain time period during the lifetime of the company. So anytime they can get their capital repaid back. Either the period which is fixed for them. For example, we take preference shares for 5 years. Now company want to repay it for after the expiry of 3 years, it can. So this is called redemption of preference shares, simply giving the amount back to preference shareholders. Now, the most important part is legal provisions, because these legal provisions will affect the accounting treatment. See here, section 55 of the Companies Act 2013 and also SEBI guidelines. And also SEBI guidelines. There are certain SEBI guidelines, but SEBI guidelines are almost similar to the principles of Section 55. So there are certain SEBI guidelines. Now these two will provide the provisions to be followed in case the company is going for redemption of preference share. Now first of all, Section 55 says for issue of preference shares, for issue, I'm talking about the issue of preference shares. For issue of preference shares, see, there must be authorization in articles of association. There must be authorization in articles of association. And the most important, which can be asked as MCQ, is this point. A company cannot issue irredeemable preference shares. There is no question of issue of irredeemable preference shares. As far as the Companies Act is concerned, Section 55 says a company cannot issue preference shares which are irredeemable. And generally, the maximum redemption period is 20 years. The maximum redemption period is 20 years. Of course, there is one exception for this. Suppose a company who is engaged in setting up of or dealing with infrastructure projects, setting up of dealing with infrastructural projects, they may issue preference shares beyond 20 years, but maximum up to 30 years. Very, very important, may be asked as MCQ. So whether all companies are allowed to issue preference shares beyond 20 years? No, only the companies which is engaged or set up and dealing with infrastructure projects, like for example, construction of roads, construction of dams, construction of bridges, construction of colleges, construction of universities, construction of hospitals, construction of hotels, construction of warehouses, infrastructure projects. The companies which is exclusively engaged in construction of infrastructure projects, so the act has given them some extra period that you may issue preference shares beyond 20 years, but maximum period for you is 30 years. So for a normal company, how many years they can issue preference shares? 20 years. But if you're a company which is engaged in infrastructure project, you can issue preference shares for beyond 20, but up to 30. And then for redemption of preference shares, see, these are the conditions for issue of preference shares. There must be an authorization in the articles of association, and maximum redemption period is 20 years. There is no question of irredeemable preference shares. If you are engaged in infrastructure project, beyond 20 up to 30, subject to one condition that minimum 10% of the amount of capital must be redeemed every year after 20th year. So that is not that much important. Okay, anyway, covered. Next, for redemption of preference shares, what are the conditions? First thing is, whenever a company want to redeem the preference shares, first of all, those shares must be fully paid up. Suppose if the company has not collected the entire amount on those shares, that means they are partly paid up. They are not allowed to go for redemption of preference shares. There is no question of redemption of partly paid up preference shares. If company wants to redeem the partly paid up preference shares, first they need to call the remaining amount, make it fully paid up, then redeem the preference shares. So this is the first condition put by the Companies Act, that whether your shares or preference shares are fully paid up or not. If they are fully paid up, then go for redemption of preference shares. So if partly paid up, see, if partly paid up preference shares are to be redeemed, they must be converted into fully paid up. So this is the point. Now, so these are the legal provisions relating to issue as well as redemption of preference shares. Now focus on issue, that 20 years, 30 years point. In redemption, so make sure that the shares must be fully paid up. Now, the most important part is sources for redemption of preference share capital. Sir, as far as the Companies Act is concerned, which sources a company can utilize for redemption of preference shares? So, Companies Act has prescribed certain sources. See, sometimes you may redeem at par. Sometimes you may redeem at a premium. That means along with the capital, some extra amount also you need to pay. That we call it as premium on redemption of preference shares. Okay, anyways. The Companies Act has separately prescribed the sources for redemption of capital, preference share capital, as well as the sources for redemption of premium on redemption of preference shares. First, we will talk about the sources for redemption of preference share capital. Normal capital. whenever we have taken preference share capital and we want to redeem it, which sources company can utilize? See, the Companies Act said two sources you can utilize. The first source is divisible profits or distributable profits, or the profits which is available for distribution of dividend. The profits which is otherwise available for distribution of dividend. That means, in a way we call it as free reserves, which can be used for any purpose. Which can be used for any purpose means which can be used for payment of dividend also. So to put it simply, either divisible profits, distributable profits, or free reserves, they are having the same meaning, which can be utilized for payment of dividend. Now, whenever you are going for redemption of preference shares, you can use free reserves, divisible profits. So, sir, can you give me some examples? For example, general reserve, free reserve, you can utilize. Revenue reserve, if you see the name revenue reserve in balance sheet, that is also free reserve, which we can utilize. P&L account, utilize. Dividend equalization reserve, you can utilize. But most important thing is securities premium. Whether securities premium can be utilized. Securities premium is not a free reserve. So therefore, you are not supposed to use securities premium for redemption of preference share capital. Securities premium. Next, revaluation reserve. See, this is not revenue reserve. This is revaluation reserve. Sir, whether revaluation reserve can be utilized? No. Because which is not a free reserve. Revaluation reserve is not a free reserve. So don't utilize it. Next, capital reserve. This is most important. Capital reserve which is unrealized. Unrealized. Suppose, for example, you sell the asset. You got some profit. So it's a capital reserve. Now, whether that profit is actually realized or not. Unrealized capital reserve is not available for payment of dividend. Don't utilize it for redemption of preference shares. Sir, what about capital reserve realized in cash? It is allowed. Because the act said profit otherwise available for payment of dividend, divisible profit. Suppose a capital reserve which is realized in cash is also one of the eligible sources for redemption of preference shares. So in problem, when you are doing the problem, you have to be very careful. If capital reserve is created, is given in the question, you have to see whether this capital reserve is realized in cash or not. Suppose if it is realized in cash, then it is available for redemption of preference share capital. But if it is not realized, then it is not available for redemption of preference share capital. And then statutory reserve. See, this is statutory reserve. See, sometimes we create reserves as per the act. As per the act, for example, export profit reserve. We created one reserve called export profit reserve as per the Income Tax Act. Now, whether that reserve we can utilize? No. Because if you create something as per the statute, you have to utilize it for only for particular purpose. So that reserve you have to utilize only for particular purpose. So it is not freely available. Therefore, statutory reserves is not available for redemption of preference shares. Next, investment allowance reserve, development rebate reserve, workmen compensation fund, WCF, workmen compensation fund, development rebate reserve, investment allowance reserve. Sir, these are the reserves. Out of these reserves, if any free portion is available, then utilize them. Free portion means which can be utilized for any purpose. So be careful when you're solving the questions. I think there are certain questions in that they say out of the workmen compensation fund, 1/3 of the fund is free. The moment he said free, that means we can utilize for redemption of preference shares. So therefore, what we are discussing, sources for redemption of preference shares. Whenever a company wants to redeem preference shares, what sources company can utilize? What is the first source? First source is profits available for distribution of dividend. That means company can utilize general reserve, revenue reserve, P&L account balance, debenture redemption reserve, development dividend equalization reserve. These are the reserves they can utilize. Securities premium, no. Revaluation reserve, no. Capital reserve unrealized, no. Realized in cash, yes. Statute reserve, no. Sir, because it is created as per the act, which is available only for particular purpose. Development rebate reserve, investment allowance reserve, workmen compensation fund, only free portion available for dividend redemption of preference share capital. Next. So if you have any one of these sources, first category, you utilize it for redemption of preference shares. Sir, I am not having any one of the above sources, sir, then you have another option. Or if you have the above source, it is not compulsory that you have to utilize it. So you have another source, that proceeds from fresh issue. Proceeds from fresh issue. So you can go for fresh issue. Fresh issue of shares. Suppose company can issue of equity shares. Whatever the amount collected, that amount they can utilize for redemption of preference shares. So the logic is very simple, sir. Here, on one hand, you are reducing preference share capital. So reduction of capital is a negative thing, right? Scale of capital is down. When scale of capital is down, so it may have negative impact on the organization. Now, what companies are trying to do here is, whatever the capital is reduced through redemption, we want to fill it up. How you are going to fill it up? Either by using your own sources or by making a fresh issue. See, when you make a fresh issue, obviously share capital is created in the books. So that means on the one hand, there is a reduction of preference share capital. On the other hand, already you made a fresh issue. So the capital is set off. So therefore, either we are encouraging you to go for fresh issue, get the proceeds, and utilize it for redemption of preference shares. Or if you are earned very well profits, good profits, out of that profits, some amount you may use it for redemption of preference shares. Whatever the gap created, that gap you can fill it up. Or sometimes you can use combination of 1 and 2 also. Combination of 1 and 2 also. So tell me, what are the sources a company can utilize for redemption of preference shares? Two sources. What are the sources? Own profits, outside profits. Own profits, outside funds. Own profits means divisible profits. So the profits which is available for distribution of dividend. Next, proceeds from fresh issue. You make a fresh issue, get the money and use it for redemption of preference shares. And through redemption of preference shares, there is a reduction of capital. Now that capital you want to fill it up. And if you have own divisible profit, fill it up. That's why they are saying that first option is divisible distributable profits. If you have sufficient profits, then what is the need to go for fresh issue? See, fresh issue may not be possible always. Because even if you are going for a fresh issue, there is somebody to purchase now. So that's why they know that. That's why, see, they are giving one of the option is proceeds of fresh issue. Another option is your own profits. That too divisible profits. Don't use undivisible profits. I mean the profits which is not available for distribution of dividend. Now the combination of these two also can be used. For example, a company is redeeming 10 lakhs worth of preference share capital. So 10 lakhs. Out of 10 lakhs, for example, 5 lakhs fresh issue, remaining 5 lakhs own profits. Yes, it can go ahead. Okay. So this is the sources for redemption of preference shares. Next, now most important thing is premium on redemption of preference shares. Sir, I told you sometimes we may redeem preference shares at a premium. For example, we have taken preference shares worth of face value worth of 10 lakhs and premium 1 lakh, 10%. So we need to pay 11 lakh rupees. Now till now we learned this 10 lakhs. What are the sources for redemption of 10 lakhs? Now what are the sources for redemption of premium of 1 lakh? For 10 lakhs, there are two sources: divisible profits, proceeds from fresh issue. What about this 1 lakh? Now Companies Act said, see, whenever you are redeeming preference shares at a premium, the companies are now divided into two categories. First thing is the companies which is covered under 133 of the Companies Act. That means the companies to whom the accounting standards are applicable, which are required to follow applicable accounting standards. Now for those companies, with effect from 1/4/2014, we are allowing you only profits of the company. Very important. We are not going to allow securities premium cannot be utilized by those companies to whom 133 is applicable with effect from 1/4/2014. Suppose in the question MCQ possible, suppose a company issues preference shares before 1/4/2014, then those companies they can use either securities premium or profits of the company for adjusting the premium on redemption of preference shares. But the company which is issues preference shares on or after 1/4/2014, then those companies definitely have to have only one source for adjusting the premium on redemption of preference shares. What is that? That is nothing but profits of the company. They cannot utilize securities premium. Okay. Now for other companies, they have the option. Either they can use profits or they can use securities premium. Now here important points there. Companies Act, if you look at it carefully, they said when it comes to redemption of capital, they use the word profits which is otherwise available for payment of dividend. But when it comes to premium on redemption of preference shares, they have not utilized such word. That means any kind of profit can be utilized to set off the premium on redemption of preference shares. Best example, for example, capital reserve. Suppose capital reserve unrealized. Will you use it for redemption of preference share capital? No. Why? Because it is not available for payment of dividend. Because they said clearly the profits which is otherwise available for payment of dividend only will be utilized for redemption of preference share capital. But otherwise available for payment of dividend, that word is not there for premium on redemption of preference share capital. Therefore, if there is any securities premium which is not realized, unrealized, that also can be utilized to set off the premium on redemption of preference share capital. So the most important thing is, remember, MCQ is possible whenever a company is redeeming preference shares at a premium. Okay, that premium on redemption of preference shares. So we can adjust by using only profits if the company is notified under 133. Other companies, they can use profits or securities premium, whatever. For example, that company is already having a securities premium. Now they are redeeming preference shares at premium. So securities premium can be utilized to set off the premium on redemption of preference shares. If it is other category of company. But if you are a company which is notified under 133, I mean the company to whom the accounting standards are applicable under 133, then you are supposed to utilize only one thing, that is profits of the company. See, the word is profits of the company, not divisible profits. That means any profit can be utilized. Any profit can be utilized. But securities premium, you cannot utilize. You cannot utilize. You cannot utilize. Which companies? The companies which is comes under 133 of the Companies Act 2013. See here, suppose capital reserve. This is most important. Realized or not realized? Realized or not realized? Both can be utilized. Both can be utilized. But suppose capital reserve unrealized, can it be utilized for redemption of preference share capital portion? No, not at all. So that means, see, 10 lakhs is the capital amount, sir. 10 lakhs is the capital amount. In our example, suppose 10 lakhs is the capital amount. 10 lakhs is capital, share capital, preference share capital. 1 lakh is premium. Now suppose if there is a capital reserve, unrealized, 1 lakh rupee. Can I use it for preference share capital? No. Can I use it for this one? I mean, premium on redemption of preference shares? Yes, 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 yes. Because look at the wordings of the Act. For redemption of, sources for redemption of preference share capital, they use the word profits otherwise available for payment of dividend. But here, as far as the profits for premium on redemption of preference shares is concerned, they said only profits of the company. There is no need that they will be available for distribution of dividend. That means any profits can be utilized. Even capital reserve unrealized can also be utilized. Statutory reserve only free portion can be utilized. See, their statutory reserves completely prohibited. They cannot be utilized for redemption of preference share capital. But statutory reserve up to free portion can be utilized for here, for premium on redemption of preference share capital. And investment allowance reserve, debenture redemption reserve, workman compensation fund, free portion can be utilized. There also can be utilized, here also can be utilized. See, for others, they can use whatever, profits or securities premium, whatever they want, they can utilize. So the conclusion is, when you are redeeming preference share capital, premium, sometimes you may redeem at premium also. For as far as the capital is concerned, you have two sources. One is divisible profits, otherwise available for payment of dividend. Second is fresh issue. So, or combination of 1 and 2. But as far as the premium on redemption of preference shares is concerned, if your a company comes under 133, you have only one source, that is profits, with effect from 1/4/2014. And for others, they can use profits or securities premium. But remember, profits of the company here means any profit. It is regardless of whether it is divisible or not. So best example is capital reserve. Capital reserve realized it is a divisible profits which can be used for redemption of preference shares. But the same capital reserve which is not realized also eligible for utilization for premium on redemption of preference share. So you carefully observe this point. Okay. Now, See, in redemption of preference shares, one of the most important point is creation of CRR. Sir, what is this creation of CRR? I tell you, listen. Sir, you are redeeming preference share capital. Yes, you are redeeming preference share capital. What happens? Tell me. If you redeem preference share capital, your preference share capital will reduce. So there is a scale down of capital. So that means preference shareholders' capital has been reduced. And see, you are utilizing what? You are utilizing either divisible profits or fresh issue. When you are using fresh issue, no problem. Because you are making a fresh issue, fund is collected, that fund you are utilizing. But when you are utilizing your own profits for redemption of preference share capital, then the creditors are not happy. Why creditors are not happy? The funds which is available to them has been reduced. The funds which is available to them has been reduced. That's why they are not happy. So we need to somehow make sure that the funds available to the creditors before redemption, after redemption must be same. That means we need to protect the interest of creditors. So that's why whenever there is a redemption of preference shares, the act introduced the concept of creation of capital redemption reserve. One more reason could be capital intactness. See, when you redeem preference share capital, your capital has been reduced now. Scale down of capital is a negative thing, which will have a negative impact on the organization. So that's why through legal provisions, the act is making mandatory that we need to make sure that our capital will be intact. So that could be one of the reasons why the Companies Act has introduced the concept of CRR. But the main reason could be to protect the interest of creditors. See, I have created a simple notes for this with example so that you will understand it better. See here, creation of CRR. If preference shares are redeemed out of divisible profit, see, creation of CRR is applicable only when you redeem preference shares out of divisible profits. Suppose if you are going for fresh issue, then CRR is not required. Why? Because through fresh issue already capital is created. Whatever the capital is reducing, to that extent the capital is created and fund is arranged through outsiders. So we are not utilizing the existing sources now. Then why creditors are bothered? When creditors are bothered, when the existing sources of the company have been utilized for redemption of preference share capital, they may feel that they may get less amount as far as their repayment is concerned. So when company is going for fresh issue, creditors are happy because company is not touching the existing thing, existing assets of the company, existing profits of the company. So therefore, if preference shares are redeemed out of divisible profits, a special reserve called CRR is to be created out of divisible profits for an amount equal to the nominal value of preference shares redeemed. Sir, we need to create CRR when company depends on divisible profits. To what extent? To the extent of the nominal value of preference shares redeemed. To the extent of nominal value of preference shares redeemed. So in the question you have to see whether company is depending upon fresh issuer or company is depending upon the divisible profits. When company is depending on divisible profits, you have to create CRR. To what extent? To the extent of the nominal value of preference shares redeemed by using this free reserves. Okay. Sir, why we need to create CRR? See here. To protect the interest of creditors. To protect the interest of creditors, that is outsiders. To protect the interest of creditors. And second thing is there is to ensure no reduction in shareholders' funds, that is capital intact. See, possibly these two could be the main reasons why the company is going for creation of CRR. See, take an example here. Suppose there is a company called X Limited. The balance sheet on 31st March 2021. See here, they have 25,000 equity shares of 10 each, 2,50,000. 5,000 preference shares of 10 each, 50,000. P&L account balance 1,50,000. Creditors 1,60,000. Asset side, if you see, fixed assets 2,10,000, stock in trade 1,00,000, debtors 1,00,000, cash 2,00,000. So this is the balance sheet. Now, preference shares are due for redemption on 1/4/2021. So immediately after the next day, preference shares are due for redemption. Now see here, what is the statement showing the amount available to creditors? See, before redemption, tell me what is the position? What are the total assets? 6,10,000 minus what is the funds available for distribution to shareholders? See here, 6,10,000 is my total assets. But I know that out of the funds here, P&L account balance 1,50,000 is there. Tell me this 1,50,000 belongs to whom? Shareholders. So shareholders, right? See, funds available for distribution to shareholders, minus it. So therefore, what is the funds available to the creditors? 4,60,000. Because the funds which is available to the owners, 1,50,000, if I reduce it, then I will get the funds available to the creditors. This is before redemption position. So before redemption, so creditors are having 4,60,000. Now after redemption, now I am saying after redemption. Suppose the company is going for after redemption. Now see, without transfer to CRR, with the transfer to CRR. Suppose what happens if I don't transfer any amount to CRR? Tell me what is my total assets? Total assets is 6,10,000 minus out of that for redemption of preference shares. See, 50,000 is the total preference share capital now. And assume if it is redeemed at par. So 50,000 is utilized from my cash balance. So therefore, out of 6,10,000, 50,000 has been reduced. So my total assets is 5,60,000 because 6,10,000 total assets, 50,000 preference shares redeemed. That means preference shareholders are paid 50,000 cash. Therefore, 5,60,000 is the amount available to preference shareholders. Sorry, total assets available. From funds available to distribute to shareholders, same 1,50,000. So therefore, 4,10,000 is only the funds which is available to creditors. See creditors position. Creditors not happy. Why? Company depending on the existing source. For 50,000 they have utilized from the existing assets. Now 5,60,000 is the total assets available minus profits belongs to equity and preference shareholders 1,50,000. That means funds available to us is only 4,10,000. Before redemption it is 4,60,000. We are not happy. Now that's why they brought the concept of transfer to CRR. Now what happens if I transfer to CRR? See, funds available 5,60,000. Why? Because 6,10,000 total assets minus 50,000 is given to preference shareholders for redemption. So total assets available 5,60,000 minus what is the funds available to shareholders? See, out of 1,50,000, what we do is to the extent of the nominal value of preference shares redeemed. What is the nominal value of preference shares we redeemed? 50,000. So that 50,000 we transfer from free reserves to CRR. So therefore, out of 1,50,000, which is P&L account, divisible profits available to shareholders, 50,000 we transfer to CRR. Therefore, now the funds available to shareholders is only 1 lakh. So therefore, 5,60,000 minus 1 lakh, 4,60,000 is the funds available to creditor. So look at the position before redemption, 4,60,000. After position, after redemption, 4,60,000. Now creditors are happy because their interest is protected. How? By transferring the amount to CRR. That means whenever there is a redemption of preference shares and you are depending upon the divisible profits, what is the meaning is simply we are making free reserves as restricted reserve to the extent of the share capital redeemed. So here what is the total face value of the share capital redeemed? 50,000. To that extent, we make the free reserves as CRR. CRR is a restricted reserve which is not available for distribution of dividend. See, remember, CRR is not available for distribution of dividend. So therefore, 1,50,000 is our divisible profits before redemption to shareholders. But now out of that 50,000 we transfer to CRR. That means this 50,000 we freezed it separately. That means you are now available only 1 lakh. That means 5,60,000 minus 1 lakh, 4,60,000 again available to preference share, creditors. I think now you got the concept of creation of CRR. So many times, so many times you are unable to understand why they introduce the concept of CRR. I think now you should understand. So please look at this example carefully. So I have carefully drafted it for your understanding. So you can easily get through. Now you cannot forget why we create CRR. Why we create CRR? Especially when there is a redemption of preference share capital. Simply, redemption of preference share capital. So the creditor's interest must be protected. Since we are using existing profits, we are using the existing cash reserves, creditor's interest may be affected. So that's why they introduce the concept of CRR. By making free reserves as restricted reserves to the extent of the nominal value of preference shares so redeemed, so we can increase the protection of creditors. See here, because the transfer of funds to CRR, the amount available to creditors before and after redemption of preference shares remains same. Hence, we can conclude that creation of CRR protects outsiders' interest. So this is the one reason why. So when in the question, if you see any company is depending upon the free reserves for redemption of preference share capital, then to the extent of the preference share capital so redeemed nominal value, you transfer to free reserves to CRR. so that what happens is the funds available to the creditors will be protected. See, the idea of the Companies Act is because of redemption of preference share capital, so the existing company will not be affected. The creditors' interest must also be protected. So since you have utilized the existing profits of the company, existing reserves of the company, obviously creditors are not happy, creditors' interest is affected. So therefore, we need to reinstate the interest of the creditors. How? By introducing the concept of CRR. That means here, if you see carefully, the balance sheet after redemption of preference share capital, what happens is, see here, equity share capital, same. Preference share capital redeemed means it is eliminated. P&L account, see only 1 lakh. Before redemption, it is 1 lakh 50. Now it is 1 lakh. Now CRR, see here, we created a separate reserve called CRR, 50,000. Sir, we have one doubt, sir. We created CRR, na, sir. And Act says, if you read the Companies Act carefully, CRR utilized for only one purpose. What is that? Fully paid bonus shares. That means out of the divisible profits, some of the profits to the extent of the nominal value of preference shares so redeemed, we transfer to CRR. Na? Again, we are using CRR for issue of fully paid bonus shares. That means the CRR again will be converted to share capital. That means capital intact is also saved. I mean, capital intactness is also protected. So therefore, by creating CRR and later making mandatory to utilize CRR only for fully paid bonus shares through legal provisions, the Act is achieving two things. One is protection of the creditor's interest. Second thing is, anyway, the CRR will be utilized only for issue of bonus shares. That means again it will be reinstated as capital. Therefore, capital intactness is also maintained because of creation of CRR. That's why CRR will be created. These are the two reasons. These are the two reasons I have written here. There are two reasons now. See these two reasons. Protect the interest of outsiders and to ensure reduction. There is no reduction in shareholders funds. That is capital intactness. I think now you got the point why we create CRR. Okay. So this is the thing. So what we have discussed, what is preference share, what is redemption of preference share, what are the legal provisions for issue and redemption of preference shares, and what are the sources we can utilize for redemption of preference shares, preference share capital, and premium on redemption of preference share capital. And especially when a company is going for redemption of preference share capital, so we need to create CRR when we depend upon divisible profits. So divisible profits, that means whenever a company is depending upon the divisible profits for redemption of preference share capital, we need to create CRR. Why we need to create CRR? Because when you're depending upon the existing sources, your creditor's interest is affected. So to reinstate the interest of the creditors, we need to create CRR. So creation of CRR and later on making mandatory said that CRR will be utilized only for fully paid bonus shares. See, it is the entire cycle which is prescribed in the Companies Act. So it will have a twin purposes, that is capital intactness as well as protection of interest of the creditors. And see, same creation of CRR will come in another situation also. What is that? Buyback of shares. Why buyback of shares? See, again in buyback of shares also there is a reduction of capital. Here in preference share capital also there is a reduction of capital. So both are similar. And for buyback of shares also we can depend upon the existing sources or we can go for fresh issue. See, even for redemption of preference shares also we are depending upon existing sources or we are going for fresh issue. So that's why in both the cases creation of CRR is required to protect the interest of the creditors. Now finally the accounting treatment. So what entries we will pass whenever a company is going for redemption of preference shares? See, this can be divided into two categories. One is when company depends upon divisible profits, its own profits for redemption of preference shares. It is not going for fresh issue. So then first for redemption of preference share capital, due entry you have to write. So preference share capital account debtor. If you repay at premium on redemption of preference share capital account debtor to preference shareholders account. Preference share capital account debtor, premium on redemption of preference share capital account debtor to preference shareholders account. And when you discharge the amount to them, preference shareholders account debtor to bank or cash. Now the most important entry is CRR entry. When you are depending upon existing source, means you are using your own sources. That's why you need to create CRR. From where? From your divisible profits. So to the extent of the nominal value of preference shares so redeemed. So if you use general reserve account debit, revenue reserve account debit, P&L account debit, other divisible profits to CRR. To what extent? To the extent of the nominal value of preference shares redeemed. And if you redeem at premium, you need to adjust premium also. So I told you premium can be adjusted with any profit. Of course, if you are a company which is covered under 133, so you have to utilize only profits. You cannot utilize securities premium. See here, that's why profits means general reserve, revenue reserve, P&L account, any other divisible profits or any other profits for that matter. So premium can be adjusted. Okay, this is one case. Second case, suppose if you are depending upon fresh issue. See, when you depend upon fresh issue, so first of all, for example, when you issue a share, what is the entry? Bank account debtor to share capital. Suppose if you issue at premium, securities premium will also come. And remaining entries, redemption of preference shares, same entry, preference share capital account debtor, premium on redemption of preference share capital to preference shareholders. Next, making the payment. So preference shareholders to cash or bank. Now, adjustment of premium on redemption of preference share capital. Sir, creation of CRR entry will not come. Yes, will not come here. Why? Because why we need to create CRR here? To protect the interest of creditors. When creditors' interest is affected, when you use existing sources, when you are depending upon fresh issue, why creditors' interest is affected? That's why creation of CRR will not come in case of fresh issue or to the extent of the fresh issue. Of course, suppose if you are using partly by fresh issue, partly by existing sources, then to the extent you are depending upon the existing sources, to that extent, to the extent of the nominal value of preference shares so redeemed by you utilizing the existing sources, you can use CRR. You have to create CRR. But for fresh issue, no need to create CRR. Because when you make a fresh issue, capital is automatically filled up and you got the money. You are not utilizing existing sources. So that's why. So for adjustment of premium on redemption of preference shares, so whatever the source you want to utilize, debit it, and premium on redemption of preference shares can be created. Assuming this is a company which is covered under 133. Suppose if it is a company which is not covered under 133, you can utilize securities premium also. Okay, so fresh issue, redemption of preference shares, discharge of the amount of preference shareholders, then adjustment of premium on redemption of preference share. So this is the entire chapter for redemption of preference shares. Okay, so see it once, listen it two or three times. It will fit into your mind. Then solve some study material questions. So definitely you can easily get through this chapter. So the next chapter for discussion is accounting for bonus and right issue. So in this chapter, sir, two areas we need to cover. One is bonus shares, another area is right shares. So in first bonus shares we will see, then we will go for right shares. So in bonus shares, first we need to learn what is bonus share, why bonus shares will be issued, what is the effect of issuing bonus shares, and what are the different types of bonus issue, and especially there are some legal provisions relating to bonus issue. Whenever company wants to issue bonus shares, so what are the sources they can use, and what provisions are there in the Companies Act and SEBI guidelines relating to the bonus issue, and finally accounting for bonus issue. So these are the areas we are going to cover in bonus issue chapter, bonus issue topic. As far as the right issue is concerned, what is right shares, what is the effect of right issue, advantages and disadvantages of right issue, and what is the main important concept is this, the valuation of right concept, and what is the accounting for right issue. So this is regarding right shares. Now let us first see what is bonus shares. See, bonus shares are the shares which is issued by the company at free of cost to the existing shareholders of the company. So that means shares are issued for no consideration. So company will not receive anything from issue of bonus shares. So because of bonus shares, our total funds will not change. Okay, but number of shares will increase, but there is no change in the net worth of the organization because there are no new funds will flow to the entity. So what is bonus shares here? A bonus share may be defined as issue of shares at no cost. This is important. At no cost to the current shareholders in a company in proportion of their existing holding. Generally, in proportion of their existing holdings, like 1:1 ratio, for every 2 shares 1 share, for every 3 shares 1 share, like that bonus shares will be issued. And because of bonus shares, no new funds are raised with bonus issue. That means whenever company want funds they can go for public issue or private placement. Bonus issue is not the option, because from bonus issue, company is not going to receive any funds. No new funds will be raised. And what is the effect of bonus issue, sir? Number of total shares, I mean, definitely they will increase. But is there any change in net worth? No. No change in net worth. So assets minus liabilities, our assets remains constantly same. Our liabilities also not affected because of bonus issue. So therefore there is no change in net worth because of bonus issue. Sir, actually technically there is a name for bonus issue. That name is capitalization of profits. Why it is capitalization of profits, sir? See, simple here. Bonus is nothing but what? Company giving shares freely to the existing shareholders. Now, from which sources the capital will be created? Because whenever company issues bonus shares, no new funds will be raised. But you have to write capital in the books now. Share capital will need to be increased now. As number of shares increased, share capital has to be increased. So, in case of bonus issue, what company will do is, company by using its own profits create the capital. That's why this is called capitalization of profits, because we are capitalizing our existing profits. We are converting our reserves and surplus into capital. That's why this is called capitalization of profits. So in bonus issue, what exactly happening is, company by utilizing its own reserves, it is creating capital. Okay, because the shares we are issuing to the existing shareholders, but they are not bringing any new amount. They are not bringing any amount to the company. So in the books of the company, capital must be created without having any funds. How we can create a capital without, I mean, receiving any amount. So that's why this is called bonus issue, capitalization of profits. Our profits, our reserves and surplus, we will convert into the capital. Okay. So this is bonus issue. So bonus shares are shares which is issued by the company to the existing shareholders at no cost. Second thing is, no new funds will be raised. And what is the effect of bonus issue? Number of shares will increase, but there is no change in the net worth. And bonus issue we will call technically as what? Capitalization of profits, converting reserves and surplus into capital. Now, sir, why companies will go for bonus issue, sir? What is the logic behind bonus issue? See, there are so many advantages or because of bonus issue. One such advantage is to reduce earning per share. This could be one of the possible reasons to reduce earning per share. If you reduce earning per share, there will be reduction in market price. If there is a reduction in market price, which will increase the retail participation. So in a way, small investors, if the company share price is not available to the small, not within the reach of the small shareholders, what they can do? So they are unable to purchase the shares of the company. They are unable to take their share of wealth in the company. Suppose a company is growing well, it is creating a lot of wealth. So everybody wants a piece of cake from that wealth, right? So I want to purchase the shares of that company, but that share is not within my reach. So I'm a retail investor, small investor. So sometimes company, what it will do is, by using bonus issue, it will try to reduce the market price, EPS. If EPS is down, obviously there is a possibility that market price may reduce. Then it will increase the retail participation. That means one of the objectives for bonus issue is, we want small investors to purchase shares of the company. So that's why. And next, another reason could be liquidity in the stock increases. Liquidity. Sir, when a company issues bonus shares, definitely the selling and purchasing transactions of the shares will increase. So this share liquidity will increase. Liquidity means selling, buying and selling of the share will increase in the market. And markets take the action as a favorable act. Sir, issuing bonus shares will have a positive impact on the organization. It indicates that the company is having sufficient profits. That's why it's able to convert it into the capital. So it's a favorable act. It will increase the image of the organization. And one of the effect of bonus issue could be reduction in accumulated profits. Obviously, sir, this concept is why we are going for bonus issue, or what will be the effect of bonus issue. So the effect could be reduction in accumulated profits. Obviously, profits will reduce. Why? Because we are converting profits into capital. Okay, this is the reasons why or the effect of bonus issue. Can you tell me what are the why company is going for bonus issue? To reduce EPS, thereby market price, thereby increase retail participation. So second, liquidity in the stock may increases. Markets take this action as a favorable act. Reduction in accumulated profits. So I have given an example also, sir. Here if you see, suppose there is a company Z Limited. 1920 their net profit is 1 lakh. Number of equity shares 10,000. 2021 net profit 1 lakh. Number of equity shares 20,000. So what happened? Because of bonus issue, the number of shares increased from 10,000 to 20,000. And profits are same. If you observe 1920 1 lakh, 2021 1 lakh. But number of shares doubled because of bonus issue. Now what happens? See here. EPS of the year 1920, net profit divided by number of shares, 10 rupees. Suppose market price is equal to EPS into price earning multiple. I assumed it as 10. So therefore market price is 100 in the year 1920. Now when it comes to 2021, your EPS will be 5. Why? Because 1 lakh divided by number of shares, not 10,000, it will be 20,000. So therefore 5 rupees will be the EPS and the market price came to 50. So EPS into price earning multiple. Okay. So this example you are not required to remember, but remember one of the reasons of bonus issue is to reduce the market price, thereby increase the retail participation. And because of the bonus issue, one possible effect could be liquidity in the stock increases, and markets take this issue of bonus as a positive favorable act and reduction in accumulated profits. Okay. Now, the most important topic is types of bonus issue. Sir, there are two types of bonus issue. There are two types of bonus issue. One is fully paid up bonus shares. Another one is bonus by way of converting partly paid up shares into fully paid up shares. So, for example, issue of fully paid bonus shares. One full share will be given as a bonus. Second type of bonus is bonus by way of converting partly paid up shares into fully paid up. For example, face value 100 rupees, sir. He paid 80. Shareholder till now paid 80. That means the share is partly paid up, right? Now remaining 20 rupees, company is issuing or company is giving you in the form of bonus. That means that 20 rupees gap is there now between the partly paid up and fully paid up. That gap will be given in the form of bonus. That's why this is bonus by way of converting partly paid up shares into fully paid up bonus shares. So therefore bonus could be two type. What is that? One complete fully paid bonus shares is given to me as bonus share. Second is converting partly paid up shares into fully paid up shares. That gap is also can be issued in the form of bonus issue. So there are two types of bonus. Now, most important thing is this. Sir, what are the sources of bonus issue? Because there is a provision in the Companies Act which prescribes which sources you can use for bonus issue. See, for issue of fully paid up bonus shares, there are three sources available. For issue of fully paid up bonus shares, there are three sources available. One is Capital Redemption Reserve. Capital Redemption Reserve, CRR. If you remember redemption of preference shares chapter, buyback chapter, I told you we create CRR. Why we create CRR? To protect the interest of the creditors, to make capital intact, we will create CRR. Now that CRR will be utilized only for one purpose, that is fully paid bonus shares. Now that is the reason why for issue of fully paid bonus shares, CRR we will utilize, because CRR has been waiting from the long time that when the chance will come to, because CRR does not have any other purpose except to use for fully paid bonus shares. That is the reason. So the first source from which company can issue fully paid bonus shares is CRR. Second, free reserves. So any reserves which is available for payment of dividend, distributable profits, divisible profits, like general reserve, revenue reserve, P&L account, all these free reserves we can utilize. So next, securities premium. Very, very important. Securities premium can also be utilized for fully paid bonus shares. So can you tell me what are the three sources company can utilize for fully paid bonus shares? Capital redemption reserve, free reserves, and then securities premium. But regarding securities premium, you have to be very careful. The in case of listed companies, only securities premium collected in cash will be utilized for bonus issue. And in case of unlisted company, securities premium either collected in cash or not may be utilized for bonus issue. That means if you are a listed company whose shares are listed in stock exchange is called listed company. If you are a listed company, only securities premium which is collected in cash will be utilized for fully paid bonus shares. And this restriction is applicable only for listed company. So therefore, if you are a listed company, only securities premium which is collected in cash will be utilized for fully paid bonus shares. Sir, if I am an unlisted company, see, if you are an unlisted company, you don't have any restriction. Either securities premium collected in cash or not may be utilized for fully paid bonus shares. This is important point. Okay. Second, one more interesting point is any reserve created by revaluation of assets may be utilized for bonus issue. Any reserve which is created by revaluation of assets may be utilized for fully paid bonus shares. Any reserve created by revaluation of assets may not be utilized for bonus issue. That means revaluation reserve we cannot utilize for bonus issue. Very, very important. So tell me what are the sources we can use for issue of fully paid bonus shares? Three sources: free reserves, CRR, free reserves, securities premium. In regarding securities premium, what is the note point you have to remember? Only securities premium collected in cash will be utilized in case of listed company. If you are a listed company, securities premium collected in cash only will be utilized for fully paid bonus shares. If you are an unlisted company, you have choice. Either securities premium collected in cash or may not. So will be utilized for bonus issue. Sir, what about second type of bonus? Because there are two types of bonus. These sources are for fully paid bonus shares. Suppose any bonus by way of converting partly paid into fully paid up. Only one source how to utilize. What is that? Free reserves. Only one source we need to utilize, that is free reserves. Apart from free reserve, you cannot utilize any other source. So first sources we have completed. Next, provisions for bonus issue. Whenever a company wants to go for bonus issue, is there any provisions in the Companies Act they need to comply with? Yes. In fact, there are SEBI guidelines also. Along with Companies Act provisions, they need to comply with SEBI guidelines also if they are listed company. First, we will see the provisions of Companies Act. See, these are for fully paid bonus shares. First thing is, there must be authorization in articles of association. Second thing is, the bonus issue must be recommended by board of directors. Later, it must be approved in the general meeting. So the proposal of bonus issue first will be brought by the board of directors. It will be recommended by the board of directors. Later, it will be approved in the meeting, shareholders meeting. Next, not defaulted in payment of interest or principal in respect of fixed deposits or debt securities issued by it. See, whenever a company wants to go for bonus issue, there should not be any default in repayment of principal or interest in respect of fixed deposits and in respect of debt securities issued by it. For example, a company issued debentures. Due date came, but company not paid the obligation. That means that company is not eligible for fully paid bonus shares. Suppose a company has taken a deposits from public but has not paid the deposits. Interest is not paid. Principal is not paid. Whatever. Even if interest is not paid, that is one of the default company has committed and they are not eligible for fully paid bonus shares. Remember here, fixed deposits, debt securities. Similarly, there should not be any default in payment of statutory dues to the employees. See, whatever the statutory dues payable to the employees like provident fund, gratuity, pension, bonus. So any workman compensation which is payable as per the Workman Compensation Act. So any statutory dues as per law, what are the legal benefits which need to be provided to the employees? If company made any default in payment of those benefits to the employees, that companies are also not eligible for bonus issue. Because see, they want to make one thing clear that you are giving your profits, you are converting your profits to capital. That means you are giving free shares to the existing shareholders. Now, without making the payments which is required to be paid first, how can you give benefit to shareholders? So, keeping that objective in mind, the law drafted these 2 points that once you have committed any default in payment of any of your debts, so there is no question of bonus issue. Second thing is the employees, the dues payable to the employees. So first they have committed, they have covered creditors, then employees. And one more thing, sir. So only fully paid up shares must be given, fully paid bonus shares. Partly paid up shares, company cannot issue fully paid bonus shares as a bonus. For example, 10 rupees shares, sir, only 8 rupees paid. Now this is partly paid up share. Can a company issue bonus shares? No. On this, no, it cannot. First of all, the remaining 2 rupees has to be called, and then they can issue fully paid bonus shares. See, this is not bonus by way of converting partly paid into fully paid. This is issue of fully paid bonus shares. Only shares which are fully paid by the existing shareholders, or only the shares which are fully paid up, on that company can issue fully paid bonus shares. So there are 5 conditions in the Companies Act relating to fully paid bonus shares. Tell me those 5 conditions. First, authorization in articles of association. Second, it must be recommended by board of directors, and then it is authorized in general meeting. Third, there is no default in payment of interest or principal in respect of fixed deposits or debt securities issued by it, and no default in payment of statutory dues to the employees. And partly paid up shares must be converted into fully paid up bonus shares. And one important point, sir, once the company announced the bonus issue, shall not subsequently withdraw the same. So bonus shall not be issued in lieu of dividend. This is also important point. Sir, once the bonus is declared, no question of withdrawal. You cannot withdraw. Second, bonus is not a substitute for dividend. So see, most of them are thinking that whenever a company is unable to pay the dividend, so they will issue bonus shares. So, but Companies Act says bonus cannot be issued in lieu of dividend. The meaning is that dividend is separate concept, bonus is separate concept. Bonus shares cannot be a substitute for dividend. You cannot say we have given bonus, so we will not give dividend. So there is no such thing. Depending upon the requirements of the company will issue bonus shares, or company can issue dividend also. There is no question that it is a substitute for the dividend. It will not. Okay. And then SEBI guidelines. Sir, whatever the conditions which is there in the Companies Act, same conditions are there in the SEBI guidelines also. But there are some extra points which is there in the SEBI guidelines. So out of those extra points, this one is very, very important. That is, no bonus issue will be made unless a similar benefit is extended to FCDs and PCDs. So that too, it is applicable for listed companies, because SEBI guidelines itself is applicable only to listed company. No question of SEBI guidelines is applicable to unlisted company. And this point is very, very important. What this point is saying is simple. In case of FCDs and PCDs, FCD means fully convertible debentures. PCD means partly convertible debentures. So either fully convertible debentures, or partly convertible debentures. Either fully or partly. Suppose if a company had any fully convertible debentures or partly convertible debentures, and they are making a bonus issue, see, the similar benefit will be extended to these people also. That is what they are saying. No bonus issue shall be made unless the similar benefit is extended to FCDs and PCDs. So for fully convertible debentures, partly convertible debenture holders are also eligible for bonus issue. Sir, but when they are eligible, right now they are in the form of debentures, but in future they will get converted into shares, right? At that time you need to provide this benefit. So that's why this benefit of bonus issue must be reserved for them also. That is what there in the SEBI guidelines. So remember, this is very, very important. They may ask one MCQ from this. So if you are a partly convertible debenture holder or a fully convertible debenture holder in a company, and if that company has made any bonus issue, that benefit will be extended to you also. Nothing wrong. So we have completed the provisions relating to bonus issue. Now the accounting treatment for bonus issue. See, as I told you, there are 2 types of bonus. One is fully paid bonus shares. Another one is bonus by way of converting partly paid into fully paid. Can you tell me what are the sources we can use for converting partly paid into fully paid? Only one source, that is free reserve. And what are the sources company can use for issue of fully paid bonus shares? 3 sources. What are those? CRR, free reserves, securities premium. In respect of securities premium, you remember that securities premium collected in cash. Listed companies will utilize only that. Unlisted company, there is no restriction. Now, suppose what is the accounting entries we are going to pass in case of bonus issue? First, for issue of fully paid bonus shares. First, company will declare the bonus. Sir, tell me, sir, fully paid bonus shares are declared from which sources? CRR, free reserves, securities premium. So whatever the source you utilize, debit it. So suppose you utilized CRR account debit. securities premium account debit, general reserve account debit, P&L account debit to bonus to shareholders. This is when bonus is declared. Now that bonus on issue of bonus shares, bonus to shareholders to share capital account. So reserves and surplus account debtor to bonus to shareholders to share capital account. So very easy na, two entries. Once bonus is declared and then bonus is issued, bonus shares are issued. So on declaration, whatever the source you utilized out of those three, you will debit. So reserves and surplus account debtor to bonus to shareholders account debtor to share capital. That means ultimately what is the entry we have written? Reserves and surplus account debtor to share capital. That's why bonus issue is called capitalization of profits. We are converting the profits into capital. Next, sir, suppose I am issuing bonus in the form of converting partly paid up shares into fully paid up shares. What entries will come? See, first of all, final call due entry. Because see that for that balance amount only we are issuing bonus shares now. So what we need to do is first we need to write a due entry for the final call. What is the entry for final call? Share final call account debtor to share capital. Now this call amount company will issue in the form of bonus. So therefore on declaration of bonus, and you know for converting partly paid into fully paid only one source we have to utilize, CRR, free reserves. So general reserve, P&L, nothing but free reserves account debit. Free reserves account debit to bonus to shareholders. Sir, can I utilize CRR here? No. Can I utilize securities premium? No. This is bonus by way of converting partly paid into fully paid. So that's why you have to utilize only free reserves to bonus to shareholders. Now this bonus is adjusted with share final call. That is the entry. See here, share final adjustment of final call, bonus to shareholders to share final call account. That's it. So these are three entries will come in case of bonus by way of converting partly paid into fully paid. So first entry, share final call entry. What is the entry? Share final call account debtor to share capital. Next, declaration of bonus. Free reserves account debtor to bonus to shareholders. Then this bonus will be adjusted with share final call. So the bonus to shareholders account debtor to share final call account. So ultimately what happened? Share final call account is cancelled. Bonus to shareholders cancelled. What is remaining is free reserves account debtor to share capital here also. Ultimately, that's why this is called capitalization of profits. Okay. So this is bonus issue. So the most important things in bonus issue is what, sir? Sources, the provisions and entries. Okay. Very simple. Now, next, right shares. Sir, what is right shares, sir? See, whenever company wants further capital, company can issue shares. But preferably, company may offer shares to its existing equity shareholders. Once the shares are offered to the existing shareholders, it will become their right. So that's why these shares are called right shares. Actually, if you read Companies Act, there is a separate section for further issue of shares. Whenever company wants to make a further issue, they have a choice. Either they can go for public, or they can go for private placement, or they can issue shares to existing shareholders, employees. But if they select existing shareholders, mostly they will select existing shareholders. Why? Because see, already existing shareholders means he know everything about the company. So he will understand the situation of the company. So that's why there is a chance that the right issue may become more successful. Of course, we will conduct the meeting based on the resolution only we will proceed. Okay. First of all, what is right share? Right means it is right to the person to whom we offered. Since we offered to the existing shareholder, it has become his right. See, once we have given a right to you, either you can utilize that right and subscribe, or you can transfer that right to somebody else, and that person will come to the company and he can purchase the shares of the company. That's the best part about this right shares. See, what is right shares? Right shares are the shares which are offered by the company to its existing equity shareholders at a concessional price. This is also one of the important points. Generally, right shares will be offered at what price, sir? Concessional price. Suppose in the market, the price of the share is 100 rupees, but company is offering you at 80 rupees only. Why? Because you are an existing shareholder. We want to provide some benefit to you. Suppose we will give you 100 rupees only, like that you said, now who is interested to purchase from the company? The same share is available at 100 rupees in the market also now. If I want to purchase, I will purchase from the market. Why I will purchase from you? So therefore, in order to induce the existing shareholders, okay, encourage the existing shareholders to purchase the shares, maybe some concessional price may be offered. Okay, that is called right shares. Next, see the whenever the right shares are offered, a shareholder has choices. What are the choice he had? He can accept the offer, subscribe the shares. Second thing is he can reject the offer. He says, I don't want it. I don't want to purchase the shares of the company again. So like that, he can reject the offer. He can accept the offer and subscribe the shares. That is one option. And reject the offer. And he accept the offer, but he sell the rights to somebody else. This is called right of renunciation. He can renunciate his right to do in favor of somebody else. See, understand carefully. Suppose you are the existing shareholder. Company gave an offer to you that you can subscribe this many number of shares, 1:1 ratio. Suppose you have 10 shares, we will give you another 10 shares at a concessional price. Now you accepted the offer and you can purchase the shares of the company by paying the required amount. So whatever the rate company offered, you pay the amount to the company will get the capital and you will get the shares. That is one thing. Or you can reject the offer straight away. Or once you accept the offer, of course, it is your right? So you can transfer to somebody else also. See, you accepted the offer, but you don't want to subscribe. So you can transfer the right to somebody else. Now, here in right shares, what is the important topic is this one. This is very, very, very important. You can expect a question from this. Calculation of value of right. Sir, how to calculate value of right? First of all, what is value of right? Value of right means the difference between cum rate value of the share minus ex rate value of the share. That means the share before right issue, after right issue, what is the difference? So, for example, cum rate value, that means cum means including. So, once the company announced right shares, what is the value of the share? After announcement of the right, this share is carrying this right? Because see, company offered a right to me, existing shareholder. I am the existing shareholder, company offered a right to me. Now, immediately when company offered a right to me, my shares carrying my shares carrying the benefit of right issue, because company offered to me, not to any other person. I means existing shareholders. So my share is having the right benefit. This is called cum right value of share. So is this share is an ordinary share? Yes, this is my ordinary equity share only. But on this share, company now has announced right. That means I am getting share at a concessional price. So that benefit of right is included in my share. That's why it is called cum right value of share. Now, once this right is removed from the share, that means X right. X right means after, excluding right. After right issue, what is the value of the share? So, after announcement of right, okay, what is the value of the share? And once the right issue is over, what is the value of the share? So, the difference is the value of right. That means, for example, the share value, cum right value, before right issue, the share value is 125 rupees. X right value after right issue it is 100 rupees. So therefore 25 rupees is the value of right. So you need to ascertain this value of right by this formula. Cum right value of the share minus X right value of the share. What is X right value of the share? How to find out X right value share or theoretical X right fair value per share? Also they will call it as theoretical X right fair value per share. This is a formula. Simple. This is nothing but the average book value of the share, sir. What is the average book value? How to find out this? Here. Cum rate value of the existing shares. Take the existing shares cum rate value plus right shares into issue price. How many shares company is offering and price, issue price, divided by existing number of shares plus right number of right shares. So therefore, what is the formula to ascertain X rate value of the share? X rate value of the share is cum rate value of the existing shares plus right shares into issue price divided by number of existing shares plus right shares. Okay. So this is the formula to ascertain the value of right. See here. For example, there is a company. Okay. Now that company cum rate value of the share 150 rupees. 150 rupees is the cum rate value. That means the market price, like market price before right issue, 150 rupees. And Four shares are there. Now 4 into 150, come rate value of the share, minus X rate value of the shares 145. We need to find out how they have find out X rate value of shares. See, come rate value of existing shares plus right issue into issue price divided by existing number of shares plus right shares. So come rate value of the existing shares. For example, you have 4 shares, each share 150 rupees value, market value. 4 into 150 plus, and for every 4 shares company is giving you 1 share right. So 1 into at what price company is issuing shares at 125. Okay, so 4 into 150, the come right value of the existing shares plus amount received from right issue, that is number of right shares into issue price, divided by existing shares 4 plus right shares 1. So total 725 divided by 5, it will be 145. So what is this meaning? 145 rupees is the X rate value, 150 is the come rate value. 150 minus 145, that is 5 per share is the value of right. Value of right is 5 rupees per share. Like that, 4 shares you will get, you will get 1 right share if you have 4 shares. So 4 into 5, 200 rupees is the value of right. So this is how you will find out the value of right, sir. And sir, what is the advantages or effect of right issue, sir? See, the benefit of right issue is we are offering shares to the existing shareholders. So what happens is there is no dilution in the ownership. Existing shareholders hands only, the ownership will lies. Ownership will not change, will not dilute. So that is one of the benefits, sir. And second benefit is it is better than public issue because there is a savings in cost. Because see, when I want to go for a public issue, lot of expenditure I need to incur. Since I'm offering shares to the existing shareholders, comparatively the procedural expenses, the public issue expenses will be more than offering shares to the existing shareholders. So there will be some savings in cost, and it is very easy to raise money than public issue, because see, very difficult to convince the public. So they are the existing shareholders, so they will understand, and the chances of success is also more in case of right issue. And what are the disadvantages of right issue? The disadvantage is we are offering at a concessional price, therefore company will get some less amount because of right issue. That is the only disadvantage we had. And what is the accounting treatment for right issue? See, suppose for example we offered shares at par, same manner like how when we issue shares, we write the entries cash or bank account debtor to share capital. And suppose if you issue shares at premium, so we will write share premium. So bank account debtor, share capital account debtor to securities premium. So this is the entire chapter of bonus and right issue. And in case of if you see the study material, I covered every point. There are certain questions in the study material you have to solve. You solve study material questions, that's more than sufficient, sir. I will solve the question relating to value of right, which is very important. Remaining on all, once you know the theory very well, I think they can be very easily solved. I explained the theory, you try the questions. See here. In case of how to find out the value of right, see here. There are 2 questions relating to right issue in study material. Illustration 22, you see, a company is planning to raise funds by making right issue of equity shares to finance its expansion. The existing equity share capital of the company is 50 lakh rupees. The market value of its share is how much, sir? 42 rupees. Market value 42. That means it is come right value. The company offers its shareholders the right to buy 2 shares at rupees 11 each for every 5 shares held. See, for every 5 shares, they are offering 2 shares. Okay, right to buy 2 shares at 11 rupees each for every 5 shares held. Now you are required to calculate theoretical market price after right issue. What is this theoretical market value? Market price after right issue? Nothing but X right value per share. This is called X right value per share. X right value per share. And value of right, the difference between come right price minus X right price. And percentage increase in share capital. How much increase in share capital? So first of all, we need to find out the value of right. How to find out the value of right? Come rate value of the share minus X rate value of the share. What is come rate value? Before right issue, what is the price? Before right issue, the price is, I think, 42 rupees. So we know this, 42. So see here, market value of the 5 shares, I mean come rate value of the share minus X rate value of the share. So value of right, market price 42 minus, we need to find out theoretical market price for share. How to find out theoretical market price for share? There is a formula. Come rate value of the existing shares plus right issue into issue price divided by number of existing shares plus right shares. So what is the come rate value of the existing shares? How many existing shares are there? The existing equity share capital of the company is 50 lakh rupees and the market value of the share is 42. And the company offers to its shareholders the right to buy 2 shares at 11 for each 5 shares held. You are required to calculate the theoretical market value of the share. So come rate value of the existing shares, actually see the market value per share is 42, sir. And for every 5 shares, company is giving you 2 shares, right, as a right issue, right offer. So therefore, can we say that $50 lakhs is the total capital, present capital? Okay. Now, every 5 shares, market price 42 rupees. So it will be 210 rupees, the market value of the existing shares. And how much you are extra paying, sir? Price to be paid by him for acquiring 2 more shares at 11 per share. 22 rupees I want to pay. I need to pay because 2 shares, each one is offered at 11. So therefore 232 rupees is what? The total price of 7 shares after right issue. So therefore, the theoretical market price for one share 232 divided by 7, the average value per share 33.14. So therefore 42 minus 33.14, that is 8.86, is what? The value of right. And they have asked one more question, sir. What is the percentage of increase in share capital? See, present capital 50 lakhs na. What is the right issue? For every 5 shares, 2 shares are offered. So therefore, 50 lakhs into 2 by 5. For every 5 shares, 2 shares are right. That means 20 lakhs, there is a increase. So percentage of increase is present 50 and you are increasing another 20 lakhs because for every 5 we are issuing 2. So proportionately if you take, it is 20 lakhs. So therefore 20 lakhs divided by 50 lakhs. So it will be 40% increase in the share capital. So this is how you need to arrive the value of right. Or this can be solved in the formula manner also, sir. What I have taught you by way of formula, in that manner also we can solve this. See, quickly I will explain you. See, first of all, what is value of right? So the formula for value of right is equal to come rate value per share, come rate value minus X rate value, right? X rate value. And what is the come rate value per share? 42 minus I want X rate value per share. How to get X rate value per share? Theoretical X rate fair market value. What is the come rate value of the existing shares? See, actually company is offering every 5 shares 2 shares. That means I should have 5 shares. Suppose if I am having 5 into 42, this is the come rate value of the existing shares plus amount received from right issue. So 2 shares they are giving as a right issue at 11 rupees each. 2 into 11 divided by 5 plus 2. So therefore 5 into 42 plus 2 into 11, 22 divided by 7. So it will be 33.14. This is called theoretical X rate fair value per share. So 33.14. So therefore 42 minus 33.14. So therefore 8.86 is the value of right. Value of right. So that is the 8.86 is the value of right. Value of right. So what is the meaning of this 8.86? See, if I am having 5 shares, you are giving me 2 shares, right? So that too at a concessional price. So therefore, the value of right at which I can sell is 8.86 per share. Like this, if I have 5 shares, then only I will get one right now, 2 rights. Because see, for every 5 they are giving 2. For every 5 they are giving 2. So this is per share, 8.86 per share, 8.86 per share into 5. So it will be 44.3. At this price, I will sell to the existing. I mean, if I want to sell it, I will sell it at this price, 44.3. But in exam, if they have asked what is the value of right, you calculate only per share, 8.86. Okay. So remaining questions and all, you solve it once, very simple questions. Once you listen to the theory and then solve it. Okay. This is bonus and right issue. Now the next concept what we are going to discuss is buyback of securities. So in this chapter what we are going to learn is the accounting treatment whenever a company bought back its own shares. So what is the accounting treatment we need to do? So that is the main objective of this chapter. First of all, what is buyback of shares? See, generally company will issue shares, right? When the same shares are purchased back by the company with an intention of cancellation, that is called buyback of shares. So what is buyback of shares? Purchase of own shares. See, buyback of securities means purchase of own shares and then cancellation of the same, cancellation. That means, sir, company purchased its own shares. Can it be called as buyback? No. Only upon consequential reduction, that is called, or that will, this complete activity is called buyback. It is not just we are purchasing our own shares. After purchasing, we should cancel them. Okay, that is technically called as buyback of shares. So buyback of shares means purchase of its own shares by the company. When shares are bought back by a company, they should be cancelled by the company. Thus, a company cannot buy its own shares for the purpose of investment. Sir, can a company purchase its own shares for its for the purpose of investment? No, not allowed. So that's why whenever a company purchased its own shares, it is not for investment but for the purpose of cancellation. Okay. Now, sir, whenever a company wants to buy back its own shares, there are certain provisions in the Companies Act we need to follow. Like, for example, what are the sources we have to utilize for buyback, and what are the limitations, restrictions there for buyback. So that is the main thing about this chapter. See, sir, what is the advantage? A company purchase its own shares and then cancel them. Is there any advantage to the company? Yes, there are number of advantages because of buyback. One of the advantages to increase EPS, earning per share. So how EPS will be increased? See, suppose imagine a situation, a company earning constantly same profits and number of outstanding shares are reduced. So therefore obviously earning per share will increase na. For example, see here 2023-24 current year, 2022-23 previous year. Suppose previous year our profit is 10 lakhs and the number of shares is 1 lakh. So what is the EPS, sir? 10 rupees. Suppose for example current year also 10 lakhs, but the number of shares out of this 1 lakh, around 20,000, 25,000 shares are bought back and cancelled by the company. Now the outstanding shares are only 75,000. So therefore 10 lakhs divided by 75, it will be 13.33. Obviously the earning per share has been increased, right? So that could be one of the reason why companies will go for buyback, to increase EPS. And with the increase in EPS, there is a possibility that there may be increase in the market price. So to increase EPS, and if there is no dilution in the company's earning, as the buyback of shares reduces the outstanding number of shares. Second reason could be in order to make sure that the promoters will hold their control in the company, or to increase promoters holding as the shares are bought back or cancelled. The promoters, they want to protect their interest. In order to protect their interest, or they want to increase their control. Now in such a situation, they may use this buyback as an option. For example, sir, so in company there are two groups of shareholders. promoters group, major group, and then minority shareholders, minority group. For example, sir, there is a company A Limited, in that the promoters is having, for example, 55% share capital. Remaining shareholders are having 45% share capital. Now, promoters want to increase this. So, because maybe for special resolution, so 55% is not possible. So, therefore, promoters wants to increase their share. So what they can do is they can purchase shares from the minority group and then cancel. Obviously, promoters' percentage of control will increase. For example, there are 10 lakh shares, sir. Imagine there are 10 lakh shares. So out of these 10 lakh shares, 5.5 lakh shares is there with promoters, 4.5 lakh shares is there with minority shareholders. Okay, that means 55%, 45%. Now, out of this 4.5 lakhs, what company has done is 3 lakh shares they purchased and cancelled, bought back and cancelled, bought back and cancelled. Now you tell me, what is the total number of shares of the organization? 5.5 lakhs, which is there with promoters, plus 4.5 lakhs, which is there with small shareholders, minus 3 lakhs, which is bought back and cancelled. So 5.5 plus 4.5 minus 3. So it will be 7 lakh shares. Now find out the percentage of control. Percentage of control is equal to, out of 7 lakhs after buyback, the promoters having 5.5 lakhs. So 5.5 divided by 7 into 100. So it will be 78.57%. Now come to minority shareholders. What is the percentage of control? Percentage of control is, out of 4.5 lakhs, only 1.5 lakhs remaining out of 7 lakhs. So therefore 1.5 divided by 7. So it will be 21.43%. See here, before buyback, minority shareholders are having how much? 45%. Now they are having 21.43%. Now before buyback, actually promoters are having 55%. Now they are having 78.57%. How this is possible? Because of buyback. So increase promoters holding, buyback can be used as an option. See, to increase EPS, earning per share, and this is the first reason. Second is to discourage others to make hostile bid to take over the company, as the buyback will increase the promoters holding. See, we don't want our competitors will come into our company. So if our competitors wants to, take over the company by making a hostile bid, so this buyback may used as a strategy to, to increase the promoters holding. So suppose if majority of the holding is there with promoters, then obviously the company interest will be protected. Because see, these minority shareholders, maybe our competitors or outside investors, they offer more money to these small investors, and they will get the share capital in the company, and they are entering into the share capital of the company, ownership of the company. Now that is not advantageous to the company. Therefore, through this buyback, promoters can increase their holding so that they can protect the interest of the company. They can protect others. The competitors are not entering into the business. Next, to support the share price on the stock exchange, when the share price, in the opinion of the management, is less than its worth, especially in a depressed market. Sir, when there is a depressing market conditions, the market price is continuously falling down. Na? In that situation, how to protect the share price? How to support the share price? Now, in such situation, we can use buyback as a strategy. Now, Infosys company, I think last year. So, because the CFO or CEO of the company has been resigned overnight, now the share price has gone down pretty quickly. Now, what Infosys has done is, Infosys has announced a buyback. In a depressing market conditions, Infosys announced buyback, making sure that shareholders, don't worry, we are ready to purchase the shares of the company at this price. So therefore, obviously, the panic of the shareholders will be reduced, because the company came and ready to purchase the shares at a prescribed price. So whatever be the market price, whatever the price fall, so we are not bothered, because the company announced a buyback. So to support the share price in a depressing market conditions, company can go for buyback. And then when company is having surplus cash, what they can do? They can reduce their obligation by paying the money back to the shareholders. That means they announce the buyback. So those who are interested will sell the shares to the company. Company will purchase. So these are the reasons why company will go for buyback. So what are the advantages of buyback? So the first one is to increase EPS, thereby market price. Second price is promoters wants to increase their control. They can increase control through buyback. Third one is to discourage others to take over the company. Next, fourth, to support the share price, especially in the depressing market conditions, and to pay the surplus. Okay. Sir, suppose a company decided to go for buyback. Now see, in buyback what happens, sir? Company purchases its own shares and then cancel them. Right? Company purchases its own shares and then cancel them. Therefore, the share capital has been reduced. Share capital has been reduced. See, similar to redemption of preference shares. In redemption of preference shares also, if you see, company redeeming the capital to preference shareholders, the share capital has been reduced. So, in case of buyback, what company can do is, what are the sources company can utilize for buyback of securities? Companies Act is putting a restriction on the sources for which are to be used for buyback of securities. So, first, free reserves company can use, securities premium company can use, and proceeds of the fresh issue of shares company can use. So these are the three sources company can use for buyback its own shares. Okay, now important, listen to me. Sir, what is the sources of buyback? See, these sources are to fill the gap which is created by buyback of securities. See, because of buyback, the funds of the organization has been reduced. Na? So we need to protect the interest of the creditors. How we are going to protect the interest of the creditors? By using the reserves of the company, free reserves, securities premium, proceeds from fresh issue of shares or other specified securities. Suppose if company is depending upon the proceeds of the issue of shares or other specified securities, company need not worry, because company issues the shares and get the money. That money is utilized for buyback of securities. Suppose if there is no option of fresh issue, then company can go for what? Free reserves or securities premium. So because of the buyback, whatever be the amount of capital reduced, now to fill that capital, company may use its existing free reserves or securities premium. So remember which sources a company can use in case of buyback. So source means here the gap in the capital which is created by buyback has to be filled up by transferring the amount to CRR. I mean, in redemption of preference shares, I told you why we will create CRR. Two things: capital intactness, second, to protect the interest of creditors. Same logic will apply here. Even in case of buyback also, we need to create CRR. Now, if you want to create CRR, from where you create? You create CRR from free reserves or securities premium. So, an amount in nominal value of shares so bought back must be transferred from free reserves or securities premium to CRR. So, in redemption of preference shares, we created CRR. Na? Why we created CRR? Because when you go for redemption, the funds of the organization will gone down. So, creditors' interest is affected. Therefore, we need to ensure that the creditors' interest is protected. That's why what we have done, from the existing profits of the equity shareholders, we transferred some amount to CRR. We restrict it. Therefore, it is not possible to give dividend from that restricted reserve, CRR. And later, CRR will be utilized only for one purpose. What is that? Fully paid bonus shares. So, therefore, two objectives can be achieved by creating CRR. One is capital intactness. Second one is to protect the interest of creditors. So here also, in case of buyback, we create CRR when we depend upon free reserves and securities premium. Suppose if you are going for fresh issue, automatically capital is created, funds also collected. Na? What is the need to create CRR? When we need to create CRR? When the existing funds have been utilized for buyback of securities. Suppose for example 10 lakh rupees, sir. This 10 lakh rupees company collected by fresh issue. See, when 10 lakhs is collected by fresh issue, that means funds is coming from outside and capital is already created. So therefore, no need to create CRR. But see, suppose existing profits company utilized, our cash reserves reduced, creditors not happy. Therefore, we need to create CRR from free reserves or securities premium. So therefore, you need to understand, like redemption of preference shares, here also we need to create a CRR. That is very, very important. See here. 10th point. Section 69 states that where a company purchases its own shares out of free reserves or securities premium, a sum equal to the nominal value of shares so purchased must be transferred to CRR account and details of such account shall be disclosed in the balance sheet. And the CRR account may be applied by the company in paying up fully paid bonus shares to the shareholders. Okay. So therefore, what is the common point here? The most important point. Redemption of preference shares, buyback of securities, buyback of shares. So in both these cases, law says, CRR can be created when you are not depending on fresh issue, when you are depending upon existing sources. Then from free reserves or securities premium, you need to transfer the amount to CRR to the extent of the nominal value of preference shares bought, preference shares redeemed or shares bought back. So remember, this is one of the important point. See, students these days now, they are unable to understand. The moment Act says following sources have to be utilized, they thinking that the amount from these sources must be utilized. Yes, the amount from these sources will be utilized by creation of CRR. See, actually tell me, free reserves belongs to whom? Equity shareholders, right? Now these free reserves you are transferring to CRR. That means free reserves you are restricting. That means this cannot be given as a dividend now. That's how we are restricting. That's how we are protecting the interest of creditors. So by restricting the reserves. Similarly, securities premium. Suppose if you are depending upon fresh issue, what is the need to create CRR? So only when you depend upon these two sources, or when you depend upon the existing sources of the company, existing cash reserves, then from these two things you can create CRR. Suppose if you are going for fresh issue, no need to create CRR. So tell me, what are the sources for buyback? So first of all, company want to purchase its own shares. For that, company requires some money, right? So that money they can arrange from fresh issue. So fresh issue of shares or other specified securities they can issue, or they can use existing cash, existing reserves in the company. Existing cash reserves in the company, asset side cash can be utilized. Now they are saying that when you use existing cash, existing reserves, cash reserves of the organization, creditors not happy because you are paying the amount back to shareholders. We are, as a creditor, we are not happy. Therefore, law is making it mandatory that, okay, don't worry. In case of buyback also, what is happening? Capital is reduced by using the existing cash reserves. So therefore, we will protect your interest. How? By restricting the free reserves to transfer to CRR. So we brought the concept of CRR. Now, the purpose for creation of CRR is two things. One is capital intactness. How capital will be intact? Because from this free reserve securities premium, you are transferring the amount to CRR. Later, the CRR will be used for fully paid bonus shares. That means it will convert as a share capital. That is the one reason. That means capital is intact. Second reason could be, see, if you restrict the free reserves, that means in future this is transferred to CRR and the CRR cannot be utilized for dividend. Therefore, these free reserves will not go out of the organization in the form of dividend. Therefore, the cash reserves will be protected. That's how we are protecting the interest of creditors. Okay. So therefore, what are the sources we can utilize? So the moment I said the sources for utilization of buyback, I mean for buyback of shares, either you use existing reserve, existing cash in the organization. If you use existing sources, then these two could be utilized to create CRR. Suppose if you are depending upon fresh issue, absolutely no problem. But remember one thing, sir, when a company is going for buyback, no buyback of any kind of shares or other specified securities shall be made out of the proceeds of earlier issue of the same kind of shares or same kind of specified securities. For example, if I want to buy back equity shares, can I issue equity shares and get the money? And with that money, can I buy back equity shares? No. It is not a game. See, for fun, you cannot go for buyback. Sir, existing equity shares are there, sir. We will buy back equity shares and we will make a fresh issue. From that we collect some amount. That amount we use it for purchase of buyback of equity shares. No, not allowed. So no buyback of any kind of shares or other specified securities shall be made out of the proceeds of earlier issue of the same kind of shares or same kind of other specified securities. For example, if equity shares are to be bought back, preference shares may be used for the purpose. For example, I'm buying back equity shares, sir. I may issue preference shares. So that is possible. Okay. Remember, so in MCQs, they may ask, suppose a company is going for buyback, they are buying back equity shares and they want to issue equity shares for the funds. Okay, is it allowed? Not allowed. Not allowed. So this is about sources of buyback. So what are the points we learned till now? Company purchases its own shares with an intention of cancellation. Whenever there is a buyback, so company can go for fresh issue, collect the amount, and with that money they can buy back. Now if they go for fresh issue, the existing reserves are not affected, existing cash amount, bank balance is not affected, therefore no need to create CRR. But when the moment company using its existing cash and bank balance for buying back of the securities, therefore they need to create CRR to protect the interest of creditors and to make sure that the capital will be intact. How? From free reserves and securities premium to the extent of the nominal value of shares so bought back must be transferred to CRR, and later on the CRR will be utilized for fully paid bonus shares. Now, apart from these conditions, apart from the sources, there are conditions, other conditions also very, very important. But see, there are so many conditions for buyback. Law point of view, they are very much important. But accounts point of view, three conditions are very, very important. They may ask as a separate question also. That is maximum number of shares that can be bought back. So see, in examination, they may ask a question relating to buyback. What the question could be? Maximum number of shares. Maximum number of shares that can be bought back. Maximum number of shares that can be bought back. Maximum number of shares that can be bought back. Okay. So Companies Act is not allowing free hand here. How many shares you want to buy back? Buy back. No, not allowed. They are saying that three conditions. Out of these three conditions, there are so many conditions, but out of these three conditions are very, very important from accounting point of view. So which involves calculations and numbers. So what is the maximum number of shares that can be bought back? First test is shares outstanding test. Shares outstanding test. Second test is resources test. Resources test. Third test is debt equity ratio test. Debt equity ratio test. Now apply these three tests. Find out number of shares that can be bought back by using these three tests. For example, shares outstanding test, you can buy back 1 lakh shares. Resource test, for example, 75,000 shares you can buy back. Debt equity ratio test, 1 lakh 2,000 shares you can bought back. Now, what is the maximum number of shares to be bought back? Least of them. So, what is the least here? 75,000 shares. So, this is the maximum number of shares a company can buy back. Maximum number of shares company can buy back. So, in exams, they may ask a question. Find out, they will give you the balance sheet of a company and says this company is going for buyback. Find out the maximum number of shares, or they will give you this many number of shares company wants to buy back. Tell me whether it is permittable as per the act or not. Then you need to find out the maximum number of shares to be bought back and compare with the actual number of shares which a company wants to buy back. If it is within the limits, allowed, otherwise not allowed. So therefore, what is the maximum number of shares to be bought back, sir? Three conditions, sir. Shares outstanding test, resources test, debt equity ratio test. Now, first test. What is shares outstanding test? Simple. Suppose if you are buying back equity shares, then the buyback should not exceed 25% of paid up equity share capital of that financial year. So whenever a company is going for buyback of equity shares, it should not exceed 25% of paid up equity share capital of that financial year. Paid up equity share capital of that financial year. Okay. Now go for resources test. This test says what is the maximum amount we can use for buyback. See, the maximum amount that can be used for buyback is it should not exceed 25% of paid up capital plus free reserves. 25% of paid up capital plus free reserves. Here paid up capital, here paid up equity share capital. Paid up equity share capital. So whenever you are buying back equity shares, na sir, the restriction is, the limit is 25% of paid up equity share capital. Resource test is amount. How much amount I can use for buyback? The amount that can be used for buyback is 25% of the, should not exceed 25% of the paid up capital plus free reserves. Here free reserves including securities premium. Generally securities premium is not part of free reserves, but here we should include securities premium. And debt equity ratio test, which says ideally debt and equity should be maintained in 2:1 ratio. If debt is 2 rupees, equity should be 1 of debt. So after buyback, debt is not more than twice the paid up capital and free reserves. So we need to maintain debt equity ratio in 2:1 ratio. Okay. So see, by applying shares outstanding test, resource test, debt equity ratio test, under each test you find out the number of shares to be bought back. Now the least is the thing. The least is number of shares which is allowed. See this question in StudyMat. To understand these limits relating to buyback calculation, what is the maximum number of shares that can be bought back? See here, there is a company called R Limited which wants to buy back 1 lakh equity shares of 10 each at 20 each. 10 rupees each share they want to buy back at 20. The buyback is allowed in Articles of Association and the company has obtained necessary approval from the shareholders. The company has sufficient bank balance to make the payment for buyback of shares. That means company is depending on what? Existing sources. That means when company is depending on existing sources, definitely CRR has to be created because the existing cash reserves will be decreased when company go for buyback. So creditors' interest we need to protect. And this is the information they have given. Now you need to understand, you need to calculate what is the maximum number of shares to be bought back. Actually company wants to buy back 1 lakh shares. Is it permitted or not? We need to find out. See here, first of all, shares outstanding test. They want to buy back equity shares. So 50 lakhs into 25% limit. So 50 lakhs into 25. It will be 12 lakh 50 divided by face value 10. So therefore 1 lakh 25,000 shares are to be permitted to be buyback. Shares outstanding test. 25% of outstanding shares. Some students what they will do now? 25% of 50 lakhs they will apply. Then they will get 12 lakh 50,000 divided by buyback price. No, this is wrong. Because see, here the test is what? Shares outstanding test, which says the maximum number of equity shares that can be bought back is 25% of the paid up equity share capital of that financial year. You know, capital is always represented at face value. Therefore, you cannot divide it with buyback price. You have to divide it with face value. Then only you will get the number of shares to be bought back. Because see, if you purchase and cancel each share, the share capital is reduced only by face value. Because share capital will always be written in the books at face value. Even though you are buying back at 20, we don't reduce share capital by 20. So therefore, see here, 12 lakh 50 divided by 10. So 1 lakh 25,000. Or you can do simply, what is the number of shares? 50 lakhs divided by 10, 5 lakh shares into 25%. Then only 1 lakh 25,000 shares will come. So the first test, very simple, shares outstanding test. Now come to resource test, which says what is the maximum amount which is allowed for buyback? 25% of the paid up capital plus free reserves. See here, paid up capital plus free reserve. Paid up capital means both equity plus preference plus free reserves. Free reserves means including securities premium we have to take. Okay. Now take here 50 lakhs equity share capital, 60 lakhs general reserve, dividend equalization reserve is also free reserves. balance in P&L account. So 50, 60, 10, 5. So therefore total 1 crore 25 lakhs. Correct, sir? 1 crore 25 lakhs. See here, 1 crore 25 lakhs. On that you should apply 25%. Then you will get 31 lakh 25,000. So what is this 31 lakh 25,000? See, this 31 lakh 25,000 is the maximum amount which is allowed for buyback. So by using this 31 lakh 25,000, how many shares I can buy back? So 31 lakh 25 divided by 20. Each share is bought back at 20. So then you will get 1 lakh 56 250. See, understand, sir, you said in shares outstanding test we need to divide it with face value. Now you are saying that we need to divide it with buyback price. See, understand the concept here. Here second test is all about resources. That means how much amount you can use for buyback. It is amount related test. This is number of shares test. Understand the test. Okay, what Companies Act says, when you are buying back equity shares, it should not exceed 25% of the capital, paid up capital. But when you use resources amount, maximum amount you can use for buyback is 25% of the paid up capital plus free resource. That's why I divided with buyback price, because for each share I need to pay 20 rupees. So 20 rupees cash is going out. So therefore 1 crore 25 into 25%, that is 31 lakh 25 divided by 20, then you will get 1 lakh 56,250. That is the number of shares that can be bought back as per resource test. Now the most important test is debt equity ratio test. What is this test says? See, after buyback the debt equity should be ideally maintained at a 2:1 ratio. So therefore first I will take total debt. What is the total debt of the company? Here debt is both secured plus unsecured debt. See here, this is the debt: 75 lakhs, 40 lakhs, 66 lakhs. 10% debentures, bank loan, current liabilities. The total debt I have taken 1 crore 81 lakhs. Now if debt is 1 crore 81 lakhs, what will be equity? 2:1 ratio, exactly half. So therefore 90 lakh 50,000. This is the equity after buyback. So in order to maintain 2:1 ratio after buyback, my debt and equity, so if my debt is 10 rupees, my equity should be 5. Then only 2:1 ratio will be maintained. Similarly, if my debt is 1.81 crore, my equity should be 90 lakh 50,000. Now this is the equity I need to maintain, 90 lakh 50,000. And what is my present equity? Present equity, paid up capital plus free reserve. See, please understand, equity means equity share capital, preference share capital, free reserves, including securities premium. So present equity already we calculated in resource test, 1.25 crores. So therefore I need to maintain 90 lakh 50, but at present my equity is 1.25. Therefore there is a possibility of reduction in equity. Suppose if there is no possibility of reduction in equity, then debt equity ratio test is not satisfying. Therefore buyback is not permitted, because the present equity itself is less than what you are going to maintain in future. So because of buyback, the equity will further down. Now how can you maintain 2:1 ratio? Suppose sir, the equity you need to maintain after buyback is 100 rupees sir. At present you have only 80 rupees equity. So how reduction is possible sir? Not possible na. As per debt equity ratio, you need to maintain 2:1 ratio after buyback. Suppose at present 150 rupees is there equity. After buyback you should maintain at 100. Therefore you can reduce 50. So by this 50, how many shares are allowed to be buyback? But the twist here is, there is a legal compulsion. As per the Companies Act, whenever you are depending upon the existing cash reserves for buying back, an amount equal to the nominal value of shares so bought back must be transferred from free reserves to CRR. Therefore, from the existing free reserves and CRR, from existing free reserves, first you need to transfer the amount to CRR. Then only the balance amount will be utilized for buyback. Therefore, suppose for example, equity to be maintained after buyback is 100. Present equity 150. Can I use 50 rupees, total 50 to buyback? No. First from this 150, I need to transfer the amount to CRR. Only the balance amount I can use for, suppose out of 150 I transfer to CRR 10. Therefore 140 will be there. 140 100 minus 100. So 40 rupees I can use for buyback. So therefore always you have to be very, very careful. What is the present equity we need to maintain here in this question? 90,50,000 we need to maintain after buyback. What is the present equity? 1 crore 25 lakhs. How much reduction is possible? From this 1.25, first we need to transfer the amount to CRR. How much amount we transfer to CRR? To the extent of the nominal value of shares so bought back. How many equity shares we need to buy back? That is what only we are trying to find out now. So therefore here the situation arises like this. On one hand, we need to transfer the amount to CRR. On the other hand, we don't know the nominal value of shares so bought back. Because that is the reason why we are applying 3 tests. Out of the 3, whichever is least, that is the maximum number of shares to be bought back into nominal value. Then I will get nominal value of shares so bought back. Therefore here, how I am going to solve is, you need to frame certain equations. Most of the students are not learning these equations. These equations are very, very easy. As per the law, you have to create these equations. See, first, let us assume the amount to be transferred to CRR be X. Assume that the amount to be transferred to CRR be X. And maximum amount permitted for buyback. Maximum amount permitted for buyback. Assume it as Y. Okay, now frame equation number 1. What is equation number 1? For example, maximum amount permitted for buyback, that is Y is equal to present equity. First you need to take the present equity. In this problem, what is the present equity? 1 crore 25 lakhs minus amount to transfer to CRR, that is X, minus what is the equity to be maintained after buyback? Equity to be maintained after buyback. After buyback, how much equity we need to maintain? Present equity 1 crore 25 lakhs, sir. And out of that I need to transfer the amount to CRR. I don't know. So that's why I assumed it as X, minus equity to be maintained after buyback 90,50,000. We know this. So 125 minus 90.5, that will be 34.5 lakhs minus X. This is equation number 1. Y is equal to 34.5 minus X. What is Y? Maximum amount permitted for buyback. How you will arrive maximum amount permitted for buyback under debt equity ratio test? Simple. At present, what is the debt? Okay, exactly half equity. 90,50,000 equity I need to maintain. Okay, what is the present equity? 1.25 crores. So 1.25 crores is the present equity. From that, in that free reserves also included, securities premium, including securities premium. First I need to transfer the amount to CRR. Therefore, present equity minus CRR minus equity to be maintained after buyback. This is equation number 1. Now frame equation number 2. Equation number 2 is how much amount I need to transfer to CRR? X is equal to, generally nominal value of shares so bought back must be transferred from free reserve CRR. So to ascertain the nominal value of shares so bought back, first I need to know how much amount is permitted for buyback. That is already we assumed as Y. So Y divided by 20, buyback price. Each share we are buying at 20 rupees now. Then we will know how many shares we are buying back into the face value 10 rupees. So therefore, here in this question, the face value is 10 rupees only, na? Yes, 10 rupees. Once again, I am telling, sir, simple equation. X amount to be transferred to CRR is equal to Y, maximum amount permitted for buyback under debt equity ratio test, divided by 20. You will get number of shares to be bought back into 10 rupees face value. Then you will get nominal value of shares to be bought back. This is equation. So therefore, 2x is equal to y. So therefore, this is equation 1, this is equation 2. Now solving. So if I solve this, in place of y is equal to 2x, so 2x is equal to 34.5 minus x. So it will be 3x is equal to 34.5. So x is equal to 34.5 divided by 3. So it will be 11.5. What is this 11.5? X. What is x? Amount to be transferred to CRR. Therefore, x 11.5. If x is 11.5, what is y? So y is equal to 34.5 minus 11.5. So therefore 34.5 minus 11.5. It will be 23. That means this is the amount which is eligible for buyback. So understand, what is your present equity? 1 crore 25 lakhs. What is the equity to be maintained? 90 lakh 50. How much reduction is possible? 34 lakh 50. But total 34 lakh 50,000 is eligible for buyback? No. First you need to transfer the amount to CRR from the existing equity. So that amount to be transferred to CRR is the nominal value of shares so bought back. That is what we are trying to find out. What is the maximum number of shares that can be bought back? So that's why we assumed CRR be X. Maximum amount permitted for buyback is Y. So I framed two equations. See, these equations I framed keeping the legal provisions. What is Y? Maximum amount permitted. How much amount is permitted? Present equity minus CRR minus equity to be maintained after buyback. What is X? Amount to be transferred to CRR is nothing but the nominal value of shares so bought back. So amount permitted divided by 20 into face value, nominal value. So I solved 11.5, 23. So therefore you see here, maximum permissible for buyback 23 lakhs. So if 23 lakhs is permitted, each share we are buying back 20. So therefore 1,15,000 shares can be bought back by debt equity ratio test. Because under debt equity ratio test, only 23 lakhs is eligible. Sir, how you got this 23 lakhs? See, 1.25 crores existing equity, future equity to be maintained 90.5. So therefore, reduction is possible 34.5. But first I transferred the amount to CRR. So I framed simultaneous equation, I solved it, I find out the amount to be transferred to CRR. Then the balance amount is eligible for buyback. Divided by 20. 1,15,000. See, most of the students, instead of framing these equations, they are doing mathematically. They are trying to solve by mathematics. You won't get any marks. Only you have to solve this way. So this is the maximum number of shares to be bought back. 1,15,000. So under three methods you apply. As per shares outstanding test, 1.25. Resource test, 1,56,250. Debt equity ratio test, whichever is least. And company wants to buy back 1 lakh. So buyback is permitted. So this simultaneous equation method is very, very important. Okay. Now, so these are the conditions relating to buyback. Now, whenever a company wants to go for buyback, what is the entries we can form? What is the entries? See, these equations here given also. If you want, you can see it once. Here, journal entries. Suppose, for example, a company wants to go for buyback. First, it's sold if any investments are sold. See, existing assets can be sold. So, for buyback, bank account debtor, investment account debtor to P&L. Suppose if they are sold at profit. And what is the entry for buyback? Equity share capital account debtor, because capital will be reduced. Suppose you are buying back at premium on buyback to equity shares buyback account. And then equity share buyback account debtor to bank. Or you can write directly equity share capital account debtor, premium on buyback account debtor to bank account also. Or you can write two entries. First, buyback entry. When you buy back, what happens? Buyback and cancel. So equity share capital will be debited. And if you are buying back at premium on buyback will be debited to equity shares buyback account. Then equity share buyback account results in bank account to bank, because we need to pay the amount to shareholders. Then suppose this premium on buyback you can adjust with securities premium. And the most important entry is this one. Transfer to CRR. Sir, tell me when you are going to transfer the amount to CRR. When company utilizes existing, see here, investments, existing cash, if they utilize it now, that means creditors interest we need to protect. That's why from free reserves or CRR, we need to transfer the nominal value of shares of bought back from free reserves to CRR. So for that, this entry we will record. Suppose if company depends upon fresh issue, no need to create CRR to that extent. So this is the main thing about buyback. Now the next chapter is preparation of financial statements of companies. Examination point of view, one of the important chapters. And in this chapter, we are going to cover Schedule 3 of Companies Act 2013. Basically, in this chapter, what we are going to learn, sir, in preparation of financial statements of companies, first we need to understand what is the format for balance sheet and P&L account. So in case of a company, how financial statements will be prepared by following schedule 3. So we should learn that schedule 3 and some miscellaneous other concepts are there, miscellaneous topics. Like in CMA material, if you see, you have a concept relating to provision for tax. So that will also I will cover. Okay. And this is the chapter you have to cover it comprehensively. Okay. This is one of the important chapter. Definitely you can expect 14 marks question and 2 marks MCQ. And first of all, in order to solve that big question, balance sheet and P&L question, you should have an idea about the format of schedule 3. Now, first of all, what is meaning of financial statements? P. As per section 2 clause 40 of the Companies Act 2013, financial statements includes balance sheet at the year end, P&L account for the financial year, and in case of NPO, we prepare income and expenditure account, cash flow statement, and any explanatory note annexed to or forming part of the above. And one more thing you can add, sir, here, statement showing changes in equity. Statement showing changes in equity. This is also one of the component of financial statements. So that means there are 5 things which are called as financial statements: balance sheet, P&L account, cash flow statement, statement showing changes in equity, and any explanatory note forming part of the above. But in case of some companies like OPC, one person company, small company, and a dormant company, as per Companies Act, cash flow statement is not mandatory. Cash flow statement is not mandatory. Because see, generally cash flow statement is mandatory for level 1 big enterprises. So for small companies and dormant companies, one person company, generally cash flow statement is not mandatory. Okay. So we understood what is financial statements. Next, frequency of financial statements. Generally, we will prepare financial statements annually, every year. Once in every financial year, we prepare financial statements. But if you are a listed company, according to the listing agreement, you may need to, list the financial statements every quarter. Therefore, the listed companies are required to prepare financial statements on quarterly basis, and they will submit it to the SEBI. Okay. Next, section 129 subsection 1, very very important section 129, sir. Sir, what section 129 says is, whenever you prepare financial statements, the financial statements must reflect a true and fair view of state of affairs of the entity. And whenever you prepare any financial statements, you comply with accounting standards. And whenever you prepare financial statements, you comply with schedule 3. So they are saying that whenever you prepare financial statements, it shall give true and fair view. See, this will be the ultimate objective in preparation of financial statements, because whatever the information we are submitting through financial statements, so it should reflect the true and fair view of affairs, state of affairs of what happened in the organization. So there should not be any window dressing, or there should not be any wrong disclosures. So exactly what happened, the financial statements must reflect that position, that performance. So that will be the first requirement for preparation of financial statements. Your financial statement should reflect true and fair view. 129 says. Second thing is, comply with accounting standards notified under 133. See, accounting standards must be applied in the preparation of financial statements. Of course, if those accounting standards are applicable to your organization, you have to apply them in the preparation of financial statements. And also, you need to follow the formats which is prescribed in schedule 3. So that means it is mandatory for every company to follow schedule 3 and prepare their financial statements as per the format which is given there. Okay. So can you tell me what section 129(1) says? First of all, the financial statement should reflect true and fair view. Second of all, the financial statement should comply with accounting standards. Third point, the financial statement should be prepared in the format. according to schedule 3. And now one more important point which is prescribed by 129 is, whenever you prepare financial statements, every year you need to conduct AGM, annual general meeting. In that AGM, it is the responsibility of the board of directors to lay down these financial statements before the shareholders, and shareholders must approve these financial statements. So at every AGM, board of directors shall lay before such meeting the financial statements for the financial year. They must lay down the financial statements. See, because in case of company, who are the owners? Shareholders. Now we have to submit what is our financial performance and what is our financial position before the owners. That's why every year company will conduct one annual general meeting, and all the shareholders will be called to that meeting, and in that meeting the financial statements will be given and approval is taken from the approval is taken from the shareholders. Once we got the approval, the company will release annual report. Okay. Now one more important point, sir, as per 129, suppose if you are a parent company, you are having one or more subsidiaries, then in addition to the independent financial statements, so anyway the company has to prepare financial statements for its own for its company, and along with that they need to prepare consolidated financial statements also. So this is also mandatory as per section 129. So 129 is one of the important sections which exclusively talks about financial statements. So 129, 3 points they are saying. First thing is, financial statement should reflect true and fair view, should comply with accounting standards, and should be in the format which is specified in schedule 3. Second, every annual general meeting the financial statement should be laid down before the shareholders. It is the responsibility of board of directors. Third, when you have one or more subsidiaries, apart from your individual financial statements, you need to prepare financial statements for the entire organization. We call them as consolidated financial statements. Okay. Sir, you said we need to prepare financial statements in the format which is specified in schedule 3. Yes. The form and content of financial statements. See, the form and content of financial statements is specified in schedule 3. And the object is to bring uniformity. Suppose if given a choice, every enterprise will follow different format, then it will be does not serve the purpose of comparability of financial statements. So we want to bring some kind of uniformity, some kind of sameness in the preparation of financial statements. That's why the Companies Act through schedule 3 has given a format, and each item where it need to be disclosed, under which head it need to be disclosed, and relating to that item what information we need to present in the notes to accounts to the balance sheet and P&L account is also specified in the schedule 3. Now basically this schedule 3 has 3 divisions: division 1, division 2, division 3. See, division 1 is general instructions for preparation of balance sheet and P&L account, whose financial statements are required to comply with Companies Accounting Standard Rules 2021. So there are 3 divisions in schedule 3. Division 1 is about general instructions for preparation of balance sheet and P&L account of a company whose financial statements are required to comply with accounting standard rules. Second, division 2, general instructions for preparation of financial statements of company whose financial statements are drawn up in compliance with the Indian Accounting Standard Rules 2015. So there is a difference. Division 1 talks about whose financial statements are required to comply with Companies Accounting Standard Rules 2021. Division 2 talks about general instructions of preparation of financial statements of a company whose financial statements are drawn up in compliance with company's Indian Accounting Standard Rules 2015. And third division is general instructions for preparation of financial statements for NBFC, whose financial statements are drawn up in compliance with Indian Accounting Standard Rules 2015. So see here, division 1, general instructions for preparation of balance sheet and statement of P&L whose financial statements are required to comply with Companies Accounting Standard Rules 2021. Companies Accounting Standard Rules 2021. Division 2, general instructions for preparation of financial statements of company whose financial statements are drawn up in compliance with Companies Indian Accounting Standard Rules 2015. Okay. And the third one is general instructions for preparation of financial statements for a NBFC whose financial statements are drawn up in compliance with Indian Accounting Standards rules 2015. So whatever, you are not required to remember all these things. Just remember that schedule 3 has given a format. Of course, in schedule 3 we have 3 divisions. So division 1, division 2, division 3. Of course, last division is for NBFCs and first 2 divisions are for normal other companies. So suppose if you are following Indian accounting standards, then division 2 is mandatory. Otherwise, normal accounting standard rules division 1. See, because there are normal accounting standards and later on Indian accounting standards was released. Okay. Anyways, now very important, sir. Division 2, I mean schedule 3, part 1. See, actually division schedule 3 we have part 1, part 2. Part 1 is about balance sheet. Okay. Now very important part is the format of the balance sheet. So the balance sheet has divided into 2 parts, sir, according to schedule 3. One part is equity and liabilities. See, this is the first part of the balance sheet, equity and liabilities. And then second part is assets. So one after another. First you need to show equity and liabilities and make the total of all the items in equity and liabilities. Then you start asset side and make the total. Like how normal balance sheet is prepared, same manner only, but presentation difference. Generally, we prepare balance sheet in T shape. Now, one side we will take liabilities, another side we will take assets for normal small proprietorship forms, normal partnership forms, because for them schedule 3 is not applicable. Schedule 3 is mandatory for corporate entities. So therefore, they will be prepared in T shape, but here not in that manner, one after another. So the presentation. First you take name of the company and balance sheet as at, suppose balance sheet you are preparing on 31st March 2024 and name of the company X Limited, and then figures at the end of the current reporting period, figures at the end of the previous reporting period. Generally, if you see practically the financial statements along with the current year figures, you will see previous year figures, because in order to enable comparison so easy, so the schedule 3 is suggesting that along with the current year figures you need to present last year figures also. But when you are solving problems, last year information most of the times will not be given. Therefore, this column you are not required to prepare. Only if you prepare this, it is sufficient. But in practice, we will do. So along with the current year figures, we will take previous year figures also. Now, first equity and liabilities. See, equity and liability side, we have 4 heads. One head is shareholders fund. Another one is share application money pending allotment. Third head is non-current liabilities. Fourth head is current liabilities. So with me everybody, tell me what are the 4 heads of equity and liabilities. First, shareholders fund. Second, share application money pending allotment. Third, non-current liabilities. Fourth, current liabilities. This is the main heads, 4 heads of equity and liabilities. Now coming to assets, 2 major heads, non-current assets, current assets. That's it. Non-current assets, current assets. See, non-current assets, current assets. That means in balance sheet, total there are 6 major heads. So 4 on equity and liability side, 2 on asset side. Once again, equity and liabilities, first shareholders fund, second share application money pending allotment, third non-current liabilities, fourth current liabilities. Asset side, you see non-current assets, current assets. You see, according to schedule 3, there is one common point. What is that common point now? The assets as well as the liabilities are divided into current, non-current. Current, non-current. Schedule 3 has divided the assets into non-current assets, current assets, as well as the liabilities, non-current liabilities, current liabilities. So we will understand what is current liability. So what is non-current liability? Which items generally will come in non-current liabilities? Similarly for assets, what is current asset? What is non-current asset? We will see. Now, let us start with the first head on the equity and liabilities, shareholders fund. See, we know we need to show the share capital and liabilities. So in share capital, they say first of all relating to shareholders. What are the things? So shareholders fund. In that there are 3 heads. What is that? First, share capital. Second, reserves and surplus. Third, money received against share warrant. Share capital, reserves and surplus, money received against share warrant. So share capital, whatever be the paid up capital contributed by the shareholders, it can be equity share capital or it can be paid up preference share capital. We will take under share capital. Reserves and surplus, we will see all kinds of reserves and surplus, like for example, general reserve, revenue reserve, securities premium, dividend equalization reserve, debenture redemption reserve, capital reserve, P&L account. Every kind of reserve we will take under reserves and surplus. Next, money received against share warrant. See, share warrant is also a financial instrument which is issued by the company, which gives the right to the holder to purchase the shares of the company in future at a predetermined price. So even see, by issuing share warrants also company can raise capital. Generally, how company will raise capital? By issuing shares. Now, financial share warrant is also an instrument, a document which will give you the right to purchase certain shares of the company. So that's why money received against share warrant is also part of shareholders fund, but it is not included in share capital. Remember, when it will be included, when actually by using this share warrant, the shareholder, the person who is holding the share warrant, if he purchase the securities of the company, then the amount will turn into share capital. Till that time, it will be there as a separate item, that is money received against share warrant. Okay, so share warrant is a financial instrument which gives the holder the right to subscribe shares of the company in future at a predetermined price. So therefore, it is whatever the amount company received by sale of these share warrants, it is part of shareholders fund but not part of share capital. That's why we have to show it separately. So in shareholders funds, what are the three items? Share capital, reserves and surplus, money received against share warrant. See, Schedule 3, what they have done is, for every item, they have given general instructions. For example, if you take share capital, relating to share capital, what additional information we need to disclose in the financial statements they have given. See, this is the main balance sheet. In this balance sheet, you will present share capital. You will write the amount. For example, share capital 10 lakhs. Now, for example, see, if the share capital is 10 lakhs, what is the breakup of this 10 lakhs? How many shares company issued? How many of them are subscribed by public? How much is the paid up capital? And there are other information relating to the share capital, which is not possible to present in the balance sheet. That's why for balance sheet, we will prepare what? Notes to accounts. So the information in the notes to accounts is also very, very important information, which is mandatorily required to be disclosed because it is there in the schedule 3 itself. So schedule 3 is a minimum requirement. Whatever the information disclosure requirements which is there in the schedule 3, every entity has to follow. Of course, if they want to make more disclosures, they are most welcome. I said schedule 3 is a minimum disclosure requirements. Now, if you see share capital, relating to share capital, what points I need to disclose? Additional points. Anyway, in the balance sheet, I will disclose share capital amount, but that is not sufficient. You have to see notes to accounts also. Schedule 3 says, in respect of share capital, what we need to present is the number, the amount of shares authorized for each class of share capital. Equity share capital, preference share capital, for each share capital, each class of share capital, we need to present the number, how many shares. We have to write clearly 1 lakh equity shares of rupees 10 each, amount of shares authorized. First, you need to present authorized capital. So, every company will have authorized capital, na? That authorized capital we need to present. Next, the number of shares issued, subscribed, fully paid. Subscribed but not fully paid. Authorized capital. Next, how many shares issued, how many shares subscribed by public, how many shares fully paid. Sometimes subscribed but not fully paid. That has to be shown separately. And then par value per share, face value per share, definitely you need to disclose. So these are all important requirements, sir. Sir, if somebody asks me, sir, why I need to present all this information? Why you are unnecessarily wasting so much of time and energy? So in balance sheet we have written share capital. Is that not sufficient? No, that is not sufficient. Because schedule 3 making it mandatory for every organization, you need to present all possible information which will be useful for the users of financial statements. So just writing the numbers with the name is not sufficient. You have to present it more elaborately. That's why we are presenting the requirements also. This is the information you need to present. For example, if you are presenting information relating to share capital, we see in balance sheet share capital amount, but that is not sufficient. You have to present how many number of shares you issued, what is the shares authorized, how much amount of shares is authorized, how many shares are issued, subscribed, fully paid, subscribed but not fully paid, what is the par value per share. And we need to do a reconciliation of number of shares outstanding at the beginning and at the end of the reporting period. For example, opening shares 1 lakh, closing shares 2 lakhs. What is the difference? How changes happened? A reconciliation statement we need to prepare. And what are the rights, preferences, restrictions attached to each class of shares, including the distribution of dividend and repayment of capital. See, equity share capital. Within equity share capital, there are different classes. So, what are the rights? What are the preferences? What are the restrictions attached to each class of shares, including restrictions regarding payment of dividend? For example, if I purchase this class of equity shares, how much I will be able to participate in the dividend. For example, if I purchase preference shares, what is my participation rights? What is my repayment of capital? Which preference I will get? So all these rights, restrictions, preferences we need to disclose relating to each class of shares in the notes to accounts. Similarly, in respect of each share in the company held by its holding company or its ultimate holding company, including shares held by subsidiaries, associates of the holding company or the ultimate holding company in aggregate. So, how in the company, how many shares are held by parent company? Suppose if I am a subsidiary company, in my company, how many shares are held by parent company? 50%, suppose more than 50, 51%, 60%, 70%. Similarly, for example, I am an associate company. In that, the investing company had how many shares? So, I have to clearly disclose. And this is important, sir. Shares in the company held by each shareholder holding more than 5% shares, specifying number of shares held. Suppose in your company, more than 5% shares held by any shareholder, we need to disclose the name of the shareholder. Name, how many number of shares he had. For example, you take Reliance company. Suppose Mukesh Ambani is having 10% of the shares. We need to clearly mention his name. So this many number of shares this shareholder had. So more than 5%. Remember, MCQ can be asked. So see, these are all disclosure requirements. What are the information we need to disclose according to Schedule 3? So the lawmakers, whatever the information they feel is very, very important relating to that particular item, so they have written in Schedule 3 and we are learning that. So therefore here you need to read, you need to remember the things. Okay, so that's why most of the times there won't be any logic. If they feel, the lawmakers feels that this is the important information we need to disclose, now they will write that point in the Schedule 3. Suppose see, holding more than 5% shares, whoever have the shares more than 5%, so we need to disclose the name and number of shares. Similarly, company, any shares are reserved for issue under options, contracts, commitments, for sale of shares, disinvestment, including terms and amounts. For example, any shares which is company wants to issue under any contract. So under any commitment, how many shares the company is reserved to issue to a particular person or particular party under any contract commitment. So we need to clearly mention the terms and amounts, and I point is important. Sir, three situations. One is whenever company issued shares without payment being received in cash. That means shares issued for consideration other than cash. Second, shares issued by way of fully paid bonus shares. Third, buyback of shares. Remember, important point. Three situations. One is shares are issued for consideration other than cash. Second, issue of fully paid bonus shares. Third, buyback of shares. See, if any one of these three situations happen in the organization, we need to disclose how many number, what is the class of shares. How many number, aggregate number, class of shares. Aggregate number, class of shares. Common points. Aggregate number, total number of shares issued for consideration other than cash. Total number of shares issued as fully paid bonus shares. Total number of shares bought back. And not only that, class of shares, which type, which class of shares they are. Equity, preference. Within equity, there are different classes. Which class of shares they are. So we need to clearly disclose. Sir, for how many periods? 5 years. 5 years we need to disclose. Okay. So this is the point. So whenever a company has made fully paid, issue of fully paid bonus shares, the aggregate number, the class of shares, they need to disclose. And whenever a company bought back any shares, they need to disclose the aggregate number, class of shares. Similarly, when a company issues shares for consideration other than cash, they need to clearly disclose the aggregate number and class of shares. And apart from that, So what are terms of any securities convertible into equity or preference shares along with the earliest date of conversion? For example, we issued any convertible bonds, convertible debentures, convertible preference shares, when they are going to convert into equity shares, what is the date of conversion? So all these things we need to write. Calls unpaid. So calls unpaid, whenever company made a call on shares, so if any amount is not paid, how much amount of calls is still not paid, unpaid, calls in arrears, nothing but showing aggregate value of calls unpaid by directors and officers. See, if any calls made by company and amount is due from directors and officers, we have to disclose them separately, because the company persons, so those who are the directors and officers itself is not paying the amount, how others will pay, sir? So that's why they are saying that you have to highlight this point, you have to disclose separately. Next, forfeited shares. Suppose if company forfeited any shares, how many number of shares they have forfeited, amount originally paid up, in respect of those forfeited shares, how much amount we already received. So all these points we need to disclose. And also see how many shares the promoters had. See, promoter is a person who bring the company into existence, you know that. So that promoter, the promoter of the company, here the promoter is what is defined in the Companies Act. So whoever be the defined as promoter, now that promoter, how many, who is the name of the what is the name of the promoter, how many shares he had, what is the percentage of total shares, and is there any change during the year. For example, Mr. X is the promoter, he is having 1 lakh shares, and out of total shares it is 10%. Okay, now change during the year. For example, out of this 10%, 1 lakh shares, 50,000 shares are sold. That means 5% decrease he is holding. That we need to disclose. This is about share capital. Sir, do we remember all these things? No. Just one time plain reading is sufficient. First of all, what we are learning, always remember that in point. We are learning schedule 3 format of balance sheet. In that, first we are in equity and liability side. Equity and liabilities, first one, shareholders fund. In shareholders fund, share capital. Regarding share capital, what points we need to disclose, we are discussing. So regarding share capital, first we need to write the number and amount of shares authorized. First, always authorized capital you need to write in the notes to accounts. Then issued, subscribed, fully paid. Subscribed but not fully paid, you have to disclose separately. What is the face value of the share? What is the reconciliation of number of shares outstanding at the beginning and end of the period? And what are the rights, preferences, restrictions attached to each class of shares, including in the aspect of dividend and repayment of capital. Okay, so and then what are the shares in a company held by each shareholder having more than 5% shares? His name and number of shares held we have to disclose separately. And if any shares are reserved for issue under any options commitment contracts, we need to disclose the terms and the number of shares and amount also. And if shares are issued for consideration other than cash, if shares are issued as fully paid bonus shares, and if the shares are bought back, if any one of these three situations happen, the aggregate number class of shares we need to disclose it for 5 years. So calls unpaid, anything, and if any calls unpaid from the directors and officers, we need to disclose separately, and then forfeited shares. So at least the points I have put a star mark now, they are important. So I think you read once, I think you will remember, it will fit into your mind. Okay, now come to reserves and surplus, sir. Sir, shareholders funds, what is the second item, sir? Reserves and surplus. Reserves and surplus, schedule 3 has given information like this: capital reserve, capital redemption reserve, securities premium, debenture redemption reserve, revaluation reserve, share option outstanding account. Important. The moment you see outstanding account, most of you will feel that it is a liability. No, it is share option outstanding account. Actually, employee stock option outstanding account also can be called. ESOP chapter, employee stock option plan. There is a chapter called ESOP, employee stock option plan. In that chapter, whenever we issue shares to employees less than market price, the concession, so we will generally recognize this account, share options outstanding account. Okay, this share option outstanding account is not a liability, it is a reserves and surplus. Reserves and surplus, and any other reserve and surplus. What is surplus, sir? Sir, according to schedule 3, surplus is nothing but P&L account, the balance in P&L account. Here one important point, sir, balance in P&L account. See, generally reserves and surplus means which balance? Credit balance or debit balance or credit balance. But of course, if reserves and surplus is having a debit balance, that is also to be considered. Okay. For example, P&L account debit balance is there. P&L account debit balance. What is the meaning? This means we have losses. Generally, P&L account should have credit balance. Suppose if the P&L account is having a debit balance, that means it is losses. So whenever it is a loss, can I show it on the asset side, opposite side? No. See, this practice is not permitted. Even if the reserves and surplus is having negative balance, you have to show under the head reserves and surplus only with a negative symbol. So remember, there can be a question possible here. See here, debit balance in the statement of P&L should be shown as a negative figure under the head surplus only, under the head P&L only. Similarly, the balance of reserves and surplus after adjusting negative balance of surplus, if any, be shown under the head reserves and surplus, even if the resulting figure is in the negative side. That means, see, for example, capital reserve 1 lakh, CRR 2 lakhs, debenture redemption reserve 3 lakhs, P&L account minus 10 lakhs. See, that means your total will become minus 4 lakhs, right? Minus 4 lakhs. Even then, you have to present under the head shareholders fund, reserves and surplus only. You cannot show it on the asset side. See, there is a practice. Previously, especially when the balance sheet is prepared like this. So what they have usually done it now, reserves and surplus, the P&L account is having a debit balance, they have shown it on the asset side, opposite side. So that type of practices is not permitted here. Even if the P&L account is having a debit balance, we have to show under the head reserves and surplus only with a negative figure. Okay, I think we have completed the shareholders fund. So shareholders fund, first share capital, then reserves and surplus, money received against share warrant. Now second head, you see the second head, share application money pending allotment. Sir, what is the share application money pending allotment? See, any application money received but no allotment has been done. By the end of the year, any money already received from the prospective applicants who applied for shares, but allotment has not yet done. So without allotment, can you include them as a part of share capital? No. That's why they have not taken into shareholders funds. That's why there is a separate head. So therefore, suppose a company went for public issue on 25th March. Now we have received all the applications by April 5th. That means on 31st March. So some of the amount from the share application we have received, but no allotment has been done. Without allotment, you cannot consider the share application money as part of share capital. That's why share application money pending allotment. So on 31st March, no allotment, but application money received. So that should be shown separately. Sir, you cannot say, sir, these are received from shareholders. No, sir. No, they are not shareholders. Only when the shares are allotted, they will become shareholders. Suppose if I applied for shares, now company has to allot the shares to me, then I become shareholder. Na? Without allotting shares, can I also be considered as a shareholder and member of the company? No. Therefore, on 31st March, whatever the application money received but pending allotment to the shareholders, that we have to show separately. Don't include it as a part of shareholders fund. Okay, it's a kind of a liability, sir. You received the amount, but you have not made any allotment under the contract. So therefore, other party money is there with you. So that is like income received in advance. It's a liability kind. That's why they have not included it as a part of shareholder. But once allotment is done, of course, it will go to shareholders fund as a part of share capital. Okay. So the second head is also completed. Next, liabilities. Sir, coming to liabilities, sir, I told you liabilities are two types as per schedule 3. One is non-current liabilities, another one is current liabilities. Sir, when we call a liability as current liability, see, schedule 3 has given a criteria to classify liabilities as well as assets. First, we will see the liability. Important, listen to me carefully. See, they told 4 criteria. If any one of the criteria is satisfied, then that liability is called current liability. Similarly, for assets also, they told 4 criteria. If any one of the criteria is satisfied, they call it as current asset. So first of all, what is current liability? See, a liability is said to be current liability if it satisfies any one of the following. First one, it is expected to be settled in the normal operating cycle. Sir, any liability is expected to be settled. See, they are not saying that due to be settled, expected to be settled in the normal operating cycle. So that is called current liability. So what is expected to be settled in the normal operating cycle? For example, what is normal operating cycle? They say how much time it has taken to convert the raw material into cash or cash equivalents. Now that cycle, that period is called normal operating cycle. So normal operating cycle is a cycle how much time it has taken to convert the raw material into cash or cash equivalents. For example, first you purchase the raw material will convert into work in progress, later it will become finished goods, and this finished goods you will sell and you will finally get cash and cash equivalents. Now for this to become cash and cash equivalents, how much time it has taken? Raw material waiting time, work in progress time, finished goods time, then marketing time, and finally realization of the amount. Now all these things you have to include and you will get the time limit, that is called normal operating cycle. Now within that normal operating cycle, whatever the liability you are expecting to settle, that is current liability only. For example, there is a company, manufacturing company, the normal operating cycle is 6 months. Now within 6 months, whatever they are expecting to settle, it's a current liability. For example, normal operating cycle is 15 months. Within 15 months, whatever the liability they are expecting to settle, they are current liabilities. Normal operating cycle can be more than 12 months also. So how much time it has taken to convert the raw material into cash and cash equivalents? Now that time is called normal operating cycle. Sir, suppose we are a trading entity or we are an entity we are unable to determine the normal operating cycle. See, when you are unable to determine the normal operating cycle, then assume it as 12 months. That means any liability you are expecting to settle within 12 months is a current liability. Any liability which you are not expecting to settle within this 12 months obviously will be non-current liability. So the first thing is, when we call a liability as current liability, it is expected to be settled within the normal operating cycle. Second, any liability held primarily for the purpose of being traded. See, for the purpose of trading, whatever the liabilities you held, like for example, futures, options, forwards, swaps. So all these things you do now. So for hedging purpose, no, for for trading purpose, being traded, company will enter futures, future contracts, forward contracts, options, all these derivative contracts. Now they are held primarily for the purpose of trading. See, for the purpose of trading, if you held them, they are also current liabilities. Next, anything due to be settled. See, due to be settled within 12 months. What is the first one? Expected to be settled within the normal operating cycle. Third one, due to be settled. Due. It means it is compulsorily due within 12 months. Due to be settled within 12 months after the reporting date. Reporting date means 31st March. So whichever the year you are preparing, suppose 23, 24, 31st March 2024 is the reporting date. From that day within 12 months, that means 31st March 2025. So 31st March 2025. So within 12 months, anything we are expecting to settle, due to settle, not expected to settle, due to be settled. For example, next 12 months we need to repay debentures. Next 12 months we need to repay the loan. Next 12 months we need to pay some other kind of liabilities. We need to discharge. So whatever you due to be settled within 12 months after the reporting date, we call it as what? Current liability. So most of the students will follow this one. But see, they have told 4 criteria. So what is the first one? Tell me. Expected to be settled within the normal operating cycle. What is normal operating cycle? How much time it has taken to convert the raw material into cash or cash equivalents. Suppose if you are unable to establish the normal operating cycle, so then take 12 months. Next, anything held primarily for the purpose of being traded. For the purpose of trading, whatever the contracts the company had held, from that contracts any liability arises, that is also current liability. And third, it is due to be settled within 12 months after the reporting date. And the last one, the most important one, is the company does not have unconditional right to defer the settlement of liability for at least 12 months after the reporting date. Sir, any liability, the company does not have unconditional right to defer the settlement of liability for at least 12 months after the reporting date. And terms of liability that could, at the option of the counterparty, result in the settlement by issue of equity instrument do not affect its classification. See, important. The company does not have what? Unconditional right to defer settlement of liability for at least 12 months after the reporting date. What is unconditional right? See, unconditional right means without asking the other party, without taking permission from other party, if I can able to take any decision, that is unconditional right. Whatever I want, I can do. Unconditional right. But here the entity, company does not have unconditional right. For what? To defer settlement of liability. Can I defer the settlement of this liability? I mean, can I postpone this liability? Or can I make this liability paid in installments? Somehow I can defer the liability? No. You don't have the unconditional right to defer the settlement of liability for at least 12 months after the reporting date. At least 12 months. 12 months or more. Can you postpone? No. Can you defer? No. You don't have the right. Now, in such a cases, such kind of liabilities are also called current liabilities because you don't have the right to postpone it 12 months or beyond. That means it should be settled within the 12 months. Therefore, it's a current liability. And see, suppose at the option of the counterparty, other party, we can settle the liability by issue of equity instruments. Will it make any difference in classification? Absolutely no difference in classification. Whether you settle a liability in cash or you settle a liability in equity, it doesn't make any difference. Best example could be loan repayable on demand. Demand loans. Loan repayable on demand. Suppose you have taken a loan from bank, sir, or from any party you have taken a loan, and that loan is repayable on demand. That means whenever other party demanded, you have to repay it. So that means it's a very short-term loan, short-term liability. Now, how can you have an unconditional right to defer it at least 12 months after the reporting date? You don't have the option. So definitely this will become what? Current liability. Similarly, any convertible bonds. For example, you issued convertible bonds. Now these convertible bonds due date came in the next 12 months. Suppose from this 31st March, next 6 months it is due to be settled. Do you have the right to defer it? No. I don't have the unconditional right to defer the settlement of liability for at least 12 months after the reporting date. For example, see, 31st March 2024 is the balance sheet date, reporting date. Suppose 30th September 2024 is the maturity date of the bonds, convertible bonds. Now, suppose for example on 30th September 2024 means next 12 months, next 6 months, you have to pay it. Can you have the right to defer it? No. Of course, the terms of the option that could at the option of the counterparty result in its settlement by issue of equity. For example, other party may exercise the option or may not exercise the option. What is the option for? The option is we have given an option to them to, if you want, you can take shares, convertible bonds. If you want, you can take the shares. Suppose we are expecting that they will take shares, or we may expect that they will not take shares. See, your expectations doesn't matter here. That's why Schedule 3 says whether they will exercise the option and take the shares or not take the shares, it won't affect the classification. Even if they opt for equity instruments, you cannot say, sir, we have not paid any cash, sir, we issued shares, sir, so therefore we will not consider it as a liability. No. So you settle the liability even by issue of equity, it does not affect the classification. Still, it has to be considered as what? Current liability. So I think there is no question from this till now, but they can ask. So remember, what is the fourth one? Company does not have what? Unconditional right. You yourself cannot take a decision. You does not have the right for what? To defer the settlement of liability for at least 12 months after the reporting date. But other party, see, according to the terms of the contract, the other party can exercise the option of taking shares also. It won't affect the classification. When we issue convertible bonds, convertible debentures, so they will near to the next maturity date. So from this reporting date, suppose if they're due to be settled within 12 months and you don't have the unconditional right to defer it beyond 12 months, you have to classify them under what? Current liabilities. So therefore, what is current liability, sir? A liability is said to be current liability if it satisfies any one of the following. First one, it is expected to be settled within the normal operating cycle. Second, it is held primarily for the purpose of being traded. Third, it is due to be settled within 12 months after the reporting date. Fourth, the company does not have the unconditional right to defer the settlement of liability for at least 12 months after the reporting date. Now, if a liability satisfies any one of these four, we call it as current liability. All other liabilities are non-current liabilities. All other liabilities are non-current liabilities. Now come to the non-current liabilities and current liabilities. So we understood what is current liability, what is non-current liability. Now listen, Schedule 3 has classified non-current liabilities into four categories or four heads in non-current liabilities. First one, long-term borrowings. Because all short-term borrowing comes under current liability. Just now we have seen anything due to be settled within 12 months, where you does not have the unconditional right to defer settlement for at least 12 months, expected to be settled within the normal operating cycle. That means in essence what we can say is anything to be settled within 12 months or in near future, naturally it will comes under current liabilities. Anything to be settled in long run, but after seeing the definition of current liability, anything to be settled in the long run, definitely it will form part of non-current liability. That's why you see non-current liability, what is the first one? Long-term borrowings. And in current liabilities you see short-term borrowings. So Schedule 3 has how they have classified long-term borrowing. See here, long-term borrowings here, bonds and debentures, long-term borrowings, bonds and debentures. Can anywhere be bonds and debentures be short-term borrowings, sir? Can any company issues bonds and debentures for 12 months? No. They are long-term finance providers, long-term finance. There is no question of short-term. Even if you read Schedule 3, they will be part of long-term borrowings only. So long-term borrowings shall be classified as first bonds and debentures. Next, term loans, term loans. See, there are different loans we take from the bank. Term loans is important. Term loans means any loan which is taken whose the period of the loan is more than 1 year. 1 year, 2 years, 3 years, 4 years, 5 years, 10 years, they are called term loans. Maybe from banks, from any other parties, maybe from financial institutions, maybe from other companies, from individuals. Company has taken a loan, no problem. Term loans, it should be term loan, not short term loan, not cash credits. No, term loans. So term loans naturally indicates that it's a long term loan. And any deferred payment liability. Sir, what is this deferred payment liability? See, where a liability you are settling in parts, in I can't say exactly installments, because installment sale is generally associated with when I purchase goods based on installment basis, then we say it's an installment. Installment includes principal plus interest. So maybe deferred payment liabilities are a liability to be settled in parts. That's it. A liability which we can settle or which we defer it for the future. For example, there is a GST liability, okay, of 20 crores. Now this GST liability you are not paid, an entity not paid. Now GST department send a notice saying that you have not paid 20 crores GST liability, please pay it. Now company accepted the liability and said we are unable to pay 20 crores at a time, so please give us some facility of paying in installments. Now GST department has given a 20 for example 5 years time, 5 years, every year you pay some amount, okay, so with simple rate of interest. So 20 crores divided by 5, so 4 crores you pay. Maybe then we will call it as deferred payment liability. So there is a liability of 20 crores and this liability you are paying every year 4 crores, like that for 5 years. So deferred payment liability. Next, any deposits. Sir, these are the deposits we taken from outside public, generally deposits taken from public or deposits taken from employees, whatever, long term nature. Any loans and advances from related parties. Suppose if I am a subsidiary company, any loans and advances taken from my parent company, any loans and advances taken from associates, joint ventures, these are all liabilities. That's why loan taken. Next, long-term maturities of finance lease obligations. This is important. This can be asked as an MCQ. This can be asked as an MCQ. Long-term maturities of finance lease obligations. Sir, any asset taken on finance lease, okay, any asset purchased under finance lease, according to that finance lease, whatever the amount we need to pay to the owner, to the lessor, those long-term maturities are also our long-term liabilities. Now, see, whenever we are presenting any borrowings, Nana, I mean, we have to classify long-term borrowings as secured, unsecured. secured, unsecured. Generally, when we take any borrowings, now definitely the party who is providing the loans, borrowings, they will ask for security. So if they are secured, you need to mention the nature of security. Shall be specified separately in each case. See, that means when you are presenting the balance sheet, for example, loan from bank, you have given land and building as a security. You have to write clearly secured by land and building. For example, you issue debentures. For debenture holders, you have given plant and machinery as a security. You have to clearly write that debenture holders are secured by plant and machinery. Can you tell me what are the items which comes under long-term borrowings? How long-term borrowings are classified? Bonds and debentures, term loans from banks, from other parties, deferred payment liabilities, deposits, loans and advances from related parties, other loans and advances. How borrowings are classified? Borrowings are subclassified as secured, unsecured, and we need to mention the nature of security in each case in the notes to accounts. Okay, so that means in balance sheet we completed this long-term borrowings. Next, deferred tax liability. See, this will be discussed as in AS 22. Actually, in your financial accounting paper, you have AS 22. Okay, anyways, what is deferred tax liability? See, what I can tell you is, if it is a deferred tax liability, take it under non-current liability. If it is a deferred tax asset, take it under non-current assets. So, for presentation purpose, if you remember this much, this is more than sufficient. Deferred tax assets, deferred tax liability. If it is a deferred tax liability, where will you show? Non-current liability. If it is a deferred tax asset, where will you show? Non-current asset. And what is deferred tax asset? What is deferred tax liability? So, tax effect of timing differences between accounting income and taxable income. See, age 22. So, I don't think so they will ask what is deferred tax asset, what is deferred tax liability. But they will give you deferred tax asset or deferred tax liability in the balance sheet. You have to, where you have to write non-current liability if it is a liability. Asset, non-current asset. That's it. Please remember that much. And if you want to know more about AS 22, then financial accounting, this is there. So you go and study. But what I can tell about deferred taxes are timing, tax effect of timing differences between accounting income and taxable income. Okay. Now deferred taxes are also done. Now other long-term liabilities and then long-term provision. See, every head you see, assets and liabilities, there is others. Because see, how many items you classify, sir? It is not possible now. So that's why they have made a specific classification for long-term borrowings, deferred tax liabilities, long-term provisions. Remaining and all others. Similarly, if you see current liabilities also, short-term borrowings, trade payables, short-term provisions. Remaining and all others. So others, remaining item. Suppose if there is no specific head for any item, take it under others. Very easy. Take it under others. Suppose if you are unable to recollect whether it is a particular head or not, then simply you write in the others. So remember, but name you should write correctly. Non-current liabilities, we call it as other long-term liabilities. Current liabilities, you cannot call other current, other short-term liabilities. We need to call it as other current liabilities. Here, other long-term liabilities. And of course, long-term provisions, short-term provisions. Any provisions made by the organization, if it is of long-term nature, you will take under non-current liabilities. Specific head A, B, C, D, D, long-term provision. And if it is a short-term provision, we will take under current liabilities, short-term provisions. So first of all, what is provision? See, as per AS 29, provision is a liability which is measured with a substantial degree of estimation. Liability is a present obligation arising from past events, the settlement of which requires outflow of resources. To put it simply, any provision is a liability. That's why we are showing under the head liabilities. Non-current liability, current liability. That's why see, if you create any provision on asset, don't show here. These are assets. So these are liabilities. Only provisions relating to liability or provision itself is a liability you show here. Any provision you see relating to assets like provision for doubtful debts, provision for depreciation, all these are assets related provisions. We need to reduce from concerned assets and show it in the financial statements. Okay. So other long-term liabilities, long-term provisions, provision for warranty or provision for employee benefits. So these are all long-term, any other provision. Similarly, short-term provision. For example, provision for tax. Sir, provision for tax, which provision, sir? Short-term provision. Why? Because whatever the provision we create now, that has to be settled within 12 months. Definitely taxes has to be paid. So therefore, short-term provision, long-term provision. You see in the question, generally they won't specify. They will specify which provision is this, long-term provision or short-term provision. Generally, provision for tax given, take it under short-term provision. Suppose they have not mentioned anything, then you take an assumption. You can consider it as long-term provision or short-term provision. But provision for warranty they have given. So generally consider it as long-term. Because when you sell the goods on warranty basis, so you have to incur some cost to make the repairs, to make the replacements. Now for that you need to anticipate and you need to create a provision. So that could be naturally long-term. Okay. So like this, long-term provisions, short-term provisions, you have to write. See here, other long-term provisions, provision for employee benefits, others like provision for warranty we can take. Provision for warranty we can take. Any other provision you want. Similarly, short-term provision also same. See here, provision for employee benefits. Sir, whenever an employee going to retire, sir, we need to pay PF, gratuity, pension, all those things. So we need to mention. Okay. But remember here, provision for tax. Generally short-term provision. Okay. So that means what is the remaining thing in non-current liabilities? Other long-term liabilities. Other long-term liabilities. Generally, what items comes in other long-term liabilities? Suppose there is a liability which is not a current liability, which is not fit into the definition of current liability, but which is not long-term borrowings, which is not deferred tax liability, which is not a long-term provision. Then generally we need to take it under other long-term liabilities. Now look at how Schedule 3 has classified it. See, other long-term liabilities. Other long-term liabilities are classified as trade payables and others. Any other item. Sir, what is trade payables? Generally, we will show trade payables as a part of current liabilities, na sir. See here. Current liabilities, we have trade payables. See, suppose a trade payable means creditors. Creditor for goods. Suppliers, nothing but. So generally, trade payables is due to be settled within the normal operating cycle. Then you will take it as a part of current liability. But for example, any creditor, if it is not due to be settled within the normal operating cycle, it is not due to be settled within 12 months after the reporting date, if it is not satisfying any criteria of the Schedule 3 current liability, then you take it under other long-term liabilities. So that's why here they have given trade payables. Which trade payable is this? The trade payable which is not satisfying the definition of current liability will be taken here. See here, important. This trade payables is long-term trade payables. Trade payables you take here. Suppose generally trade payables is part of current liability. That's why in current liabilities also you have trade payables. That trade payable is satisfying the definition of current liability. For example, sir, there is a company, the company normal operating cycle is 12 months and there are creditors. Suppose they are required to be settled within 15 months. That means they are not required to be settled within the normal operating cycle. Suppose they have not to due within 12 months of the reporting date, any criteria is not satisfied, then where they will be taken? Tell me. If they are not satisfying the definition of current liability, they have to be taken in non-current liabilities. In non-current liability, is it a long-term borrowings? Amount payable to creditors? No, we have not taken any borrowings. We have taken goods and we need to make the payment. So therefore, where we need to take? We have to take under other current liabilities. Remember this, very, very important. Okay. So that means non-current liabilities, 4 heads completed. Can you tell me what are the 4 items in non-current liabilities? Long-term borrowings. First one. How long-term borrowings are classified? Bonds, debentures, term loans from banks, from other parties, deferred payment liabilities, long-term maturities of finance lease obligations, public deposits, okay, and loans and advances from related parties. And how borrowings will be classified? Secured, unsecured. If they are secured, nature of security has to be specified. Deferred tax liability. Deferred tax liability is a non-current liability. Deferred tax asset, non-current asset. And then other long-term liabilities. If any liability not fitting into any of the above or any of the specific items, then take it under other long-term liability. And last one, long-term provisions. Provision is a liability. Don't take provision on asset. Provision on asset will be deducted from the concerned asset. And then come to current liabilities. Current liabilities, we have short-term borrowings. There we have long-term borrowings, here short-term borrowings. See, generally in short-term borrowings, you cannot take bonds, debentures, term loans from banks. See here how short-term borrowings are classified. Observe the difference between long-term borrowings and short-term borrowings. Here loans repayable on demand. That's why I said demand loans from banks, from other parties. Whenever bank demanded, we need to repay. Whenever the other party demanded, we need to repay. So these are always short-term borrowings. Loans and advances from related parties. Deposits, other loans and advances. And similarly, how borrowings are classified into secured, unsecured. Even short-term borrowings are classified into secured, unsecured. And if they are secured, the borrowings are secured, we need to specify the nature of security. And see, sometimes whatever the borrowings we have taken, if they are guaranteed by the directors, how much amount of such loan is guaranteed shall be disclosed separately. And current maturities of long-term borrowing shall be disclosed separately. This is very, very important. Sir, basically that liability is a long-term borrowings. Out of that, if it is due to be settled within 12 months, we call it as current maturities of long-term borrowings. First of all, tell me, debentures is which liability? Long-term borrowings. Just now we have seen it is long-term borrowings, non-current liabilities. Suppose if this debentures is due to be settled within 12 months, then it will become a current liability. In current liability, where we will show, sir, we will show it as a part of short-term borrowings. Important, sir, short-term borrowings. Current maturities of long-term borrowings. For example, debentures you have issued for 5 years, 10% debentures. Suppose 100 lakhs. These debentures where we will show in the balance sheet. Non-current liabilities la long-term borrowings. Correct? Suppose if this debentures is going to be settled within 12 months, next 12 months, then it will satisfy the definition of current liability. Then it is no more a non-current liability. It's a current liability. In current liability, where we will show? We will show as a part of short-term borrowings. So that means basically it's a long-term borrowings. Non-current liability is long-term borrowings. But in future, whenever it satisfies the definition of current liability, it will turn into a current liability as a short-term borrowings. Okay, this is how the short-term borrowings will be classified. So current liabilities, what is the first item? Short-term borrowings. What is the difference between long-term borrowings and short-term borrowings, sir? Long-term borrowings, bonds, debentures are there. Here bonds and debentures not there. Because why bonds and debentures are not there? Because bonds and debentures basically long-term. But the moment they become short-term, they are required to be settled, they will be part of short-term borrowings now. So that's it. We call them as what? Current maturities of long-term borrowings. What is that? Current maturities of long-term borrowings. So remember, this is very, very important point. Next, trade payables. Trade payables means just now I told you, creditors. Creditors for goods, if they are satisfying the definition of current liability, if they are required to be settled within the normal operating cycle. So then generally take. But suppose if trade payables not fit into the definition of current liability, where we will show non-current liability, others. Just now. Next, short-term provisions. Any provision of short-term, any liability, for that you created a provision. Take it, short-term provision, if it is for 12 months. Next, any other item, others. See, this other current liability is important here. What items generally comes in other current liabilities? See here, other current liabilities. Current maturities of finance lease obligations. Sir, long-term maturities of finance lease obligation. Long-term maturities. For example, you take in any asset on finance lease, and in respect of that finance lease, whatever the amount you require to pay, long-term maturities of finance lease obligation, where it will come? It will come under non-current liabilities, long-term borrowings. Suppose current maturities of finance lease obligation, that means if that liability is to be settled within the 12 months, current maturities of long-term borrowings, then it will be part of other current liabilities. So here important thing is, bonds and debentures are also long-term borrowings. But if they are required to be settled within 12 months, if they become current liabilities, where they will be shown as a part of short-term borrowings. But in respect of long-term maturities of finance lease obligation, basically it's a non-current liability, long-term borrowings. But if they become settled within 12 months, then it should not be treated as short-term borrowings, but it should be treated as other current liability as of now. Okay, remember. Next, any interest accrued but not due. Interest accrued and due. So, for example, on borrowings, suppose you taken a debentures. On those debentures, interest accrued, but not due. Due date not came, but interest already accrued. Sufficient. We will recognize as a other current liability. Interest accrued but not due. Interest accrued as well as due. recognized as a other current liability. Income received in advance. Any advance received from customers. It's a liability, na? Other current liability. Where we will show, is it a short-term borrowings? Is it a trade payable? Is it a short-term provision? No, others. Unpaid dividend. Suppose dividend declared but not paid. And similarly, application money received for allotment of securities and due for refund and interest accrued thereon. Now, important, sir. Sir, you taken the money, application money, but for some of the applicants, you have not made the allotment. Sometimes it is not possible. Now, for example, there is a oversubscription. In case of oversubscription, some of the applicants' applications are rejected. Now, by the end of the year, application was rejected, but the amount is not yet refunded. See, when you don't make the allotment, you need to refund it back the amount. Now, that amount which is already taken, but application shares allotment has not been done, which is due for refund now, it will also become other current liability. See, application money received for allotment of securities and due for refund, because your application is rejected, we are not allotting any shares to you. Okay, then whatever the amount I paid, please give it back. Okay, application money received for allotment of securities and due for refund and interest accrued thereon. See, as per the Companies Act, if you are not allotting the shares in time, you have to repay the money back. If you are not repaying, you have to repay along with interest. Similarly, any unpaid mature deposits and interest accrued thereon. Unpaid mature deposits. Already you taken a deposit, they are required to be settled within 12 months. Due date came, but you have not paid. That means it is part of short-term borrowings under other current liabilities, including interest accrued thereon. Similarly, unpaid mature debentures and interest accrued thereon, and others. So these are other current liabilities. Definitely other current liabilities is important, sir. Please read it once. So what items comes under other current liabilities? Current maturities of finance lease obligations, interest accrued but not due, interest accrued and due, income received in advance, unpaid dividend, and any application money taken for allotment of securities but it is due for refund, interest accrued thereon, and unpaid mature deposits and interest accrued thereon, unpaid mature debentures and interest accrued thereon. Okay, so this is the current liabilities, and then total. So tell me, balance sheet, what is the first part, sir? The first part is 4 items are equity and liabilities. In equity and liabilities, the first one, shareholders funds. In shareholders fund, share capital, reserves and surplus, money received against share warrant. Second head, application money pending allotment. Third, non-current liabilities, then current liabilities. So non-current liabilities, we have 4 heads. What is that? Long-term borrowings, deferred tax liabilities, other long-term liabilities, long-term provisions. Current liabilities, you have short-term borrowings, trade payables, other current liabilities, short-term provisions. Now coming to assets, sir. First one, non-current assets. In non-current assets, I think we have 5 items. First one, property, plant, equipment, intangible assets, capital work in progress, intangible assets under development. See, these are all fixed assets. First one, property, plant, equipment. This is tangible fixed assets. Generally, first you non-current assets means all fixed assets you have to take. So property, plant, equipment. See, there is a classification. Like how a current liabilities are classified, current assets are also classified. See here, definition of current assets. An asset is said to be current asset if it satisfies any one of the 4. Like how a liability, if it satisfies any one of the criteria, we call it as current liability. Similarly, an asset, if it satisfies any one of the following, we call it as current asset. Sir, what is that? Anything expected to be realized, expected to be received, or intended for sale, anything we are expecting to sell or consume, use in the production in the company's normal operating cycle. Suppose within the normal operating cycle, you know what is normal operating cycle, how much time it has taken to convert the raw material into cash or cash equivalent. Now within the normal operating cycle, what we are expected to realize, what we are intended for sale, what we consume, so it's a current asset. Similarly, if anything is held for the purpose of being traded, so same manner, in current liability also, anything held primarily for the purpose of trading, futures, forwards, options, same. But their liability here asset. And it is expected to be realized within 12 months after the reporting date. Same. So if you see the current liability, current asset definition, same sir, first 3. There, see, current asset, first one is what? It is expected to be settled within the normal operating cycle. Here, expected to be realized or intended for sale or consumed in the company's normal operating cycle. Suppose what you expected to realize within the normal operating cycle, anything. For example, from debtors, we are going to receive the amount. So debtor is a current asset. Intended for sale. What you are intending for sale in the normal operating cycle, finished goods. So finished goods is nothing but current assets. Consumed. For example, raw material. Raw material generally you consume within the normal operating cycle. Anything you realize, anything you are expecting to sell, anything you consume in the normal operating cycle, then it will be current asset. Not only that, anything held primarily for the purpose of being traded, that is also current asset. If it is an asset, if it results into assets. Similarly, anything expected to be realized within 12 months after the reporting date. See, from this balance sheet date till the next balance sheet date, within this time, whatever we are expecting to realize. And then cash and cash equivalents. You know, cash and cash equivalents is what? Definitely a current asset. Unless there is a restriction, it is restricted being exchanged or to be settled a liability for at least 12 months after the reporting date. Suppose if there is a restriction regarding the cash and cash equivalents that it cannot be used to settle a liability for at least 12 months, don't consider it as a part of cash and cash equivalents. So if any asset, if it satisfies any one of the four, then we call it as what? Current asset. Any other asset? Non-current asset. So that's why you see asset side, first one fixed assets, non-current assets, first one fixed assets, tangible fixed asset, because they are not satisfying any one of the criteria. They are not intended for sale in the normal course of business, normal operating cycle. They are not expected to realize. It is not expected to be held primarily for the purpose of being traded. So it is not cash and cash equivalents. So tangible fixed assets, property, plant, equipment. Next, intangible assets. And then capital work in progress, any asset under development stage. Any intangible assets under development stage, like how physical assets are under construction development stage, intangible assets are also under development stage, like R&D, research and development. Take it. Okay. Next, investments, non-current investments. Non-current investments. See, basically investments are two types: current, non-current, long-term. So long-term investments you take here. Current investments you take under current assets. Next, deferred tax assets. I told you, deferred tax liability, non-current liability. Deferred tax asset here. Okay. So as far as the investments is concerned, sir, Schedule 3 is giving some disclosure requirements. See here. See, property, plant, equipment, how they have classified. Property, plant, equipment, I told you, is part of non-current assets. Tangible fixed assets. How they will be classified? Land, building. See, land and building, two separate assets. Plant and equipment, furniture and fixtures, vehicles, office equipment, others. Like this, all tangible assets we have to divide. And also assets under lease. Suppose any asset is taken under the lease, we need to clearly specify. So this is a leased asset. Okay, and we need to prepare a reconciliation statement of the what is the gross carrying amount, net carrying amount of each class of assets in the beginning and at the end of the reporting period. Along with additions, how much is the additional purchases of that particular asset during the year, disposals, how much we sold, any acquisitions through business combinations, for example, amalgamations, mergers. Business combination means amalgamation and mergers. Through amalgamations and mergers, how much of worth of assets we acquired, amount due to change, amount of change due to revaluation, if change is 10% or more in aggregate. So if any assets are revalued, now that revalued adjustments and any other adjustments related to depreciation, impairment, losses, reversals shall be disclosed separately. Nothing, sir. In respect of each class of asset, what we need to do is, what is the gross carrying amount of the class of assets, and during there, how much additions we have done, how much disposals we made, and any additions through mergers and acquisitions, any additions through revaluation, and any other adjustments minus depreciation, impairment losses, reversal of impairment losses, and then closing net carrying amount of the assets. Like that, you need to prepare one reconciliation statement for every tangible, each class of tangible assets. Similarly, intangible assets. How intangible assets will be classified? Goodwill, brand and trademark, computer software, mastheads and publishing title. Mastheads means the title of the paper, the title of the newspaper. So that is their intangible asset. Publishing titles, any mining rights, copyrights, patents, and recipes, formulas, models, designs, prototypes, initial models, licenses. These are all what, sir? Classification of intangible assets. Like how for each class of tangible asset, PPE, you made a reconciliation statement showing the opening gross amount, opening net carrying amount, additions, disposals, acquisitions through business combinations, minus depreciations, impairment loss. Similarly, you have to do it for each class of intangible asset also. Okay. And then non-current investments as a part of non-current assets. So we have to show non-current investments as a part of non-current assets, and current investments as a part of current assets. See here, current investments. So generally investment means what, sir? See how they have classified. So non-current investments, first investment property. Remember, this is very important. Sir, if any investment is done in investment in land or building, not for the purpose of uh, occupation, business occupation, but for the purpose of earning income, rental income, that is called investment property. Investment property, if a company invested in purchase of land or building, not for the purpose of carrying business, but for the purpose of earning income, we call it as investment property, and that investment property is always a non-current investment. And similarly, any investment in equity, so company invested in equity shares of other company, investment in preference shares, investment in government or trust securities, investments in debentures and bonds, investments in mutual funds, investments in partnership firm, and any other non-current investments. All kind of investments we need to show clearly. Investment property, investment in equity, preference, government bonds, debentures, like that. And also we need to disclose the aggregate amount of quoted investments and market value thereof. What is aggregate amount of quoted investment? Quoted means listed company securities. So if any company purchased listed company securities, how much worth of listed company securities we purchased and what is the market value thereof? We need to disclose in the notes to accounts in respect of non-current investments. Similarly, aggregate amount of unquoted investments. So unquoted investments, if you purchase any unquoted investment, what is the aggregate amount of unquoted investments we need to disclose? Similarly, aggregate provision for diminution in the value of investment. For example, if there is a reduction in the value of investment, how much is the provision we created? So remember these 3 points, very important. Additional disclosures in respect of non-current investments. Aggregate amount of quoted investments and market value thereof, aggregate amount of unquoted investments, aggregate provision for diminution in the value of investments. Similarly, if you take current investment, same points will follow. Except one change. What is that? Investment property. Investment property will always comes under non-current investments. Okay, it will not come under current investments. It will not come under current investments. So as far as the asset side is concerned, non-current assets, so property, plant, equipment, intangible assets, capital work in progress, intangible assets under development, non-current investments, deferred tax assets. And this side current investments completed. Now you see long-term loans and advances. Here short-term loans and advances. Sir, what is this long-term loans and advances? Any loans and advances which is given by the company. So generally company will give loans and advances now, then it will become asset of the company. Now how Schedule 3 had made a classification in respect of long-term loans and advances. See, long-term loans and advances are classified as capital advances, any loans and advances to related parties and others. So any capital advances given by the company, it's a long-term loans and advances, and any loans and advances to related parties and other loans and advances. And see, these loans and advances, whatever given by the company, we need to classify that as 3 things. One is subclassification, secured considered good. Secured considered good means we have taken an asset on security and we have given a loans and advance. That is secured and we are considering good. That means the recovery is probable. The recovery, we are expecting the recovery. Second, unsecured but considered good. See, we have not taken any asset on security, but we are expecting that other party will make the payment. Doubtful. Doubtful means we have a doubt whether the amount will be realized or not. Similarly, if you take short-term loans and advances, see here, loans and advances to other parties. Capital advances not there. Capital advances exclusively part of long-term loans and advances and others. Any loans and advances given to related parties and others. Company given any loans and advances of short-term nature will come under current liabilities, short-term loans and advances. And so no assets, current assets as a part of short-term loans and advances. So subclassification same, secured considered good, unsecured considered good, doubtful. Okay. Next, So therefore, if you see asset side, we completed everything. Last one is any other non-current asset. You take here. Any other non-current asset, what item will come is if you remember, see, long-term trade receivables. If you remember that one, what is that? Liability side, other long-term liabilities. Which item will come? Trade payables. If a trade payable is not fit into the definition of current liability, I told you it will come in other long-term liabilities as a part of non-current liabilities. Similarly, generally trade receivables is current assets, debtors. But if it is not fitting into the definition of current asset, then you have to take it as a part of other non-current asset. So long-term trade receivables, any security deposits, others, so is part of other non-current assets. And they are subclassified as secured considered good, unsecured considered good, doubtful. The same classification we applied for long-term loans and advances, short-term loans and advances will be applied for other non-current assets also. Secured considered good, that means we have taken an asset on security and we are expecting the payment. Unsecured considered good, we have not taken any asset but we are expecting the payment from the other party. Doubtful means whether we have a doubt whether they will be given or not clearly. Okay, so that's it. So therefore we have completed non-current assets. Now coming to current assets, Nana, current investments. Okay, inventories, you know, finished goods, raw material. So how schedule 3 has classified them, I will show you. Inventories, you see, inventories are classified as raw material, WIP, work in progress, finished goods, stock in trade. If you are a trader, suppose if you are a trader, you don't have raw material, work in progress, finished goods, but you have a stock in trade. Stores and spares which we consume in the factory. Loose tools, equipment which we use in the factory for production. Remember, loose tools, stores and spares is also part of inventory, provided they have not satisfied the definition of PPE. Suppose if they satisfy the definition of PPE, then they should be taken as a part of property, plant, equipment, tangible fixed assets, non-current assets. And any goods in transit is also inventory, na? Our goods only in inventory. So goods in transit shall be disclosed under separately. Mode of valuation, how we have valued the inventory, we need to disclose. So this is inventories, regarding inventories. So current assets, inventory is also completed. And then trade receivables, you know this. Trade receivables, if exclusively, if it satisfies the definition of current asset, you take here. Otherwise, you take it as a part of non-current assets, other non-current assets. Now, cash and cash equivalents and others. So look at trade receivables. See, whatever the amount we are receiving from debtors, we need to show under trade receivables. See, trade receivables. Trade receivables, aging schedule shall be given. Important, sir. Sir, relating to trade receivables, we need to prepare aging schedule. That means the debtors outstanding for more than 6 months, we need to show separately. Others we need to show separately, generally. That is called aging schedule. And that aging schedule we need to prepare, actually. See here, outstanding for a period exceeding 6 months, we need to show separately. And like how we have prepared for long-term loans and advances, just now we have seen other non-current assets, same subclassification. Secured considered good, unsecured considered good, doubtful. And we need to prepare aging schedule. Aging schedule means outstanding for a period exceeding 6 months, we have to show separately. Sir, remember, sir, 3 things. One is long-term loans and advances, we have given. Short-term loans and advances, we have given short-term loans and advances. Other non-current assets, and the trade receivable. For all of these 4, common subclassification. What is the common subclassification? Secured, considered good. Unsecured, considered good, doubtful. Remember this. And then cash and cash equivalents. Cash and cash equivalents is always current asset. We have seen the current asset definition also. So balance with bank, checks, cash on hand, others, whatever will be shown here. So that means we have completed schedule 3 balance sheet. Can you tell me schedule 3 total balance sheet? Schedule 3 total balance sheet. First one, equity and liabilities. Equity and liabilities, we have first head shareholders funds. In shareholders fund, share capital, reserves and surplus, other application, what is it? Money received against share warrant. Second, share application money pending allotment. Third, non-current liabilities, current liabilities. Non-current liabilities, A, long-term borrowings. B, deferred tax liabilities. C, other long-term liabilities. D, long-term provisions. Next, current liabilities. Current liabilities, we have short-term borrowings. Next, what is that? Trade payables. Then other current liabilities, then short-term provisions. Now assets. Assets is non-current assets. In non-current assets, first one, property, plant, equipment. Second, intangible assets. Third, capital work in progress. Fourth, intangible assets under development. Second, non-current investments. Third, deferred tax assets. Fourth, long-term loans and advances. Fifth, other non-current assets. And then come to current assets. Current assets, you have first current investments, then trade receivables, then inventories, then cash and cash equivalents, then short-term loans and advances, and then others. So these are the things we need to disclose. Okay. So you read it once. Once you listen to it 2 or 3 times, then you just make a plain reading, then it will fit into your mind. Now, once we completed the balance sheet, sir, now we need to show the P&L account. See, P&L account, the format is very, very important, sir. First, take name of the company and then P&L account for the year ended. And P&L account, if you see, same as we need to take the current year figures as well as the previous year figures. Revenue from operations, other income, then total revenue, then expenses. Coming to expenses, first raw material consumed. How much is the worth of raw material we consumed during there? We have to take. Consumption of raw material means opening plus purchases minus closing. Then you will get consumption. Next, purchase of stock in trade. Suppose if you are a trader, how much worth of stock you purchased, you debit to P&L account. Similarly, change in inventories of finished goods, change in work in progress and stock in trade. Work in progress, stock in trade. Changes. See, if you are a manufacturer, you will have raw material, work in progress, finished goods. For raw material, you show the consumption. For finished goods, work in progress, you show the change. Because when you prepare a T-shaped trading account, opening stock debit side, closing stock credit side, you are showing. But here it is not possible. That's why the difference, the change between opening and closing directly we will present here. So first, cost of material consumed. If you are a manufacturer, then change in inventories of finished goods, then change in inventories of work in progress. If you are a trader, then you don't have this raw material, work in progress, finished goods. You have stock in trade. Therefore, there is a purchase of stock in trade and there is a change in inventories of stock in trade. So, for example, whatever the purchases of stock you made, that will be debited to P&L account. Whatever be the difference between opening and closing stock in trade, that will be shown separately. So, first, cost of material consumed. Second, change in stock in trade. Third, change in inventories of finished goods. Fourth, change in work in progress and stock in trade. Next, any employee benefits, finance cost, depreciation and amortization, any other expenses, total. Then from total revenue, first revenue side, revenue from operations, other incomes, total revenue. Expenses side, first cost of material consumed, purchase of stock in trade, change in inventories of finished goods, change in work in progress stock in trade, employee benefit expenses, finance cost, depreciation amortization, other expenses, total expenses. You will get what? Profit before exceptional extraordinary items. Profit before exceptional extraordinary items. Then you adjust exceptional item, which is defined in AS5. Then you will get profit before extraordinary items and tax. Adjust extraordinary items, you will get profit before tax. And then tax expenses, current tax, deferred tax, profit or loss for the period. And at the end you show EPS, earning per share, basic, diluted. So this is the format of P&L account. See, when you prepare P&L account, Nana, first revenue from operations, you say sale of products, sale of services. Any grants or donations received, in case of section 8 company, we have to show it as a part of sale of services. And other operating revenue, like for example, any other operating revenue got, from that you need to reduce GST. Excise duty is not the GST. Suppose if you are a finance company, interest, other finance services is your revenue from operations. Other incomes, generally interest income, dividend income, net gain or loss. Finance cost means interest, any other borrowing cost. Employee benefit means salaries and wages. Contribution to provident fund, expenses on employee stock expenses, staff welfare expenses. But this is important. Sir, any income or expenditure which exceeds 1% of the revenue from operations or 1 lakh, whichever is higher, should be need to be disclosed separately. Remember, this point may be asked in as an MCQ. As per schedule 3, any income or expenditure which exceeds how much? 1% of revenue from operations. 1% of revenue from operations or 1 lakh, whichever is higher, it should be disclosed separately. Okay. And in case of companies which is covered under 135, amount of expenditure incurred on CSR, we have to show separately. So the companies who spend amount on corporate social responsibility, they have to disclose separately how much amount they spend it. And any exceptional extraordinary items, if they have incurred, they need to show separately. And any prior period items, we need to show separately. So this is the format of P&L account. So see the format, more than sufficient. But the star mark point is there now, important. Now the last point of this chapter which is there in your material is provision for income tax, advance tax and assessed tax of prior year. See, 3 situations are there here. In respect of this one, there are 3 situations. So let us look at these 3 situations, sir. See, very simple. See, first we pay advance tax. In India, we have a system of advance tax, you know that. For example, I am taking year 23-24. See, this year, I think we pay advance tax 4 times. Every quarter, we need to pay advance tax as per the Income Tax Act. See, whenever you pay advance tax, you know you are paying tax in advance. So, this advance tax will become our asset, current asset. Advance tax asset account debit to cash or bank account. Or bank account. Suppose you paid an advance tax of 10 lakhs during the year. Sir, on what basis you pay advance tax? You make an estimation based on the previous year taxable income. You make an estimation of the current year taxable income and accordingly you estimated the tax liability, and that tax liability you will pay. So advance tax to bank 10 lakhs, 10 lakhs. Now at the end of the year, 31st March 2024, once we arrive at the total income, we will find out the total taxable income and we will determine the total tax liability. And for that, we need to create a provision. So P&L account debit to provision for tax. You know this, it is an appropriation from profits. Provision for tax. So advance tax 10 lakhs, provision for tax also 10 lakhs. Okay. And finally, the assessed tax liability is also 10 lakhs. See, once the year is completed, we know the total income, we know the all records are updated, then we will calculate the tax liability, and based on the tax liability, we created a provision in the books. Now, suppose the final liability and this one is same, there is no change. Whatever provision you created, that will be the final liability. Then, therefore, no further liability is required to be created. No further provision is required to be created. Suppose, for example, in the year 2024-25, we filed return of income. Now, once we file return of income, at the time of filing return of income, we will make a final assessment of tax. And suppose the final assessment of tax, so the assessed tax liability and provision for tax, suppose both are same, 10 lakhs, 10 lakhs only, then no problem, no further provision required. No further provision required. No need to create any further provision. Simply what we will do is, this provision for tax and advance tax we will set off. This will be squared off. Because see, already you paid tax in the form of advance at the rate of at 10 lakhs. And your tax liability is also 10 lakhs. So therefore you are not required to pay anything to the government. Therefore, this provision for tax account will be debited with advance tax. So both have been adjusted. That's it. Over. This is case 1. So first you pay advance tax, at the end you determine the provision for tax. Now once we decide the final tax liability, and if the final and provision both are same, then no further provision is required. Simply square of advance tax, provision for tax. Sometimes what happens is, suppose here if advance tax paid is more than the provision required, sometimes happens because we make a more estimation. In such a situation, the balance amount will be refunded back. For example, here you paid advance tax of, for example, 11 lakh rupees and provision for tax is 10 lakh rupees. What you do, tell me? So provision for tax account debit 10 lakhs and advance tax 11 lakhs. Suppose you paid 1 lakh extra. This 1 lakh will be your income tax refund. Similarly, you may pay less amount also. For example, provision for tax 10 lakhs, but advance tax only 9 lakhs. So remaining 1 lakh is income tax payable. So always compare your what is the advance tax I paid, what will be my final tax liability. My final tax liability and provision both are same here. So therefore my provision and advance tax I compared. If provision and advance tax same, square it off. Suppose advance tax is more than provision, the balance amount you will get refunded. Otherwise it is income tax payable. Now see, sometimes what happens is, this is case number 2. Suppose your final assessed tax liability may be greater than provision for tax. That means whatever the provision you created at the end of the year, so beyond that your final tax liability arrived. For example, you created a provision for 10 lakhs but final tax liability 15 lakhs possible. So therefore first you need to create a provision for extra 5 lakhs. Create further provision for 5 lakhs. What is the entry for creation of provision? Simple. P&L account debit to provision for tax. P&L to provision for tax. 5 lakhs, 5 lakhs. Once you brought the provision to 15 lakhs, then your assessed tax liability provision both are same. Then here onwards same. Take the advance tax, square of advance tax with provision for tax. Suppose if advance tax is 15 lakhs, your provision and assessed tax liability also 15 lakhs, squared off. Suppose if advance tax there is a shortage, now you pay the balance amount. Suppose if advance tax is more, you will get the refund. Simple. See, if you pay more than what is required to be paid, you will get refund here. You pay less than what is required to be pay, you need to pay. Common sense, na? But only thing is that, see, at the end of the year, we create a provision. That provision may not be final tax liability. That is the point. Your final tax liability may be more than the provision. So when you create a provision which is required, which is less than what is the final tax liability, then you create a further provision. Sir, suppose for example, you create a provision which is more than the final tax liability. For example, we created a provision for, suppose assessed tax liability is less than provision for tax. For example, you created a provision for 10 lakhs, but your final tax liability is only 9 lakhs. That means you paid more. So therefore, extra provision has to be reversed. So excess provision will be reversed. Excess provision will be reversed. How much here? 1 lakh provision will be reversed. What is the entry? Provision for tax account debtor to P&L account. And after that, adjust with advance tax. That is same amount. So this is the concept, sir. You see here 3 situations given. When assessed tax liability is equal to provision for tax. Simple advance tax paid, assessed tax liability, if both are same, square off. Sometimes advance tax paid is less than assessed tax liability. Then whatever the income tax difference is, that is income tax payable. If advance tax is paid more than assessed tax liability, then first set off the balance, you will get the refund. Similarly, when assessed tax liability is greater than provision, you need to create a further provision, because provision for tax 10, but you assessed tax liability is 12, for example. Now you need to create a provision for another 2 lakhs. And adjustment with advance tax is same, what I told in the first case. Suppose when final assessed tax liability is less than provision for income tax. For example, assessed tax liability 10 lakhs, you create a provision for 12 lakhs. So extra 2 lakhs will be reversed. See, always remember, Nana, provision for income tax has to be brought to the position of assessed tax liability. Once it is brought, then you can adjust with the advance tax. Okay. So this is this chapter. I have revised the entire chapter, but you have to read it once and try to solve the questions. Thank you. Now cash flow statement. So let us see this chapter, cash flow statement. See, first of all, what is cash flow statement? See, cash flow statement is one of the component in financial statements of a company. We have seen the meaning of financial statements. Their cash flow statement is also part of financial statements. Basically, cash flow statement is a statement showing inflows and outflows of cash of a particular organization during a particular accounting period. So cash is one of the important items. So we need to make analysis of the cash. For that, we need to prepare one statement called cash flow statement, which shows companies' inflows and outflows. Inflows and outflows of cash and cash equivalents. Here cash and cash equivalents during a particular accounting period. So for every year we need to prepare this cash flow statement, which will consisting of inflows of cash as well as outflows of cash. What is the cash coming in, what is the cash going out, and it shows the impact of operating, financing and investing activities on cash. So according to accounting standard 3, see, there is an exclusive standard for cash flow statements, sir, accounting standard 3, which has classified the cash activities into 3 types: operating, financing and investing activities. We are going to discuss what are those. Now this cash flow statement will show the impact of these items on the overall cash of the organization, and it provides relevant information in assessing company's liquidity, quality of earnings and solvency. So whether a company has sufficient liquidity, what is the quality of earnings, and whether the company is solvent or insolvent. Now all these questions will be answered by cash flow statement. Whether company is having proper liquidity, and what about the quality of earnings. See, this is very, very important, quality of earnings. For example, my opening cash and cash equivalents 25 lakhs, closing cash and cash equivalents 50 lakhs. So by looking at this, what's your judgment? Can you able to judge? So my cash and cash equivalents are increased by 25 lakhs. Now by prima facie, by looking at it, we can't judge it. But suppose if I give you the reasons for the increase, for example, we have taken a bank loan 25 lakhs. That's why our closing cash balance has become 50. Now the quality of earnings, whether the increase in cash and cash equivalents during the period, is it because of operations, is it because of financing activities, or is it because of investing activities? What is the reason? So that we will know by looking at the cash flow statement. So basically what is cash flow statement, sir? Cash flow statement is a statement showing inflows and outflows of cash and cash equivalents of a particular organization during a particular year. Now this cash flow statement shows the impact of operating, financing and investing activities on cash. And it will provide relevant information about the company's liquidity and then quality of earnings and then solvency of the organization. Now, applicability. Sir, is cash flow statement is mandatory for every organization? No. See, generally cash flow statement is only for big enterprises, that is the level 1 enterprise, other than small and medium size enterprises. Suppose in case of a small and medium size enterprises, cash flow statement is not mandatory. If they want to prepare, they can prepare. So one person company and a small company, dormant company and a private startup company. So these are the entities which are not mandatorily required to prepare cash flow statement. Okay. Next, the most important thing is, see, in cash flow statement, there are certain terms which we use quite frequently. For example, cash and cash equivalents I will use. What is cash? See, accounting standard 3 says cash includes cash in hand. So maybe in the form of coins, money orders, checks, demand drafts, whatever. And also demand deposits with banks. So I mean cash in savings account, current account. Next, amount which can be withdrawn from bank any point of time without any restrictions or penalty. See, without any restriction or penalty. So that is called demand deposits with bank. See, even demand deposits, whatever we made with the bank is also part of cash only. Please understand. So what is cash, sir? Cash in hand, demand deposits with bank. What is demand deposits, sir? Whatever the amount we deposited in the bank, which we can withdraw any point of time without giving any prior notice and without any restriction or penalty. Whenever we want, we can withdraw it. That is called cash. And another important term we use in cash flow statement is cash equivalents. Sir, what is cash equivalent? See, generally they use the word cash and cash equivalents. What is cash equivalent? See, cash equivalents are short-term, highly liquid investments. See, these are short-term. Here, short-term means 3 months or less. Highly liquid investments. That means which can be converted into cash any point of time. That are readily convertible into cash and which are subject to an insignificant risk of change in value. That means the principal amount is not in danger. So when you make an investment, your principal should be safe. There are no significant risk of changes in value. Insignificant, that means no, not risky, no significant risk of change in value. For example, investment in equity shares. Tell me, when you invest in equity shares, is principal is having significant risk or insignificant risk? Significant risk. Therefore, investment in equity shares will not become cash equivalent. Of course, it may be for short term, 3 months or less. Highly liquid. Whenever I want, I can sell the shares. I can readily convertible them into cash. But is it subject to an insignificant risk of changes in value? No, it is subject to significant risk of changes in value. Your principal should not be in danger. Suppose if the principal is in danger, then it will not fit into the definition of cash equivalents. Then we don't consider it as part of cash equivalents. For example, the treasury bills. Treasury bills is always what? Cash equivalents, because basically they are short term, highly liquid, readily convertible into cash and subject to insignificant risk of changes in value. Similarly, short term government bonds, like for example, maturity period should be less than or equal to 3 months. Similarly, marketable securities like stocks, bonds, of course, all the conditions has to be satisfied. Prima facie, these are all cash equivalents only. Money market holdings like options, futures, hedges, hedge funds, they can also be considered as a part of cash equivalents, but above conditions must be satisfied. So therefore, tell me, what is cash? Cash in hand, demand deposits with bank. What is demand deposits with bank? Which can be withdrawn any point of time without any payment restriction or penalty, payment of penalty. And next, what is cash equivalent? Short term highly liquid investments. Short term means 3 months or less, and which readily convertible into cash, which are subject to insignificant risk of changes in value. And now, preparation of cash flow statement. Sir, the main object of this standard is, or this chapter is, to make sure that you learn how to prepare cash flow statement. How cash flow statement will be prepared? See, first of all, accounting standard 3 is saying that you need to divide the cash activities into 3 types. You need to divide the cash activities, the activities which involve cash, either inflow or outflow, has to be grouped into 3 categories. So, what are those? Cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. First, we should understand what is the nature of these activities. Which activities involving cash comes under operating, comes under investing, comes under financing. First, we should be able to judge this. Now, we will first try to understand these 3 categories. Then, in the form of statement, we will group all these items. First, cash flow from operating activities, we will write inflows and outflows, and result we will take. Next, cash flow from investing activities, cash flow from financing activities, like that we will take. So various activities of an enterprise resulting into cash flows. See, only items which resulting into cash flows, either inflow or outflow, doesn't matter. Receipt or payment. See, when you receive the cash, there is a inflow. When you make the payment, outflow, which are subject matter of a cash flow statement as per AS3. These activities are classified into 3 categories. So remember, as per accounting standard 3, the items involving cash are divided into 3 categories. What are those? Operating, investing, financing. Now, in cash flow statement, we need to show separately these cash flows generated by these activities. So one by one we need to present. Now first, operating activities. Listen to me carefully. Sir, what is operating activity? See, standard says these are principal revenue generating activities of the enterprise. The key word here is principal revenue generating activity. So which activities you do as your main activity, principal activity to generate revenue. So that we will consider as a part of operating activity. So principal revenue generating activities of the enterprise, one thing, and other activities that are not investing or financing. That means even residual items will also come here. Residuary items, the items mean, which are not investing and financing, also throw them into the operating activities. So therefore, when you are unable to classify any item prima facie under operating, investing, financing, then come to operating and show them under the head operating. So for this, you need to understand what is comes under investing and financing. Once you know what comes in investing, financing, definitely the remaining items has to be classified under operating activity. So what is operating activity? These are principal revenue generating activities of the enterprise. Principal revenue generating activities. What is your main activities through which you are generating the revenue? Principal word is key here. Like for example, you are a cement manufacturer. So manufacturing cement and selling it is your principal revenue generating activity. Suppose I am providing financial services. So financial services. So I receive commission. So commission is a principal. Providing financial services is my principal revenue generating activity. So principal revenue generating activity. From that, what are the inflows and outflows? Classify them under operating activity. Not only that, any activity, if it is not fit into the investing and financing, and that is residual items, will be shown under the head operating activity. Next, investing activity. Okay, sir, what is investing activity? Simple. These are acquisition and disposal of long-term assets, that means fixed assets, and other investments not included in cash equivalents. See, these are acquisition, purchase, nothing but acquisition and disposal, that means sale of what? Long-term assets. Sir, what is long-term assets? Tangible fixed assets, intangible fixed assets. Those are. Sir, That means purchasing of fixed asset, sell of fixed asset is investing activity. For example, an organization purchased the land, investing activity. Sold the land, investing activity. Purchase the plant and machinery, investing activity. Sell the plant and machinery, investing activity. Purchase the vehicle, fixed asset, long-term fixed assets, investing activity. Sale of goods, goods is not a long-term asset, therefore sale of goods is not investing activity. It will comes under operating activity, principal revenue generating activity. So from the acquisition and disposal of long-term assets, whatever the cash inflows and outflows are generating, we will show under the head investing activity. Not only that, other investments means already we defined under cash equivalents as short term. What is cash equivalent? Short term highly liquid investment, readily convertible into cash, which are subject to insignificant risk of change in value. We will classify them as cash equivalents. So those investments which are already classified under cash equivalents, don't consider them under investing activity. That's why they said other investments not included in cash equivalents. So when you make an investment, if that investment is cash equivalent, we will show it as a part of cash and cash equivalent separately. We don't show it as a part of investing activities. So what is investing activities, sir? Acquisition and disposal of long-term assets and other investments not classified under cash equivalents. For example, investment in equity shares. Investment in equity shares is not a cash equivalent because which is subject to significant risk of change in value. Obviously, investment in equity shares will come under investing activity. Other investments not classified in cash equivalents. Not only investment in equity share, any investment, if it is not fit into the definition of cash equivalent, obviously you have to consider under investing activity. So can you tell me some examples of investing activity? Yes, purchase of land and building, purchase of plant and machinery, sale of land and building, sale of plant and machinery, purchase of vehicles, sale of vehicles. So investment in equity shares, okay, investment in debentures. If it is not fit into that cash equivalents, consider here. Okay. Now, sir, when you make an investment, sir, you receive income, sir. That income is also investing activity. For example, we invested in debentures. From the debentures, we received interest. So, when you classify investment in debentures under investing activity, the interest from the debentures also need to be classified under investing activity. Similarly, for example, you have invested in equity shares. Investment in equity shares is investing activity. From that investment, you received a dividend. So, that dividend is also investing activity. So, when you classify a particular transaction, particular item under a specific head, the corresponding related items are also classified under that head only. Next, financing activity. Sir, what is financing activity? See, the activities which result in the change in the size and composition of owner's equity, including preference share capital and borrowings of the enterprise. So, any activity that activity must result in change. Sir, what it will change, sir? The size. Size means amount. And composition. Size and composition of what? Owner's equity. What is the owner's equity share? Share capital. Including preference share capital. And borrowings of the enterprise. See, that means any activity relating to owner's equity, capital. Any activity relating to borrowings comes under financing activity. See, investing activity means our funds, we are investing outside. Our funds are going out. We are making investment. Investing. Now, the investing and sale of investments and the related activities relating to investing comes under investing activity. See, generally financing means we are getting funds from outside by issuing shares, equity shares, preference shares, by taking borrowings, financing activity. So remember that. So what is financing activity? Any activity that results in change in the size and composition of owner's equity, including preference share capital and borrowings of the enterprise. For example, company taken a bank loan, financing activity. That bank loan repaid, financing activity. On that bank loan, company paid interest, financing activity. Financing activity. For example, company given a loan to subsidiary, investing activity. From that loan received interest, investing activity. That loan is repaid by other party, investing activity. So, suppose a company issued equity shares, issued equity shares, financing activity. Sir, a company invested in equity shares of other enterprises, investing activity. See, if we purchase equity shares of other company, it is investing. Our funds is going out. Suppose we issued equity shares, through that we got the capital. We raised the capital. That is financing activity. So therefore, any activity relating to capital and borrowings of the enterprise is financing activity. So if any activity relating to cash, if it is not fitting into investment and financing, then you have to show under the head operating activity. So can you tell me what items will come like that? For example, penalty paid under violation of law. For violation of law, we paid some penalty. Tell me, where will you classify? Is it investing activity? Penalty paid for violation of law. Is it financing activity? Like anything which will change the capital and borrowings of the enterprise? No. Is it relating to principal revenue generating activities? No. So therefore, it will not be fit into investing. It is not fit into financing. And in operating, the prima facie definition is, principal revenue generating activity. Like that also you can't classify. Then residuary item, it will also comes under operating activities only. So like this, first of all, what you need to do is, you need to classify the cash activities into three types. First of all, you should able to identify, this is operating, investing, financing. So in summary, what I can say, Nana, see, if any activity relating to your operations, operating, if activity relating to purchase and sale of assets, investing, if activity relating to taking borrowings, repaying borrowings, taking capital, repaying capital, financing activity. So when we got funds from outside, financing. When we invest our funds, investing activity. So like that you have to think. And once you classify any particular item under particular head, all corresponding related items relating to that will also comes under that head only. Okay. So now see here. So we have to classify them like this. Like, see, there are some illustrations in the study material you have to read. So for example, see, receipt from sale of furniture. Tell me, furniture is what? Asset, fixed asset. So sale of furniture, investing activity. 1 minute. Classify the following cash receipts and payments of furniture company. So if you are a furniture company, sale of furniture is what? Operating. So you have to be very careful. Generally, for other enterprises, furniture is fixed asset. But for a furniture dealer, furniture company, furniture is goods na. So sale of goods is principal revenue generating activity, operating. And purchase of furniture from various suppliers, operating. Wages paid, operating. Advertisement expenses paid, operating. Because these are all necessary for generating, do the principal activity. To achieve your main activity, so you have to incur all these expenses. Credit sale of furniture. No, it will not come in cash flow statement because we are learning cash flow statement. The cash must be involved. So if there is no cash flow, either inflow or outflow, then it will not be applicable. It will not come under cash flow statement. Next, miscellaneous charges received from customers for repairs of furniture. If you are a furniture dealer, you do repairs for the furniture. For that you receive some amount, that is also operating. Loss due to decrease in market value of the closing stock of furniture. No. Losses, provisions, they will not result in any cash inflow or outflow. Don't consider them. Payment to suppliers of furniture. For example, we purchase the furniture from suppliers. For them, we make the payment. It is part of operations, operating activity. Depreciation, sir. Depreciation on furniture. Can it be considered? Depreciation for furniture of the sales showrooms. No, depreciation does not involve any cash. So it will not come in cash flow statement. And similarly, profit on sale of equipment in exchange of new equipment. For example, there is old equipment is there. We exchange that old one with the new one. Now, exchange results does not result in cash flow. Therefore, it will not be part of cash flow statement. Any advance received from customers? See, sometimes customer will pay advance, right? It is part of operations, operating activity. GST paid, taxes paid. Sir, generally taxes paid is which activity? Operating activity. Of course, if you are able to identify the tax with the particular activity, classify under particular activity. For example, you are making furniture sale. You collected GST from the customer. Now that GST you need to pay to the government. So GST paid is also part of your operations. Now equity dividend paid, important sir. Dividend paid, to whom you pay dividend? To your shareholders. So when you raise share capital, you show under the financing activities now. So therefore when you pay dividend on that share capital, then also it will be shown as a part of financing activity. Important. See, when we invest in other companies, that is investing. Suppose we invested in equity shares of other company, so that is investing activity. From that equity shares we receive dividend. Okay, from that equity shares we receive dividend. That is what investing activity. Suppose when we issue equity shares and we pay dividend on that equity shares to our equity shareholders, that is financing activity. So there is a difference. Students are unable to understand. Very simple. When you receive dividend, investing. When you pay dividend, financing, because you pay dividend to your shareholders. So rising share capital is financing activity. So paying dividend to them is also financing activity. So like that, there are certain examples you see. Okay. Next, some special items are there in cash flow statement, sir. First one, foreign currency cash flows. See, generally, Indian companies or Indian business enterprises will enter transactions in foreign currency. See, whenever they enter any transaction in foreign currency, will that also be considered as a part of cash flow statement? Yes. Cash involved or not? If it is involved, we have to consider. Sir, where we need to classify operating, financing, investing, whatever could be based on the definition. Just now we have seen. It is operating, investing, financing. On the respective activity, we have to consider. But see, when you enter any foreign currency transactions, sometimes there will be exchange gains or losses because of the foreign exchange fluctuations. Whether those fluctuations, the gains and losses also to be considered. So the answer is unrealized gains, ignore, because they does not result in any cash. So realized, if it is involved cash, then consider them under the respective activity. See here, cash flows arising from transactions in foreign currency shall be recorded in entity's functional currency by applying to the foreign currency amount exchange rate between the functional currency and the foreign currency at the date of the cash flow. That means we need to convert into Indian rupees. Functional currency means Indian rupees. At a rate that approximates the actual rate may be used if the result is substantially the same as could arise if the rates at the dates of the cash flows were issued. So which rate you need to utilize? For that AS 11 is there. Generally on the date of cash flow statement, whatever you are preparing, the date on the date, whatever the rate is there, take that rate. And the effect of changes in exchange rates on cash and cash equivalents held in foreign currency shall be reported as a separate part of the reconciliation of the changes in cash and cash equivalents during the period. For example, see sir, on 1/1/2022, an Indian company bought goods from USA for $1,000 to be sold within India. Okay, we purchased goods from USA. What is the exchange rate? 76. On 31st March 2022, the exchange rate moved to 78. How will you report the above in cash flow statement? Suppose see, what at the time of purchase, what is the value? 76 into $1,000. So 76,000 in Indian rupees on 1/1/2022. Now at the end of the year, the payables will be recorded at 78 because AS 11 says monetary item, creditors. So you need to value them at closing rate. Closing rate is 78. At the time of purchase, it is 76 only. Now it becomes 78. That means how much is the increase, sir? 2000. Now tell me, is this 2000 increase, is it realized or unrealized? Unrealized loss, because we are not making the settlement. So under indirect method of determining the operating cash flow, this will be reported as follows. So the profit minus 2000, add increase in payables 2000. So the net impact will be nil. See, what is this, sir? See, we prepare cash flow statement. So there are two methods to arrive the operating activities, direct and indirect method. In indirect method, what we do is we'll start with net profit. So already this 2000 is included, excluded while arriving the net profit, right? So therefore, so if it is already decreased, no need to decrease again. If it is not decreased, then minus 2000. And creditors are increased, na? Opening creditors and closing creditors, there is an increase in creditors of 2000. And therefore net impact will be nil. So this you will understand better when you cover indirect method. So in indirect method, I will tell. Next, interest and dividend is one of the important things, sir. Sir, Interest and dividend. Generally, interest we will receive on investment, right? So when you receive interest, investing activity. But for a financing enterprise whose object is giving loans and advances, whose object is making investments, for them interest is what? Operating activity, na? Dividend. For example, see, generally dividend received is investing activity. But for a company whose main object is making investment, for them receiving dividend from the investing and the company in which they made the investment, that is their operating activity. So therefore, depending upon the nature of the enterprise, the classification will change. For example, for a bank, interest received from customers is which activity? Operating activity. But for other enterprise, other than bank, for example, they given loan, on that loan they received interest. So that is their, investing activity. So interest and dividend, important, sir. So see, if you are a financing enterprise, if you are a financing entity, or if you are a non-financing entity. Suppose if you are a financing entity, you are a financial enterprise. You are a financial enterprise, interest received or interest paid. Generally, it is operating activity for you. But for these people, non-financing enterprise, if they receive interest, investing activity. If they pay interest, generally, which activity? Financing activity. Why they will pay interest, sir? When they take in a loan. So loan is which activity, sir? Borrowings are which activity, sir? Financing. So loan repayment is also financing. Similarly, dividend received, paid. Sir, suppose dividend received by financing enterprise. So operating activity. For non-financing entity, if they receive dividend, it is investing activity. Okay. For dividend paid, see, this is very, very important. Dividend paid. Sir, whether you are a financing entity or non-financing entity, when you pay dividend, it will be your which activity? Financing activity. Payment of dividend to our shareholders. Suppose the bank is there. Bank paid dividend to its shareholders. Financing activity, na? Because any activity results in change in share cap, change in owner's equity, including borrowings. Now that means unrelated activities. So when you issue shares, which activity? Financing activity. On that shares you pay dividend, financing activity. So you have to be very, very careful. This table is very, very important. So remember, as far as this dividend paid is concerned, whether you are a financing entity or non-financing entity, doesn't matter. For both, it is financing activity. See here, X Limited provides the following information of cash inflows and outflows. See, dividend paid to equity and preference shareholders, 50,000. So dividend paid given. So if you are a financing institution or if you are a manufacturing entity, tell me, if you are a financing institution, you paid dividend to your shareholders, which activity? Financing activity. Suppose if you are a manufacturing entity, no difference. It is also financing activity for them. So paying dividend to your shareholders is always a financing activity. Look at here, dividend paid. So if you are a financing entity or a manufacturing entity, in both cases it is financing entity. Think about it, because we pay dividend to our shareholders. So when you pay dividend to shareholders on share capital, when you got the capital, you are treating as financing activity. So related dividend paid is also financing activity. For example, interest paid. Tell me, interest paid. If you are a financing institution, interest paid is part of your operating activity. This is operating activity. But for a non-financing enterprise, interest paid means on borrowing. So it is a financing activity for them. See, look at it. Interest paid. Operating for financing enterprise. For non-financing enterprise, manufacturing, it is financing activity. Similarly, interest received on loan, 20,000. If you receive any interest, tell me what happens. So if you are a financing enterprise, operating activity. If you are a non-financing enterprise, you receive interest. So it is investing activity for you. Making investment, investing activity. Interest income from that investment, investing activity. Similarly, dividend received from Y Limited. Same. If you are a financing enterprise, operating activity. If you are a non-financing enterprise, investing activity. So you have to be very careful. Is I a financing enterprise, non-financing enterprise? Depending on that, you have to take a decision. So if you are a financing enterprise, okay, dividend received in interest received paid is always operating. If you are a non-financing enterprise, interest paid, okay, investing activity, interest received investing activity, sorry, interest received investing activity, interest paid financing activity, because you pay interest on borrowings, okay. And for one thing is common, what is that? Dividend paid. If you pay dividend, whether you are a financing entity or non-financing entity, in both the cases it is which activity? Financing activity only. Financing activity only. Next, what is the treatment of taxes on income? Suppose we pay tax now. See, generally, if you see any tax expenses in the cash flow statement in the question, classify under which activity? Operating activity. Suppose if you can able to identify the tax with particular activity, classify under that activity only. For example, you are selling the asset. Sale of fixed asset is which activity? Investing activity. On that sale of fixed asset, you paid capital gain tax. That is also comes under investing activity. For example, you received interest. Now, other party has deducted the tax, TDS. Interest received is which activity? Investing activity. Whatever the tax you paid, TDS, that is also investing activity. Okay, so generally cash flow arising from taxes income shall be separately disclosed and shall be classified as cash flow from which activities? Operate, generally operating, unless they can specifically identified with financing and investing enterprise. See here, A Limited paid advance tax amounting to 3,65,000, out of which 15,000 is relating to what? Short-term capital gain on sale of securities. Short-term capital gain. How A Limited will report the payment of advance tax in its cash flow statement? Sir, tell me, sir, what is the total advance tax we paid? 3,65,000. Out of 3,65,000, 3,50,000, I mean 15,000 we paid for what? Short-term capital gain. So therefore, short-term capital gain means we invested in an asset. So investing activity, that asset you sold. So you got a capital gain. On that capital gain, you paid a tax. So making investment in an asset is investing activity. Okay, and you sell that investment, that is also investing activity. You paid tax on that, that is also investing activity. So therefore, out of 3,65,000, 15,000 tax, it is which activity? Tax on investing activity. So therefore, this is investing activity. And what about remaining 3,50,000? Operating activity. So you see here, thus in this case 3,50,000 would be treated as operating cash outflow, while 15,000 could be treated as investing cash flow. Okay, and you make any investment in subsidiaries, associates, joint ventures. We purchase shares of a company, subsidiary company, associate, joint venture. These are all investing activities. Generally, these are investments, na? Parent company purchasing shares in subsidiary company, parent company making investment in associates, and two companies together forming a joint venture and making investments. These are all investing activities. Unless otherwise provides, these are all investing activities. So making investment in subsidiaries, joint ventures, associates, and what is that? Sale of those investments, the sale of those subsidiaries, associate, joint ventures. So both will comes under which activities? Investing activity. And remember, Nana, non-cash transactions which does not involve any cash is not part of cash flow statement. Like for example, acquisition of assets by assuming directly related liabilities, or acquisition by an entity by means of equity issue. For example, we purchased a business by issuing equity shares, amalgamation, merger. So conversion of debt into equity. For example, debentures converted into shares. Is it comes in cash flow statement? No, no cash involved. So for example, I will purchase an asset by issuing equity shares. It does not involve any cash. So for example, I need to pay some amount to you. I will give my asset. That means settlement of liability other than by cash. That is also not part of cash flow statement. So therefore, I have completed the first part of this cash flow statement. So I explained you what is cash flow statement and for which companies it is applicable, and what are the important terms used in cash flow statement, and how the cash activities, operating, investing, financing we discussed, and then special items also we discussed. Now the most important part is how to prepare cash flow statement. Listen to me carefully. Sir, you have learned that cash flow statement is having three activities. One is cash flows from operating activities. This is one head. Next, cash flows from investing activity. Then cash flows from financing activity. So operating activity, investing activity, financing activity. So first you need to group the cash activities into these three categories. Inflows or outflows, both one by one you will write. You will get one common one result. Inflows minus outflows. You will get one result. For example, net cash flows from operating activities came 1 lakh after adjusting inflows and outflows. Now cash flows from operating activities over. Next, investing activities. After adjusting, we got minus 50,000 because the outflows may be more than inflows. Cash flow from financing activities, for example, 1,50,000 negative came, or maybe see here 70,000 came. So therefore, what we need to do is finally find out the result. So 1 lakh inflow minus 50,000 plus 70,000. So it will be 1,20,000. So what is this 1,20,000, sir? Net cash flows. Net cash generated during the financial year. Net cash and cash equivalents generated during the year. Now for this you need to add opening cash and cash equivalents. For example, opening cash and cash equivalent is 30,000 you added. Then you should get closing cash and cash equivalents. So therefore, whether cash flow statement you have done correctly or not, easily you will know. How, sir? See, during the year, whatever be the increase or decrease in cash and cash equivalents, for that if you add opening cash and cash equivalents, the amount should be closing cash and cash equivalents. So opening cash and cash equivalents, closing cash and cash equivalents, both will be given in the question itself. So therefore, during the year, what is the ultimate net result? So what changes happened in the cash and cash equivalents? For that, if you add opening, your answer should be closing. One item will come now that you compared with closing cash and cash equivalents. If they are same, your answer is correct mostly. Otherwise, wrong. For example, 1,20,000, 30, 1,50,000. Okay, but closing cash balance is for example 2 lakhs. But you got only 1,50,000. That means somewhere there is a mistake. Some item you might not have been considered here, or there may be some calculation mistakes. So this is how you will present the cash flow statement. So tell me how cash flow statement will be presented. First, cash flow from operating activity. Next, cash flow from investing activity. Next, cash flow from financing activity. And each head you classify the items. And then you will get net cash and cash equivalents during the period. For that, you add opening cash and cash equivalents. Then you will get what? Closing cash and cash equivalents. So whatever be the net increase or decrease in cash and cash equivalents during there. Here in this case, the net increase, this is positive. Net increase in cash and cash equivalents. How much? 1,20,000. For that, you add opening cash and cash equivalents. You will get closing cash and cash equivalents. Now, this is the basic way how we are going to prepare the cash flow statement. But the problem is, see here, these cash flows from operating activities, okay, can be prepared in two ways. One is direct method. Another one could be indirect method. Direct method, indirect method. Sir, what is this, sir? The direct method means inflows and outflows we will take relating to operating activities. We will write, we will get the figure, net result from operating activities. Direct method. That means the question is given in such a manner that you can able to identify the inflows and outflows relating to operating activities, or the information is given in such a manner that based on that information you can easily ascertain the cash inflows and outflows relating to operating activities. Then that method is called direct method. Sometimes he will give information in such a manner that so you are unable to identify the inflows and outflows relating to operating activities directly. Then in such a situation, we should use which method? Indirect method. So, sir, out of these two methods, which method is more accurate? Indirect method is more accurate, not direct method. So, Why indirect method is more accurate, sir? See, because an enterprise involves number of cash activities. Na? Take for example big companies like Reliance. They will do number of transactions involving cash and cash equivalents, right? So is it possible to identify each and every item? This is inflow, this is outflow, this is inflow, this is outflow. Is it possible? No. Then what is the easiest way to ascertain the cash flow from operating activities? Simple. Take the net profit. While arriving the net profit, what are all the non-operating items other than operating adjusted? So you cancel them, then you will get cash flow from operating activities. I will tell you in indirect method. Wait. Okay. So this is how we will prepare cash flow statement. So to prepare cash flow statement, there are what? Two methods are there. One is direct method, another one is indirect method. Direct method and indirect method. So in direct method, very easy, sir. You can easily take each and everything. See here, the format I will show you. See here. This is how you need to prepare cash flow statement under direct method. Cash flow statement of company name, for example, ABC Limited, for the period ended on 31st March 2024. 31st March 2024. First, cash flow from operating activities. Then you will get net cash flows from operating activities. Then cash flow from investing activities. So you will get net cash flow from investing activities. You will get cash flow from financing activities. And you will get net cash flow from financing activities. And finally, operating, investing, financing. What is the net increase or decrease? For that, you add opening cash and cash equivalents. Then you will get closing cash and cash equivalents. So it is like a cash book, sir. See, when we prepare a cash book or cash account, what happens, sir? Tell me. First, you will take opening balance. Opening balance you take, and you add all receipts. Now, all receipts will be debited. All payments will be created, right? Payments will be created, and you will get what? Closing balance. Now, so this is what exactly we are doing. But these receipts and payments, we are classifying them under three separate heads, and we are considering the result of each and every item, each and every head. Why, sir? Because we want to analyze the cash to know the quality of earnings, to ensure whether there is a sufficient liquidity or not. So I told you there are so many reasons for preparation of cash flow statement. Now this opening balance, closing balance, they will come at the end. So beginning, what is the cash and cash equivalents you add back? Closing cash and cash equivalents you will automatically arrive. So if we add the net increase or decrease in cash and cash equivalents with opening balance. Okay. So this is direct method. So what is indirect method? I will tell you. Wait. So in direct method, sir, the answers are very easy, sir. So you can easily get through direct method. The most important thing is indirect method. So what is indirect method? How cash flow statement will be prepared under indirect method? We will discuss. Hello, my dear students. Welcome you all. We are discussing cash flow statement chapter. In cash flow statement, in the previous class, we have completed some questions, basic questions. Now, as I discussed in the last class, there are two ways we can prepare cash flow statement. We have discussed the format of cash flow statement also. In that format, if you remember correctly, first we need to show cash flow from operating activities. These cash flow from operating activities, basically, either we can prepare on direct method directly, or there is an indirect method also. Now today I am going to give you an idea about indirect method, which is very, very important. See, what is this indirect method? See, cash flow from operating activities, how we are going to ascertain it? We know that operating activities are principal revenue producing activities. So relating to principal revenue generating activities, what are all the inflows and outflows we will consider under cash flow from operating activities, right? So in indirect method, what we do is, by using the information which is contained in the P&L account and balance sheet, we will try to ascertain cash flow from operating activity. What information, sir? The information which is contained in the profit and loss account and balance sheet. By using that information, we will prepare cash flow from operating activity. See, basically how cash flow statement is prepared by identifying all receipts and payments. But here we don't go to the direct receipts and payments because the information may not be available. That's why it is indirect method. So how to find out cash flow from operating activities indirectly? What is the base? See, suppose the starting point is always the net profit or loss for the period before taxes. So first take P&L account. In that P&L account, you have incomes and minus expenses, you will have net profit. Take that net profit as the starting point. And this net profit what you are taking is from P&L account, and P&L account is prepared on accrual basis, and P&L account consisting of all items like operating activities, investing activities, financing activities. So all these things are there in P&L account, but we want cash flow from operating activities. So if you take net profit before tax is the starting point for preparation of cash flow from operating activities under indirect method. Now to this net profit before tax, we will make adjustments. So what adjustments if I do to this net profit before tax, then I will arrive at cash flow from operating activities. So that's the idea. So we know we have prepared P&L account for the current year. Now that P&L account is prepared on accrual basis. Now in this P&L account, I will take net profit before tax, and to this net profit before tax, I will make certain adjustments. So that's why what they're saying here, see here, under this method, indirect method we are discussing. Cash flow from operating activities is ascertained by employing information contained in the P&L account and balance sheet. So whatever the information which is there in the P&L account and balance sheet, that is the base for ascertaining cash flow from operating activity. Indirect method of ascertaining cash flow from operating activities begins with the amount of net profit or loss before. So always the starting point is what, sir? Net profit before tax. Net profit before tax. Profit before tax is the starting point. Remember, net profit before tax. And once you got this net profit before tax, this net profit before tax is adjustment of incomes and expenses of the current year. And I want cash flow from operating activities. See here. See here, the point to understand is net profit before tax. This is what I know, but I want cash flows from operating activities. Now, how I am going to arrive cash flow from operating activities? What adjustments if I do to this net profit, I am going to arrive at cash flow from operating activities. That is indirect method. And for that, what adjustments I need to do? For that, you need to understand the nature of P&L account, because this net profit came from P&L account, and you should understand P&L account is prepared on accrual basis. What is the importance of accrual? That means all incomes and expenses we recognized in P&L account, whether it is actually paid or not, whether actually received or not. But in cash flow statement, we consider all incomes and expenses only when we pay, only when we receive. So that's the fundamental difference. So there is a fundamental difference between P&L account and cash flow statement. Cash flow statement is prepared on cash basis. Only when you receive, only when you pay, it will form part of cash flow statement. But in P&L account, whether you paid or not, that's a secondary thing. If it is income earned during the year, expenses incurred during the year, we will record it. So therefore, this net profit before tax consisting of items whether actually received or not, irrespective of that, based on accrual basis, we have included so many items in the P&L account. Even non-cash items also we have taken in P&L account, because P&L account consisting of all items, even the items which does not involve cash flow, like for example depreciation, is also there in the P&L account. So this net profit is the result of what? Is the result of all items, so of the current year, whether cash involved or not, and we have considered P&L account on accrual basis. But I want only cash flow from operating activities. So to this net profit, what adjustments I need to do? And for that I should know, see, this net profit is came from P&L account. I know P&L account is prepared on accrual basis. And one more thing, P&L account consisting of non-cash items, P&L account consisting of all items of incomes and expenses. All items of incomes and expenses. The P&L account doesn't make any difference now. Operating activities, financing activities, investing activities. Doesn't make any difference. But we want cash flow from operating activities only. But this net profit is already adjusted with non-operating activities also. What is non-operating? Non-operating activities. What is non-operating activities? Investing and financing are called non-operating, other than operating. So in P&L account, we will include in everything. For example, interest expenses. So interest expenses is also part of P&L account. Interest income, part of P&L account. But interest expenses, that means interest paid, comes under financing activity. Interest received, investing activity. But you are taking this net profit as the base. This net profit came from P&L account, and you know P&L account is consisting of all items, even non-operating items also. But I want only cash flow from operating activities. So therefore, the point to understand is, in indirect method, what we do is, we will take net profit before tax from P&L account as the base, and to this net profit before tax, we will make some adjustments to arrive at cash flow from operating activity. And what adjustments we need to do? See, briefly, the adjustments are divided into three categories, or three adjustments we need to do, three major heads of adjustments. So what adjustments if you do to this net profit, you will arrive at cash flow from operating activities. Three kinds of adjustment. First, non-cash items. Non-cash items. Sir, eliminate all non-cash items, sir. See, in P&L account, if any non-cash item is debited, that means when you are ascertaining this net profit, if any non-cash item is adjusted, debited, now you need to reverse it, add back. Suppose if it is already included in net profit, any non-cash items, minus it. Because this is cash flow statement, only items involving cash will come. So non-cash items, no question, it will not come in cash flow statement. So therefore, in the profit what is available in the P&L account, to that profit, first you need to eliminate all non-cash items. So if any non-cash item is already debited to P&L account, now add back. If it is already credited to P&L account, minus. Credited means it is included in net profit, so minus it. For example, depreciation. Depreciation is debited to P&L account, but is it comes in cash flow statement? No, because depreciation is a non-cash item. So you should add back. Like goodwill written off. Goodwill written off is what? Non-cash item. It does not involve any cash, but it is debited to P&L account. Add back. Exchange gains. For example, foreign exchange gains, unrealized gains. It is credited to P&L account, but it is not realized in cash. Therefore, we need to minus it. So simple. Go to the P&L account. See the expenses side, what non-cash items are there. See the income side, what non-cash items are there. Expenses side, any non-cash item is there. Now we add. Add means we are eliminating the effect, because if it is an expense, already it is deducted while arriving net profit. Now incomes minus expenses, all expenses are already deducted. Therefore, this net profit is after deducting non-cash items. So you should add back. Sometimes, suppose if the non-cash item is credited to P&L account, that means incomes minus expenses. This non-cash item is included as a part of net profit before tax. Now we need to deduct it. So therefore, the point to understand is in indirect method, first start with net profit before tax. This net profit before tax is available from P&L account. Now to this net profit before tax, three adjustments are necessary. First adjustment, non-cash items. The simple logic is non-cash items are not part of cash flow statement, but it is part of P&L account because P&L account doesn't make any difference between cash, non-cash items. Depreciation is the best example. Even though it does not involve cash, but we have anticipated and loss is recognized as per the concept of prudence. So similarly, any kind of non-cash item, if it is already part of P&L account, but it is not part of cash flow statement, but you are taking net profit before tax as the base. So therefore, we need to reverse the effect of non-cash items because they are anyway not part of cash flow statement. See, our object is this, our goal is this. The goal is what? Cash flow from operating activities. How I am going to arrive this goal? By making some adjustments. See, what makes this net profit this? That is what I'm doing. So I know this net profit consisting of non-cash items. Now I am eliminating. That is what I said. If it is already included, minus. If it is already deducted, add. So that the effect is eliminated. Okay. So the first adjustment is done. Okay, sir. Next, sir. Non-operating items, add or less. Non-operating items. Simple. Non-operating items other than operating items. Add or less. See, because we want cash flow from only operating activities. But in P&L account, non-operating items like investing and finance related activities are also covered. For example, if you make any investment, it is investing activity. From that investment, if you receive any income, in P&L account that is created. But in cash flow statement, it comes under investing activity. It will not come in operating activity. I want cash flow from operating activity. But I have taken net profit before tax as the base. In this net profit, non-operating items other than operating items are also involved. Therefore, eliminate the effect because they have to be shown separately under investing and financing activities. They are not part of operating activities. So therefore, any non-operating item, if it is already debited to P&L account, so while arriving net profit, if it is already deducted, add back. If it is already included in net profit, that means now it is part of net profit. Why need to deduct it? Because non-operating items are not part of cash flow from operating activity. Again, my goal is this: cash flow from operating activities. If my goal is cash flow from operating activities, what I need to do? Non-operating items I need to eliminate. How I am going to eliminate? If while arriving this net profit, if they are already debited, if they are already deducted, add back. Reverse treatment. If they are already included, minus it. So therefore, this is how the treatment will be done. So therefore, in indirect method, if in exams, the definitely question will come under indirect method. First take net profit before tax. Sometimes what happens now, this net profit before tax is not given in the question. We need to ascertain it. That calculation also I will tell. Wait. As of now, you understand, suppose net profit before tax is available and what adjustments if I do to this net profit, I will arrive at cash flow from operating activities. That is my thing. See, here my goal is this one, cash flow from operating activities. Flow from operating activities. My goal is this. So therefore, first what I will do, I will take net profit before tax. To this net profit before tax, non-cash items I will adjust. If non-cash items are debited to P&L account, I will add back. Credited to P&L account, I will minus. Again, I will consider non-operating items. See, non-cash, non-operating, because I want cash flow from operating activities. Operating activities. So this is my starting point. This is my starting point. And this is my end. This is my goal. So to reach this to this, what adjustments I need to do? So indirectly I will do. Indirectly I'm eliminating. See, direct method is what identify each receipt and payment. Cash sales, payment of salaries, payment of rent, receipt of rent. Like every operating activity, every receipt, every payment we will take, right? That is direct method. But indirect method, see, this is the starting point. This is the starting point and this is the end. So net profit before tax taken from P&L account. All non-cash items I will adjust. All non-operating items I will adjust. And one more important adjustment what I will do is, see, majority of the students thinking that, majority of the students they will understand these two. That is Non-cash items, non-operating items. Very, very good, sir, because we are preparing cash flow statement. So any item which does not involve cash, we need to eliminate. So non-cash item, any, we want cash flow from operating activities. Therefore, non-operating activities we should eliminate. Okay, we will understand. Any other adjustment necessary to the net profit before tax to arrive at cash flow from operating activities? Sir, all adjustments done. Then the balance figure is cash flow from operating activities. No, there is one more adjustment which is very, very important, that is working capital changes. This is the most important point in indirect method. So in indirect method, first take net profit before tax. To that you adjust non-cash items, then non-operating items. Then you would get cash flow from operating activities before tax, before working capital changes. So at this point of time, you will get one item, that is cash flow from operating activities, cash flows from operating activities before working capital changes, before working capital changes. So before working capital changes, so I will get one figure. Now I need to make working capital changes. So add or less working capital changes. Now, if I do the working capital changes adjustment, then I will get cash flow from operating activities before tax and extraordinary items. From that, I need to adjust tax, and then we need to adjust extraordinary items. See, always in cash flow statement, extraordinary items should be presented separately. So therefore, this is the first adjustment. This is the second. This is the third. So major adjustments are these three. Now we will talk about working capital changes. Sir, what is this working capital changes? Why we need to adjust it to the P&L account? So what way it is connected with cash flow statement? I will tell you. The working capital changes is nothing but current assets minus current liabilities. Whatever the current assets and current liabilities are part of the business, they are called as working capital changes. See, these current assets and current liabilities, the changes in these current assets and current liabilities may also have the effect on P&L account, but they does not have effect in cash flow statement. Since you are taking net profit before tax from P&L account as the base, these working capital changes are already adjusted. Now, since they are not part of cash flow statement, we need to eliminate them, like how we have eliminated non-cash items, non-operating items. Working capital changes also need to be adjusted. So first of all, what is working capital changes? Working capital is nothing but current assets minus current liabilities. First of all, what is current assets, sir? See, there are two types of assets in the business organization. One is long-term fixed assets, long-term assets. Second one is current assets. Basically, now long-term assets means they are fixed in nature. So their useful life is more than 1 year. More than 1 year. Like for example, plant and machinery, office equipment, furniture, land and buildings, vehicles. These are all fixed assets, long-term fixed assets. See, there are certain assets whose expectancy or who are going, which are going to be realized within 1 year, or whose benefits is going to be expired within 1 year. Like for example, inventory is a generally current asset, because which is meant for either use in production or meant for sale in the ordinary course of the business. So therefore we cannot say inventory is our long term asset. Inventory is a current asset. Like debtors is a current asset. Why? Because amount is going to be collected from the debtors in the ordinary course of the business. So we can't say debtors is a long term debtors, he will pay once in every 10, 20 years, 30 years. So there is no such thing as the long term debtors, like fixed debtors. So debtors is another current asset. Cash is a current asset which is readily available for use for any purpose. So current assets are those, so which is there in the business during the year. So very, I mean, less 12 months or less than period. So is the, I mean, main beneficial period for that asset. That is called current assets. Similarly, current liabilities. See, there are two kinds of liabilities: long-term liability, current liability. For example, debentures, basically a long-term liability, or any lease taken on long-term basis, it's a long-term liability. So there are some liabilities which is going to be paid in the next 12 months. Like for example, creditors, suppliers of goods. See, suppliers of goods, generally in the ordinary course of the business, we will pay the amount. So therefore, creditors is our what? Current liabilities. So the point is, the current assets and current liabilities will change every year, right? Those changes will have an impact on the profit. But That means the net profit what we have taken from P&L account is already an adjustment of these changes in working capital. But these working capital changes are going to affect my cash flow statement? Answer is no. Therefore, since I am taking net profit before tax as the base, I need to make an adjustment to this net profit before tax, these working capital changes, because they are not part of cash flow statement. Sir, how working capital changes will impact my profit? See, I will tell you. Suppose, sir, you take one by one. I will take first debtors. I am taking debtors. Okay. Now debtors, my opening balance of debtors is 10 lakh rupees, and my closing balance of debtors is 15 lakh rupees. So my opening balance of debtors how much, sir? 10 lakh rupees. My closing balance of debtors how much, sir? 15 lakh rupees. You tell me, sir, by looking at this, you can easily tell how much increase in my debtors. Increase in debtors 5 lakhs. This is an increase. You tell me whether this increase is having any effect on profit. Is there any impact on profit because of increase in debtors? Obviously. Why? Because see, how debtors will increase? Only when you make credit sales, right? See, since your opening balance is 10 lakhs, closing is 15 lakhs, so there is an increase of 5 lakhs sales, credit sales. Now, credit sale is our income, which is credited to P&L account. Since there is an increase of debtors, it indicates that there is a credit sale. That credit sale is already credited to P&L account, but it is not part of cash flow statement, because credit sale means cash is not involving. There is no cash involved in credit sale. So therefore, how can it part of P&L account? But already this 5 lakhs is already credited to P&L account, and it is part of net profit, but it is not part of cash flow statement. Therefore, this increase in current asset, you need to deduct it. Sir, increase in current asset we need to deduct? Yes, because that increase has affected, included in your profit, but it is not collected in cash. Best example, debtors. When debtors closing balance is more than opening balance, we say there is an increase in debtors. How debtors balance will increase? Only when there is a credit sale. That means that credit sale is part of P&L account. Sir, if the sales are cash sales, see, if the cash sales are there, how debtors balance will increase? If the sales itself is cash sales, so it is, debtors balance will not increase. Debtors means the person from whom we need to receive the amount. See, opening 10, closing 15, that means 5 lakhs extra we need to receive. 5 lakhs additional amount we need to receive from. Why he will give extra amount? That means he purchased goods from us. We sold goods to him on ordinary basis, credit sales. So credit sales we made, purchases we made, opening balance 10, closing 15. So that increase of 5 lakhs. That increase of 5 lakhs. So that increase has increased my income, but it is not collected in cash. Therefore, it is not part of cash flow statement. But it is already part of net profit. How it is not part of net profit? Because in P&L account we prepared on accrual basis. When you are preparing P&L account on accrual basis, what you do in P&L account? So we will take all sales. Sales means including credit sales. That means this 5 lakhs is already included in net profit. Now we need to deduct because it is not part of cash flow statement. So net profit we arrived, to this net profit we need to deduct 5 lakhs. So that means any increase in current asset will increase my profit, but it is not realized in cash. Therefore, it is not part of cash flow statement. Therefore, deduct. Increase in debtors minus to the net profit. I will take one more example, sir. Suppose, for example, you take inventory. Sir, inventory, suppose opening balance of inventory 10 lakhs, and then closing balance of inventory is 15 lakhs. Opening balance 10 lakhs, closing balance 15 lakhs. So how much in inventory increase? 5 lakhs. Definitely, by looking at itself, you can say that there is an increase of inventory balance of 5 lakhs. Now you tell me, when you prepare trading and P&L account, especially when you prepare P&L account, what you do? So the difference between opening and closing balance, the difference is change in inventories of work in progress, finished goods. This change will be debited to P&L account. For example, 10 has become 15. That means 5 lakhs increase in what? Inventory. This inventory is increased my profit. But actually, is this realized in cash? No, because we have not made any sale. Just the increase of inventory amount from 10 to 15, 5 lakhs increase. This increase is increased my profit. How it is going to increase my profit? If you remember, in P&L account, we will consider opening minus closing. That means the difference we already adjusting, we are debiting to P&L account. Because of that, my profit has been increased. So because there is an increase of this one. Actually, you see in P&L account, change in inventories 10 minus 15 minus 5 lakhs we will write expenses side. Expenses side of the P&L account. Actually, P&L account of companies I'm talking about, but it is there in the corporate accounting paper. But see, just now sorry, corporate accounting paper, schedule 3, the preparation of financial statements of a company. When you prepare financial statements of a company as per schedule 3 in P&L account expense side, we will take change in inventory. In financial statements of company chapter I explained. If you want, you can refer my notes also, or you want to pause here and go to the lecture and check it once. How inventory has to be dealt. The inventory is the opening and closing, we debit it to P&L account. So if opening minus closing, 10 minus 15, so minus 5 lakhs, we debit it to P&L account. Because of that, what happens? Incomes minus expenses. Minus of minus, it will become plus. That means this 5 lakhs is added to the net profit. Okay. So any increase in current asset, we need to deduct. Why, sir? The increase in current asset indicates that the increase is considered as part of profit, but it is not realized in cash. So since it is not realized in cash, it is not part of cash flow statement. It is not part of cash flow statement. So therefore, this is one adjustment. So what we are discussing, working capital changes. Working capital changes means the changes in current assets and current liabilities. Even the changes in current assets and current liabilities will also affect my profits, but it is not part of cash flow statement. So that is what I am explaining. First, I explained change in current assets. Similarly, change in current liabilities. I will explain change in current liabilities. For example, you take creditors. Suppose opening creditors balance is 10 lakhs and closing creditors balance is how much? Suppose 15 lakhs. Now you tell me how much increase? 5 lakhs. Why creditors balance will increase? Only when you make purchases. That means this 5 lakhs purchases is debited to P&L account. But is it part of cash flow statement? No. Why? Because this 5 lakhs is not yet paid. It is not involving any cash. See, opening 10, closing 15. That means 5 lakhs increase. Why it is increased? Because 5 lakhs additional purchases we made and we have not made any payment. Sir, whether we make the payment or not, we don't know. See, why? Suppose if the payment is made, why closing debtors balance will increase here? Logically speaking. So closing creditors balance increased means there is a current year purchase, but it is not resulted in payment. So therefore, it is not part of cash flow statement, but it is already included in net profit. How it is included in profit? We debited to P&L account. From P&L account, we have taken net profit. Therefore, this increase of 5 lakhs is already debited to P&L account. How can we eliminate the effect? Add. So therefore, increase in current asset. What we need to do? Whenever there is an increase in current asset, that increase created to P&L account. That means it is part of net profit, but it is not realized. Therefore, we need to minus it, increase in current asset. Similarly, increase in current liabilities. Suppose if there is an increase of current liability, there is a increase of what? If there is an increase of current liability, that increase has been debited to P&L account. Because of that, my net profit has been deducted. While arriving net profit, these 5 lakhs additional purchases has been deducted. So therefore, now we need to add. So that way, increase in current assets minus. Increase in current liabilities, opposite, add. Similarly, decrease in current assets. For example, I will tell you, debtors balance, opening balance, suppose 10 lakhs, closing balance, 5 lakhs. That means tell me how much debtors balance decreased? 5 lakhs. How debtors balance will decrease? That means you made the payment during the year. When you make the payment to the debtors during the year, definitely balance will reduce. So whenever you make the payment, it is part of cash flow statement. But this payment of 5 lakhs is not included in net profit. How? Because in P&L account, will you consider any payment? No. Only when expenses incurred we will recognize. Only when incomes earned we will recognize. But payment to debtors is not part of P&L account. In P&L account, we will prepare on accrual basis. Whatever the expenses we incurred, whatever the incomes we earned, we will record. But any payment made to the debtors, like opening balance 10 lakhs, closing balance 5 lakhs. So that means how debtors balance will decrease, sir? Only when you make the payment. When you make the payment, is it part of cash flow statement? Definitely it is part of cash flow statement. Because cash flow statement consisting of all cash inflows and outflows. So when you make the payment, definitely it should part of cash flow statement. So therefore, but you have taken net profit before tax as the base. While arriving this net profit, is this 5 lakhs is considered? No, not considered. That's why what we need to do now, we need to add inflow. Na? Inflow means added. So therefore, decrease in current asset, add. Similarly, decrease in current liability. Minus. How? See here. For example, creditors opening balance 10, closing 5. Tell me, sir. Creditors balance opening 10, closing 5. That means how much creditors balance has been decreased? 5. How creditors balance will decrease? Only when you make the payment. So when you make the payment, creditors balance will decrease. So therefore you made the payment and creditors balance decreased by 5 lakhs. So therefore, since creditors balance decreased by 5 lakhs, what we will do is, this decrease has resulted in cash outflow. Therefore, it is part of cash flow statement. But we are taken net profit before tax as the base. So while arriving that net profit, this 5 lakhs payment has not been adjusted. Now we need to deduct it. That's why minus. So logical way of understanding. Again, once again, I am reiterating what we have discussed so far. See, we are discussing indirect method. Indirect method of ascertaining cash flow from operating activities. See, in indirect method, first of all, start with net profit before tax. To this net profit before tax, 3 adjustments if you do, you will arrive at cash flow from operating activities. Those 3 adjustments are, first, non-cash items. Because non-cash items are not part of cash flow statement, but it is part of P&L account. Because P&L account is prepared on accrual basis, even non-cash items are also part of P&L account. Therefore, since you are taking net profit before tax as a starting point, while arriving this net profit, any non-cash items are already adjusted, we need to reverse it. Suppose if it is debited to P&L account, add back. If it is credited to P&L account, minus. So this is the first thing. This is the first thing. Second, non-operating items. I want cash flow from operating activities. I want cash flows from which activities? Operating activities. So therefore, non-operating items I need to eliminate. While arriving net profit, what are all the non-operating items? If it is already debited to P&L account, add back. If it is credited to P&L account, minus. Now, most of the students think that these are the 2 adjustments only. No, there is one more adjustment called working capital changes. Sir, what is this working capital changes? Simple. The current assets and current liabilities of the organization will impact the profits, but it does not result in cash inflows or outflows. So, best example, for example, increase in debtors. Debtors increased. That means there is a credit sale. It is part of P&L account, but it is not result in cash. Therefore, it should not be part of cash flow statement. So therefore, since you are taking profit as the base, in that profit, the net profit credit sales already included, we need to deduct. That's why increase in current assets, minus. Decrease in current asset. Since there is a decrease in current asset, that indicates that the decrease is happened because there is a cash outflow, but it is not part of cash flow statement. It is not part of P&L account. Therefore, from the P&L account, whatever the net profit you are taking, it is not already adjusted with cash we paid. So decrease in current assets. Add back. So, or you can remember in a simple manner, increase in current assets minus, opposite, increase in current liabilities plus. Minus plus plus minus. Minus plus. See, minus plus plus minus. Okay. What is this first minus? Current assets increase. What is the first plus? First minus this one. What is the plus? Minus plus. What is this plus? This plus is current liabilities increase. So both increases first. Next plus current liabilities. Sorry. current assets decrease. This one current liabilities decrease. Okay. Now you do these working capital changes. So plus, minus, plus, plus, minus. Increase in current assets, increase in current liabilities. Decrease in current assets, decrease in current liabilities. So these are the adjustments we need to do. After making these adjustments, then you will get net profit before tax. I mean cash flow from operating activities before tax and extraordinary items. From that you need to adjust tax and then work extraordinary items. Then you will get cash flow from operating activities. Therefore, from the net profit, whatever you have taken from P&L account, if you eliminate non-cash, if you eliminate non-operating items, and if you eliminate the effect of change in current assets, then what you get is cash flow from operating activities before tax and extraordinary items. From that tax, extraordinary items, if you adjust, then you will get cash flow from operating activities. So I think, see, out of these three, working capital changes is very technical and I explained enough. So all you can think like this: any current asset increase, decrease. See, when you take current assets, now don't consider cash and cash equivalents because it is already included. It is, I mean, we will consider it separately. We won't consider cash and cash equivalents as part of this one. I mean, original cash, I'm saying cash in hand, cash at bank is not part of this current assets and current liabilities. Of course, generally they are part of current assets and current liabilities. For this purpose, they are not part of current assets and current liabilities. So theory, see here this paragraph. So statement of P&L account is prepared on accrual basis, not on cash basis, and it also includes certain non-operating items. Definitely P&L account includes non-operating items also, such as interest paid, P&L account on sale of fixed asset. Actually, when you sell fixed asset, it is part of which activity? Investing activity, na? So, but that sale value, in that sale value there is a profit. That profit is part of P&L account. But you need to show it under investing activity, the sale value of fixed asset, including profit. So that's what I'm saying. See, in indirect method, what we are trying to do is, since you are beginning with the net profit as per P&L account, so and P&L account is prepared on accrual basis and it includes so many non-operating items, non-cash items. So if you eliminate those things, then you will get cash flow from operating activities. That is what till now the entire discussion is all about. And non-cash items such as depreciation, goodwill written off, these are all there in the P&L account. So see, therefore, it becomes necessary to adjust the amount of net profit or loss as shown by statement of P&L account for arriving at cash flow from operating activities. So I think this is the very important paragraph, sir. See, this theory I have prepared keeping in view the mindset of the students. So that's why I have prepared these notes basic level. So being a student, now you can understand that how I am going to prepare cash flow from operating activities. Because this indirect method is a struggle for so many students. So I want to make it very simple for you. So remember only three things: non-cash, non-operating item, working capital changes. And I have given this format, right? So this format you apply in the preparation in indirect method while you solving the problem. See here. Till now, whatever the discussion we have made, I have put it in the form of a format. In indirect method, how we are going to, prepare cash flow from operating activities. So cash flow from operating activities, indirect method. See here. Indirect method. First, what is the starting point? You know this: net profit or loss before tax. Always understand before tax. And extraordinary items. Always see. Don't adjust extraordinary items. Extraordinary items we will adjust at the end separately. At the end, we will adjust extraordinary items separately. Because see, as per accounting standard, see, this is the requirement. So what is the starting point? Net profit before tax. Generally they say net profit before tax. One more thing is also there, net profit before tax and extraordinary items, because extraordinary items we need to present separately. And first, non-cash items, this is very important. First adjustment, non-cash items. Why? Because non-cash items are not part of cash flow statement, because they does not involve any cash. Second, non-operating items, that is investing and financing activities, because we show them separately now. We want cash flow from operating activities now. That's why in this net profit or loss arrival, whatever the non-operating items adjusted, I mean already if they have deducted, we should add back. If they are already added, we should minus. So add or less non-operating items, investing and financing activities. So therefore, cash flow from operating activities, indirect method, first we will start with net profit before tax and extraordinary items. Then non-cash items, non-operating items. If they are already debited to P&L account, that means they are deducted, add back. If they are already credited to P&L account, they are included, minus. Same treatment apply for non-cash items, non-operating items. And what is a non-operating item? Investing and financing activities. So if any item relating to investing and financing activity, and if it is already included in P&L account, I mean, while arriving net profit, if it is already adjusted, we need to reverse it. Then you will get what? Operating profit before working capital changes. Most of the students feel that these two adjustments are okay, but there is a third adjustment, working capital changes. So what is working capital changes? I told you, current assets, current liabilities changes. For example, increase in current assets, deduct. Decrease in current assets, add. Increase in current liabilities, add. Decrease in current liabilities, less. So less, add less. So less, add less. So in examination, suppose for example, in that moment, suppose logic may not strike. In such a situation, you can remember like this: less, add less. What is less? Increase in current assets. Decrease in current assets, add. So less, add. So these two things are relating to current assets. These two things are related to current liabilities. I explained the logic also, and I have written here. See, increase in current assets. Imagine, see, in your mind, imagine one example. Current assets, suppose debtors, opening debtors 10 lakhs, closing 20 lakhs. So 10 lakhs debtors increase. Increase in debtors means definitely there is an increase in sales, credit sales. That's why debtors will increase. So there is an increase of, increase of debtors indicates that there is a credit sales, but it is not at realized. Credit sale means it is not realized in cash. Therefore, it is not part of cash flow statement. But while arriving net profit, it is already included. So minus. That's why I have written here, increase in net profit, but not realized in cash. Increase in net profit, but not realized in cash. Therefore, don't consider it as a part of cash flow statement. So from operating profit before working capital changes, minus. Next, add decrease in current assets. Any current assets decrease. See, decrease in current assets increase, there is an outflow of cash, but it is not included in net profit. That's why add. See, realized in cash, but not included in net profit. Not outflow. Decrease in current assets means there is a realization of cash. For example, opening debtors 10 lakhs, closing debtors 5 lakhs. See, opening debtors 10, closing 5. That means 5 lakhs decreased. How debtors will decrease? Because they make the payment. So that means amount is realized. When it is realized in cash, it is part of cash flow statement. But is this 5 lakhs decrease is part of P&L account? No, because in P&L account we will show only incomes and expenses accrued during the year, not the payments. But since it is not included in this net profit, what we need to do? Add now, because it is part of cash flow statement. Inflow, outflow, inflow. Current assets decrease result in increase, inflow of cash, the realization in cash, but not included in net profit. Similarly, increase in current liability. For example, creditors opening balance 10 lakhs, closing balance 20 lakhs. That means there is an increase of creditors 10 lakhs. This increase indicates that there is a credit purchases. Credit purchases is debited to P&L account. Because of that, net profit decreased. But is it actually result in cash outflow? No, that's why add back. Decrease in net profit, but not paid in cash. Similarly, decrease in current liability. See, current liabilities decrease means we made the payment. So paid in cash, but not deducted from net profit. So that's why less. So therefore, the point to understand is very simple. Working capital changes are this. So increase in current assets, decrease in current assets. Increase in current liabilities, decrease in current liabilities. Less, add less. Then you will get cash flow from operating activities before tax and extraordinary items. So 3 adjustments I have done. One is non-cash, another one is non-operating, another one is working capital change. After making all these 3 adjustments, then you will get cash flow from operating activities before tax and extraordinary items. From that, minus tax paid, then extraordinary items. Extraordinary items means either it can be an extraordinary item in the form of gain or extraordinary item in the form of a loss. Suppose if it is a loss, it is debited to P&L account. Now we add back. Because see, sorry, we have taken net profit, cash flow from operating activities before tax and extraordinary items. Before tax as well as extraordinary items we have taken. So therefore tax paid we have to deduct. Remember, always tax paid, because it is cash flow statement, only tax paid we have to consider. Extraordinary items also we need to consider separately. Then you will get net cash generated from operating activity. So this is how the indirect method works. So once again, first starting point, net profit before tax and extraordinary items. Add or less non-cash items. Add or less non-operating items. Then operating profit before working capital changes. Working capital changes, less add less. Less add less. Less add less. Increase in current assets, less. Decrease in current assets, add. Increase in current liabilities, add. Decrease in current liabilities, less. Then you will get cash flow from operating activities before tax and extraordinary items. Tax paid, then extraordinary items. Then you will get net cash generated from operating activities. So this is how in indirect method we will discuss different things. So now we have completed. So the next chapter for discussion is employee stock option plan, ESOP, ESPP, SES. So there are 3 topics we need to learn in this chapter, sir. First one is employee stock option plan, ESOP. Second one is employee stock purchase plan. Third one, SES, sweat equity shares. So let us first discuss ESOP. So first of all, what is ESOP and what is the basic ESO employee stock option plan will be? What are the important terms used in ESOP and what are the other share based payments? See, employee stock purchase plan is also another kind of benefit which we are providing to the employees. And what is the accounting treatment for ESOP? So that is what we are going to cover in this chapter. See, the main idea is very simple. Company wants to retain its employees. So we want employees to work with us in the long run. How can we ensure employees will work with us in the long run? So apart from the regular benefits, salaries, what we are paying, retirement benefits, what we are paying, why can't we give, benefits related to shares or benefits in the form of directly in the benefits directly relating to shares? So, or we can issue shares directly to the employees itself. So making employees to participate in the ownership. So purchasing the shares of the company. That is the main idea behind this ESOP, ESPP, sweat equity shares plans. So taking employees into the ownership of the company, so that we ensure that we are giving proper compensation to the employees. Employees also will get a feeling that they are part of the ownership of the organization. So there is a possibility that they will work in the long run. Now let us first discuss ESOP. What is this? See, this is a very popular employee stock option plan. What is this plan is all about? See, ESOP is an option. See, it is an option. It is not compulsory. Suppose there is an employee. See, according to this plan, we will offer, some shares to the employee subject to satisfaction or fulfillment of certain conditions. If he fulfill those conditions, then he will get a right to exercise the option. So it is not compulsory that he has to subscribe the shares. So that's why employee stock option plan is an option given by the company to its employees, officers, directors. Even directors, officers are also part of this plan. So it is an offer which is given by the company to its employees, directors, officers, for what? To purchase or subscribe the shares of the company. So to purchase the shares of the company when in future, not now, in future. Why? Because see, we will put some conditions now. So to satisfy those conditions, certain time limit will be there. So once you satisfy the condition, we will prescribe the time limit. Within that time, if you want, you can exercise the option and purchase the shares of the company. And one more important thing here is we will offer shares at a concessional price, that is less than the market price. So for example, the market price is 150 rupees, company is giving at 90 rupees. Offer is given by the company to the shareholders to purchase to the existing employees to purchase the shares at 90 rupees. So this is called employee stock option plan. Very simple, it's an option. So what are the important few points here? It is an option, not compulsory. Option given by the company to purchase to employees, officers, directors to purchase or subscribe shares of the company, not now, in future, at a concessional price. Okay. So sir, generally this employee stock option plan, how the basic structure of the plan will be, see here. See, actually in employee stock option plan there are three stages, or this process of employee stock option plan there are three stages. First stage is announcement, that means grant date. So company will prepare the plan and will announce the plan. So for example, here in this case the grant date is 1/4/2021. Company announced the plan. Grant date is the date on which the plan was announced. See here, the date on which the company announced the employee stock option plan, or the date on which the employer and employee agreed to the plan. So that date is called grant date. Suppose for example, there are 100 employees are there, and number of options per employee 100. Options per employee, here options means shares. So 100 employees, each employee we want to offer 100 shares, and the market price is 100 per share, but we want them to purchase at 60 rupees. We are giving them an offer to exercise at 60 rupees per share. So basically this is how the plan will be. First they will announce the plan. On the day they announced the plan, they will prescribe everything. How many number of employees are eligible, who are all the employees eligible, and for each employee how many options we are giving, and what is the market price per share, and what price we are giving you. So this is the first stage, we call it as grant date. Now sir, suppose out of that 100 employees I am also one of the employee. So company has offered me 100 shares to purchase at 60 rupees. Can I purchase directly? No, you have to satisfy certain conditions. Sir, what are those conditions? They are called vesting conditions. The conditions which an employee needed to satisfy in order to eligible to purchase the shares of the company. Company has given an offer to you according to the plan, and according to the plan they have put some conditions also. Those conditions are called vesting conditions. Vesting means the process of belonging. When an options will belong to you, when you can exercise the right of options to subscribe the shares or to subscribe the options. So vesting conditions you have to satisfy. See, there are two types of vesting conditions. One is a service condition, another one is a performance condition. Service condition, performance condition. Generally service condition is relating to what? Time period. So time, for example, those who worked in the next 3 years, they will purchase the shares of the company. They can purchase shares of the company. So company may put the time limits. For example, employees who need to work for 2.5 years, vesting period is 2.5 years. That means 2.5 years from the grant date, they need to continue in the organization. They need to work in the organization. Then after that, they will be eligible. They will be eligible. And if they want, they can purchase the shares of the company. This is service condition. Another kind of vesting condition could be performance condition, like sales, profit, etc. For example, company will put a condition that if the market price of the share this reaches by this amount, then you can purchase the shares of the company, or if the sales increases by this much, you are eligible to exercise the option. Like that, company will put a conditions. Those are called vesting conditions. So what is vesting conditions? The conditions which an employee needed to satisfy in order to exercise the option to purchase the shares of the company. See here, vesting conditions. Vesting conditions are those conditions which an employee needed to satisfy in order to get eligibility to exercise the option to purchase the shares of the company. So there are two types of vesting conditions: service conditions, performance conditions. Service conditions are relating to time, performance conditions are relating to net profit, sales, etc. And see, to satisfy these vesting conditions, they have prescribed a time limit. That time limit is called vesting period. For example, company says you have to, the employees, in order to eligible to purchase the shares of the company, they need to work for next 2 years. That means 2 years is the vesting period, because the period time limit which is given to satisfy the vesting conditions is called vesting period. 2 years is the vesting period in my example. So what is vesting period? It is the period during which an employee needed to satisfy the vesting conditions. So it is a period during which an employee needed to satisfy the vesting conditions. So therefore, tell me, in employee stock option plan, what is the first stage? The first stage is grant date. So what is grant date? The date on which the company announced the plan. What is the next stage? The next stage is vesting period. In vesting period, employee need to satisfy what? Vesting conditions. How many types of vesting conditions are there? There are two types of vesting condition: service condition, performance condition. What is service condition? Service conditions are relating to time or period. Performance conditions are relating to sales, net profit, etc. Okay. Now see, once the vesting period is over, by the end of the vesting period, we come to know how many employees are actually eligible. See here, company has selected 100 employees, and each employee 100 options they have given, and they have put some conditions. For example, they have put a condition of 2 years they need to work. See, out of these 100 employees, only 90 employees continued. 10 employees they left the job. That means 90 employees are eligible to exercise the option. So once the vesting period is over, the next stage is exercise period. The company can prescribe time limit also. For example, see, they have prescribed a time limit of 6 months. That means within 6 months after the vesting period, they need to exercise the option if they want. Otherwise, they're not required to. If they don't want to exercise, they can. It is their option. That's why it is called employee stock option plan. So what is the exercise period? Exercise period is the period during which an eligible employee, who is eligible employee? The employee who satisfies the vesting conditions. If they want to purchase shares of the company, they can purchase. In which period? Exercise period. In my example, you see, grant date 1/4/2021, 2 years, suppose service condition. That means 22-23, 31st March 2023, vesting period is completed. From here to next 6 months. If employee wants, he can subscribe the shares of the company. That is on 30th September 2023 is the last date to exercise the option. Sir, suppose what about after 30th September? See, once 30th September is gone over, you are not eligible to subscribe the shares of the company. That means whatever the options vested to you, they will be lapsed, because the time limit is there. According to that time limit, you have to exercise. Once you have not exercised, the option will be lapsed. So tell me, Nana, what are the stages in ESOP? First, grant date. Remember, grant date. What is the second stage, Nana? Vesting period. Vesting period. What is the third stage, Nana? Exercise period. Third stage is exercise period. Exercise period. What happens on grant date, Nana? The date on which company announced the plan. What is vesting period, Nana? It is a period which is given to satisfy the vesting conditions. What are vesting conditions? Vesting conditions are those conditions which an employee needed to satisfy in order to eligible to purchase the shares of the company. And vesting conditions are two types, Nana. Service, performance condition. Service conditions are relating to time, Nana. Performance conditions are relating to maybe market price of the share, sales target, anything like that. Performance, not relating to time. Now, what is exercise period? See, it is the period during which an eligible employee can exercise the option to purchase the shares of the company. So exercise period always follows after vesting period. So this is fixed. Exercise, so first grant date, then vesting period, then exercise period. Those who satisfy the vesting conditions in the vesting period, then they can purchase shares in the exercise period. And what is the exercise price? It is the price at which an employee will exercise the option. It is the price at which employee will exercise the option. Okay. So this is about the important terms which is used in ESOP. So just I have explained the basic employee stock option plan, how the plan will be, and the significance of each word. See, we are discussing this one. Along with this one, you have this one also in the chapter, that is employee stock purchase plan. Sir, what is this employee stock purchase plan? Simple. When a company is going for public issue, along with the public, shares are also offered to employees. What is the difference between employee stock option plan and employee stock purchase plan? See, employee stock option plan is a specific plan which is designed to issue shares to its employees, subject to satisfaction of certain conditions. But employee stock purchase plan, it is like when a company is going for public issue, along with the public, shares are also offered to existing employees. So employee stock purchase plan. Under this plan, shares are offered by the company to its employees along with public. And there is one more item called SAR, but it is not there in your syllabus. So please remove it. Next, the most important part is, sir, what is the accounting treatment for ESOP? See, this accounting treatment has to be done based on the guidance note which is given by Institute of Chartered Accountants of India, that is share based payment. So based on this guidance note, we need to do the accounting treatment. See, I will explain the accounting treatment with the help of an example. Now take this example. Company on 1/4/2020 grand date has announced the plan. How many employees are eligible? 50. I mean, company given an offer to 50 employees. And what are the number of options per employee? 100. And what is the market price on grand date? So on the date of announcement of the plan, market price is 120. Excise price, but company is giving you at 80 rupees only. Okay. What is the face value per share? 10 rupees. Okay. So this is on 1/4/2020. Now next, you know the next stage. What is the next stage? Vesting period. For example, company has put 2 years vesting conditions. Okay, service condition company has put 2 years employee have to work. That means these 50 employees, if they work next 2 years, then they are eligible. And then they can exercise the option. So 2 years is the vesting period. And then after that 6 months time is given to exercise their option. So therefore, from 1/4/2022, 31st March 2022. So this is the first stage, 1/4/2020. This is the second stage, vesting period, this 2 years. After that 6 months. So exercise period. This is the third stage. So by 30th September 2022, the entire plan will be over. Now, here, how to do the accounting treatment? See, always remember, on 1/4/2020, that is on grand date, no entry is required. No entry is required on grand date. So remember, so on grand date, no entry is required. No entry is required. First thing is over. That means whenever company announced employee stock option plan on 1/4/2020, no entry is recorded in the books. Just announcing the plan. So how can we, recognize anything in the books? Company is issuing shares, sir? No. So therefore, no entry on 1/4/2020. Next. The most important stage is this stage, this vesting period. Now you tell me, in the vesting period, by the end of the first year, that is on 31st March 2021, first year over. Now see, ESOP accounting is to be done based on real-time basis. Real-time basis. That means based on the position on that date, you have to think and you have to recognize. See, first year end. Imagine yourself, 1/4/2020 company announced the plan. Oh, no entry. Now at the end of the first year, 31st March 2021. How many employees are there? 50. Okay. Now, suppose 50 employees are still there. By the end of the first year also, employees are continuing, 50 employees. Now, guidance note says, during the vesting period, what we need to do is, we need to anticipate, so the loss. Suppose if 50 employees eligible and exercise the option, what will be the total loss to the company? That loss we need to recognize and amortize over the vesting period. For example, here 50 employees are there. Suppose if these 50 employees next year also they worked and satisfy all the conditions, and if they exercise the option. So 50 employees into each employee, how many options? 100. That means total 5,000 shares we need to issue. Each share at market price 120, we are issuing at 80. That means what is the loss per share? 40 into 40. That will be 2 lakh rupees. This 2 lakhs divided by vesting period, 2 years. That means 1 lakh is the loss. That loss we need to recognize at the end of the first year. So therefore, grand date, no entry. During the vesting period, what we need to do? We need to recognize the loss. Total loss amortized over the vesting period. Because based on the information available at the end of the first year, how many employees are eligible, and if this many number of employees eligible and exercise the option, how many options will be given, and what will be the loss per option? If you multiply it with, then you will get total option value. Total option value here means loss, discount. See, I have calculated here 31st March 2021 option value, that is discount. How to find out? Number of options expected to be vested. Expecting, because still at the end of the second year we don't know the real picture, but based on the information available at the end of the first year, how many options you are expecting to exercise, into market price minus exercise price. The difference between market price and exercise price. Market price is the price, and exercise price is the price at which you offered. So the difference is nothing but the discount you are giving, the loss. See, 50 employees are, each employee 100 options, so 5,000 into market price 120, you are giving it 80, so 40. So 5,000 into 80, that is 2 lakhs is the total option value or total discount. Now this will be amortized over vesting period. So what is the amortized amount? 2 lakhs divided by 2, that is 1 lakh. So therefore we need to recognize this 1 lakh in the books. Sir, how will you recognize, sir? What is the entry? See, the guidance note says the entry for recognition of employee compensation, this discount is employee compensation expenses account debtor to employee stock option outstanding account. See, employee compensation expenses account debtor to employee stock option outstanding account. This employee compensation expenses is like a loss to you, right? This loss will be again transferred to P&L account. So employee compensation expenses account debtor to employee stock option outstanding account. Okay, sir, we understood that this is a loss. This loss we need to debit, and we need to write employee compensation expenses account debtor to employee stock option outstanding account. What is this employee stock option outstanding, sir? See, this loss you are incurring because of issuing shares now. So in future you need to issue the shares. So our assumption is this, is what, for example, 50 employees are there. If these 50 employees satisfy the conditions and if they exercise the option, we need to issue 5,000 shares, and 5,000 shares we need to issue at a loss of 40 per share. Therefore our total loss is 2 lakhs. Now we are amortizing 1 lakh. So therefore this loss is relating to shares, that means shareholders. That's why you need to open an account called employee stock option outstanding account. So I told you in financial statements of company chapter that employee stock option outstanding account is formed part of reserves and surplus. It is not to be treated as any liability in the balance sheet. See, in fact it is not a liability. It is the loss which we are incurring at the time of issue of shares. So therefore it will be created to reserves and surplus. Where this employee stock option outstanding will be shown, sir? Reserves and surplus. Because once the employees exercise this option, then this outstanding account will be cancelled and converted into share capital, or if they have not exercised, then it will be transferred to general reserve, which I will tell you again. So this is the entry we need to pass during the vesting period. So tell me, during the vesting period, what will you do? You need to amortize the discount value. What is the discount? Total loss because of employee stock option plan, based on the information available at the end of the first year. Now first year is completed. What is the entry? Employee compensation expenses account debtor to employee stock option outstanding account. This employee compensation expenses will be debited to P&L account as a loss. And this employee stock option outstanding account will be shown in the balance sheet under the head reserves and surplus, not as a part of share capital. Okay. Now second year. First year is completed, second year. Now at the end of the second year. Now in the second year, suppose for example 10 employees left the organization. They resigned from the organization. So tell me now, you are at the end of the second year. Now you know the clear picture, because the vesting period is completed 2 years. By the end of the second year, you came to know that only 40 employees are eligible, not 50, because out of 50, 10 employees left the organization. Only 40 employees are there. Now that means if 40 employees are there and if they exercise the option, how many shares we need to issue? 40 into 100, 4,000. And each share we are giving at a loss of 40. So therefore 4,000 into 40, that is 1,60,000. So the total loss is 1,60,000. You need to amortize it for 2 years. Already 1 year is over. Therefore 1,60,000 is the total loss to be amortized for 2 years. You are at the end of the second year, and already first year how much recognized? 1 lakh. So therefore the remaining 60,000 will be recognized in the second year. That means based on real time basis, first year you thought the loss will be 2 lakhs. Why? Because 50 employees are there. If these 50 employees satisfy continue till the second year, and if they exercise the option, we need to give 5,000 options. And if 5,000 options are given at a loss of 40 for each, then our total loss is 2 lakhs. But we thought, we came to know the real picture at the end of the second year. See here, at the end of the second year, we came to know the real picture. So if the real picture is only 40 employees, therefore we need to revise the loss accordingly. Therefore, what is the entry for here? Employee compensation expenses account debtor to employee stock option outstanding account. How much you will write? 60,000, 60,000. Sir, why 60, 60? Not why 1 lakh, 1 lakh? See, based on the information available at the end of the first year, your loss is 2 lakhs, so divide by 2. You thought first year 1 lakh, second year 1 lakh, but by the end of the second year, the loss position changed. Only 40 employees are eligible. 40 employees eligible and exercise at 40 rupees per loss, total loss is 1 lakh 60. This 1 lakh 60,000 will be amortized for 2 years. Already first year is over. Therefore, 1 lakh 60 minus employee compensation expenses already recognized. You remove it. Only 60,000 will be recognized and that will be transferred to P&L account. Sir, suppose at the end of the second year, 50 employees continued. Then the loss for the second year to be amortized is also 1 lakh. Okay. So, grant date, no entry. Vesting period, amortization entry. And this amortization entry, you have to record it according to the real-time basis. Now the vesting period is completed. Once the vesting period is completed, exercise period. So during this period, the eligible employees can purchase the shares of the company. For example, first case, I have taken different cases here. Suppose 5,000 options were exercised. That means imagine everything is fared well. Suppose 50 employees are there. Each employee continued 2 years and each employee exercised the option. Then 5,000 options will be exercised. Na? So 50 into 100, 5,000. Now imagine yourself, you are the company, employees are exercising their options. We need to issue the shares. So what entry you will write? Bank account debit 5,000 into 80 because 5,000 options at rupees 80 rupees each, 4 lakhs. Employee stock option outstanding account debit. See, at the time of amortization of the loss, you booked employee stock option outstanding account. I told you that outstanding account now will be cancelled at the time of exercising of the option. So outstanding account will be cancelled. Sir, at what price outstanding account will be cancelled? Loss, at loss. That means option value per option. That is 40 rupees. The difference between the market price and exercise price. That is only you amortize it now. So that you need to reverse now. So 5,000 options employees exercised at rupees 40 per option. So that means outstanding account is cancelled, 2 lakhs. So bank account debtor, employee stock option outstanding account debtor, 2 equity share capital, 5,000 into 10, 2 securities premium. Because you are offering shares at premium, na? So that's why. Securities premium, balancing figure, 5 lakh 50. So tell me, what is the entry for exercising of the options? Bank account debit, number of options exercised into exercise price. Employee stock option outstanding account debit, number of options exercised into market price minus exercise price. 2 equity share capital, number of options exercised into face value. 2 securities premium, balancing figure. Okay, suppose sir, imagine 50 employees satisfied the condition, but only 45 employees exercised their options. That means 4,500 options only exercised. Then you write the entry. What is the entry? Same, bank account debit. Number of options exercised 4,500 into 80. And employee stock option outstanding account debit 4,500 into 40. So that means you need to cancel the outstanding account to the extent of the number of options exercised by the employees. So that means 1 lakh 80. And then equity share capital 4,500 options into 10 per option. 2 securities premium, balancing figure. So therefore, whenever, even though employee is eligible, how many options they are exercised, we need to see. Out of 5,000, they are exercising only 4,500. So therefore, you need to write the exercise entry for 4,500 options only. So bank account debit 4,500 options into 80. Employee stock option outstanding account debit 4,500 into 40. Because you need to cancel outstanding account only to the extent the number of options exercised by the employees. 2 equity share capital 4,500 into 10. And the remaining is balancing figure. Sir, what about those remaining 5 employees? 500 options. The 5 employees who have not exercised the option. See, once the exercise period is over, 30th September 2022, immediately after the next day, we need to cancel. The unexercised options will be lapsed. Now we need to cancel it. How to cancel it, sir? Simple. Employee stock option outstanding account debtor to general reserve. We need to cancel this outstanding account and will be transferred to general reserve. See, what is the thing here happened? During the vesting period, every year you need to see, based on the information available at the end of the year, based on real-time basis, what will be my possible loss. Accordingly, I will amortize. Suppose imagine 50 employees are there. These 50 employees continue till vesting period. That means the total loss is 2 lakhs. First year 1 lakh I amortized. Second year 1 lakh I amortized. But after the vesting period, in exercise period, out of 50 employees, only 45 employees exercise the option. That means for 45 employees, I need to recognize and I need to cancel employee stock option outstanding account. For remaining 5 employees, whatever outstanding account is there, that will be cancelled now and transferred to general reserve because they have not exercised the option. Therefore, whatever the amount I transfer to outstanding account, outstanding employee stock option outstanding account, and I will put it in the reserves on surplus, that now is not required because this reserve employee stock option outstanding account is for employees. Anyway, they are not exercising the option. Therefore, it will be transferred to general reserve. This is the cancellation entry. So, therefore, in conclusion, can you tell me what are the entries? Grant date, no entry. Vesting period, excise entry. Vesting period, we need to, not excise entry, vesting period, we need to write the amortization entry. How to write the amortization entry? Number of options expected to be vested into market price minus excise price divided by vesting period. And what is the entry? Employee compensation expenses account to employee stock option outstanding account. And excise period next. In excise period, option will be exercised. So what is the entry for exercising of option? Bank account debtor, employee stock option outstanding account debtor, to equity share capital, to securities premium. Now, to the extent of the options not exercised, they will be lapsed immediately after the excise period. Therefore, we have to write employee stock option outstanding account debtor to general reserve. Cancel the outstanding account by transferring to general reserve. Now, this is one case. This is the main thing about employee stock option plan and its accounting treatment. Now, see, sometimes what happens, the entire plan will be completed in 1 year itself. See, in the above example, during the vesting period, you amortized the loss over the vesting period. Suppose if the loss, if the vesting period itself is 1 year or less than 1 year, therefore, in that situation, no need to write amortization entry. Direct excise entry itself is sufficient. Suppose, for example, here grant date is 1/4/2020 and vesting period is 11.5 months. Last 15 days, you can exercise the option. That is, from 15th March to 31st March, company is giving an offer to the employees to exercise their option. That is half month. That means, see here, entire plan is completed in 2021 itself. So the vesting period is only 11.5 months. The exercise period is half month. So in this situation, sir, no need to write amortization entry. Directly you can write the exercise entry. Suppose here number of employees 100, number of options per employee 20, market price 150, excise price 120, face value 10 per share. Imagine, for example, number of employees at the end of the year is only 80. So if the number of employees are there in the 80, and if they out of this 80 only 60 employees exercise the option, so in this case, is it required to anyway grant date no entry? Vesting period, is it required to write any entry? No. Here the vesting period is less than 1 year, and directly we can write excise entry. What is the excise entry? We will write. So during for the excise period, see here, from 16th March to 31st March. Suppose imagine out of 80 employees who were satisfied the conditions, only 60 employees excise. So we need to write excise entry for 60 employees. So therefore, bank account debtor 60 employees, each employee 20, and the price we are giving excise price is 120. So company is receiving 60 employees into 20 into 120. So 1,44,000. Now employee compensation expenses account. Don't write employee stock option outstanding account. When outstanding account will be cancelled? When it is already recognized. Here we have not written any amortization entry. Direct excise entry we are writing. So therefore, bank account debtor, employee compensation expenses account debtor. That means direct loss. 60 employees, each employee 20, and the market price is how much? 150. We are giving it 120. Therefore, 30 per loss. 30 per option is the loss. So 60 into 20 into 30. It will be 36,000. To equity share capital. Equity share capital, remember, always will be written at face value. Always will be written at face value. Okay, this is the main basic things. These are all. When you write equity share capital, always write at a face value. And balance is securities premium. Next, this employee compensation expenses will be transferred to employee compensation expenses because it's a loss. Sir, what about you give an offer to 100 employees, na, sir, but only 60 employees exercised, na, sir, remaining 40 employees lost. Is it need to be again reversed like how we have done if they have not exercised immediately after the exercise period? So the unexercised options will be lapsed. We have written an entry called employee stock option outstanding account debtor to general reserve. Will you write that entry? No, yeah. Because where you have amortized the loss here, you are directly writing the excise entry. So don't, already if you have recognized any excess loss, that will be reversed if the employee have not exercised the option. So here directly you are writing excise entry. Then what is the need to cancel again? If you have recognized any excess loss, that will be reversed. So you are not recognizing any excess loss now. How can you reverse? What is the need to reverse? So that's it, sir. This is employee stock option plan. I have explained the entire accounting treatment with examples. So you see this and try to solve. So 2 or 3 questions are there in the study material. Please go and solve. And the next thing is employee stock purchase plan. I told you this chapter you have, 3 topics. One is employee stock option plan. Just now we completed. Second one is employee stock purchase plan. I told you employee stock purchase plan. What is this employee stock purchase plan? When company is going for public issue, along with the public, shares are also offered to employees. That is called employee stock purchase plan. Suppose in this plan, what are the entries we will write? See, same entries. When the employees exercise the option, what is the entry we have written? Same manner we have to written. See, for shares purchased under ESPP. Suppose employees purchased shares. So what is the entry from company point of view? Bank account debtor, loss account debtor. This loss will be written as employee compensation expenses. 2 equity share capital, 2 securities premium. Bank account means number of shares exercised, purchased into issue price. Employee compensation expenses means loss. What is the loss? What is the market value, fair value? At what price company is giving to you? See here, the number of shares issued under ESPP into fair value per share minus issue price. In employee stock option plan, market price minus exercise price, same manner. See, the fair value per share is nothing but market price minus issue price. So this is the loss, number of options exercised or number of shares purchased into market price minus issue price. That means loss per option. This is total loss. And equity share capital always will be written at face value. Remaining is the balancing figure. And this employee compensation expenses will be transferred to P&L account. So therefore, is there anything different, sir? No. Similar to employee stock option plan, excise entry. So in case of employee stock purchase plan, directly you write the excise entry. When employees purchased the shares, company point of view, you write bank account debit, number of shares purchased into issue price. Employee compensation expenses account debit. What is this employee compensation expenses? Because of this plan, how much loss the company is going to suffer. So the difference between the market price and excise price into the number of shares issued under ESPP. 2 equity share capital, 2 securities premium. And this employee compensation expenses will be transferred to P&L account. Okay. So this is the thing, sir. See here. Y Limited issued 2000 shares on 1st April 2021 under ESPP at 50 when the market price is 150. Past journal entries. How simple it is. Suppose bank account debit. See, 2000 shares. So 2000 into each share issued at 50 issue price. And employee compensation expenses. Number of options 2000 into what is the market price? 150 minus excise price 50. The price at which they are issued price. 100 rupees is the loss per share. So 2000 into 100. It will be 2 lakhs loss. 2 equity share capital. Share capital will always be written at face value. So 2000 into 10. Not at issue price. There are some students, I don't know where they came from. They are not even understanding this. Share capital they are creating. See, I have observed so many students. 2000 into what they will write now? Issue price 50. No, yaar, share capital will always be created with face value. Fundamentals, you have to be strong. Okay. Then the balance will go to securities premium. This is balancing figure. So total debit side 3 lakhs, na sir. Share capital is created with 20. So remaining 2,80,000 is transferred to securities premium. You see the questions in study material. Simple questions are there. 2 questions are there. That's it. You can easily complete it. Okay. See, apart from these things, there is one more concept in this chapter. That is employee stock option plan, employee stock purchase plan. I have explained. Now, there is a concept of sweat equity shares that also we can cover along with this chapter, or we can cover separately also. Sweat equity shares. So this is employee stock option plan and employee stock purchase plan. What they given here? When a company issues shares to its employees, see, employees or directors, for providing know-how, technical know-how is kind of intellectual property, right? It's a kind of an asset. Know-how means some kind of a formula design. Okay, new thing, new formula, new design is designed by an employee or a director. Intellectual properties, out of your intelligence, if you develop something, that is called intellectual property. Now see, employees or directors has developed something, some intellectual property rights or some know-how. Now company issues shares to its employees for providing that. Such an issue of shares is termed as issue of sweat equity shares. Now, for example, our company is there. For example, Ola Electronics. You see, in the Ola Electronics, one of the employees has developed a new engine which is to be used in the scooter. Now, company wants to acquire that new design, what he has done. So, by giving him shares, those are called sweat equity shares. Now, Companies Act says, Section 2, Clause 88 of the Companies Act, sweat equity shares means such equity shares which are issued by the company to its directors or employees at a discount. Generally, issuing of shares at a discount is prohibited, but the only exception is what, sir? Sweat equity shares. Or for consideration other than cash. Sir, sometimes sweat equity shares are issued by the company to its directors or employees at a discount, or for consideration other than cash. Sometimes I am acquiring asset from you and instead of cash I want to give shares. So in that situation also company can issue sweat equity shares. For providing, why company is issuing shares to them at a discount, or why company is giving shares to them for consideration other than cash? Because they are providing know-how, asset, or making available rights in the nature of intellectual property rights. So some kind of property, intellectual property rights they have developed, one new formula, one new design. For example, I am working, one employee working in a Reddy Laboratories, now pharmaceutical company. Now out of his interest he developed one new drug for cure of, for example, one disease, heart disease. Now what, that is new drug he developed. Now that is intellectual property right, that intellectual property he developed. So therefore company can issue shares to him, that is called sweat equity shares. See, in order to acquire that formula, so either company may issue shares or company may issue shares at a concessional price or value addition, any kind of value addition, not only intellectual property rights, any kind of value addition by whatever name called. So that means those employees who bring some value addition, who has some intellectual property rights, who has some formulas, who has something which is useful for the organization, then for acquiring that value addition, for acquiring those assets, company may issue shares to them. Those are called sweat equity shares. Actually, we have section 54 of the Companies Act, sir. So these are all, legal provisions. We will see it once because MCQs may be asked. The legal provisions relating to sweat equity shares. Quickly, I am going to read all these things because you are not expected to, remember everything here, because this is an accounting paper. Maybe they will ask one or two MCQs. Okay. So section 54 says, notwithstanding anything contained in section 53, a company may issue sweat equity shares of a class of shares already issued if the following conditions are fulfilled. What are the conditions company need to satisfy in order to issue sweat equity shares? First, the issue is authorized by special resolution passed by the company. So special resolution must be passed. That means 75% of the shareholders must decide, 70%, 75% of approval, 3/4 approval must be there for this decision of issuing sweat equity shares. Okay. The resolution specify the number of shares, how many shares to be issued, the current market price, what is the current market price of the share, consideration, how much amount of consideration we are giving, we want to give to employee for acquiring that intellectual property rights, so for his value addition if any, and the class or class of directors or employees to whom the equity shares are to be issued, for which employees we want to issue the equity shares, sweat equity shares, for which directors we want to issue sweat equity shares. So we need to clearly mention it in the resolution. See, first we need to pass the special resolution. We need to conduct a meeting. In that meeting, we will pass a special resolution. In that special resolution, all these details must be mentioned. Again, not important point. Next, see, where the equity shares of the company are listed on a recognized stock exchange, the said equity shares are issued in accordance with the regulations made by Securities and Exchange Board in this behalf, and if they are not listed, the sweat equity shares are issued in accordance with such rules as may be prescribed. Again, very simple point, sir. If our company is a listed company, along with rules of, along with Companies Act provision, we need to follow rules of SEBI. That is, everybody knows that. Suppose if you are unlisted company, you have you may not require to follow SEBI regulations, but you have some other rules. Those rules you need to comply. The rights, the limitations, restrictions and provisions as far for the time being applicable to equity shares shall be applicable to sweat equity shares issued under this plan, and the holders of such shares shall rank pari passu with the other equity shareholders. they are saying, what they are saying is these sweat equity shares are exactly same as any other kind of shares. Don't treat them separately. Whatever the rights you will get, whatever the restrictions you will have, whatever the responsibility being a shareholder you will have, same things will be applicable to sweat equity shareholders also. So they are not different from other equity shares. In fact, they rank pari passu. That means equal with the other equity shareholders. Like for example, a company issued shares to public. Those shares, sweat equity shares, both are same only. But for different purposes, we are issuing the shares. That we need to remember. And there are some rules which further states that a company other than listed company which is not required to comply with Securities and Exchange Board of regulations on sweat equity shall not issue sweat equity shares to its directors or employees at a discount or for consideration other than cash for their providing know-how or making available rights in the nature of intellectual property or value additions by whatever name called, unless the issue is authorized by special resolution passed by the company in general meeting. We know this point. Special resolution has to be passed. So suppose if you are an unlisted company, you cannot issue sweat equity shares without unless there is a special resolution. So in order to issue sweat equity shares, the special resolution is required. Okay. Next, the special resolution authorizing the issue of sweat equity shares shall be valid for making the allotment within a period of not more than 12 months from the date of passing the special resolution. Maybe MCQ possible. So they may ask, suppose a company passed a special resolution. Now that special resolution has given how much time to issue sweat equity shares to its employees or directors? 12 months. Remember, 12 months. A period not more than 12 months from the date of passing special resolution. So from the date of passing special resolution, within 12 months, if you want, you can issue sweat equity shares. Next, the company shall not issue sweat equity shares for more than 15% of the existing paid up share capital in a year or shares of the issue of shares of the issue value of rupees 5 crores, whichever is higher. Important, sir. Sir, here they are saying that a company shall not issue sweat equity shares for more than 15% of the existing paid up share capital. One is 15% of paid up share capital in a year or shares of the value rupees 5 crores, whichever is higher. Suppose a company wants to issue sweat equity shares. What is the limit? The limit is 15% of the paid up share capital or 5 crores, whichever is higher. Remember this, important. Next, the sweat equity shares issued to directors or employees shall be locked in or non-transferable for a period of 3 years from the date of allotment. This is also important. Sir, once any shares are issued to the directors or employees under sweat equity shares, as a sweat equity shares, there is a lock-in period. That means they cannot transfer the shares. We have just now seen question. There is a lock-in on transfer. 3 years they locked the transfer. For that, because of that, the fair value of the share is came down to 28 from 30. Same here. See, whenever you want to offer any shares to the directors or employees issued, and any shares are issued under this plan, so those shares are locked for 3 years. So that means 3 years you cannot transfer it. That's a restriction put by the law. Next, the sweat equity shares issued shall be valued at a price determined by the registered valuer as the fair price, giving justification for such valuation. Suppose, for example, if you are unable to decide the fair value of the share which you are issuing as a sweat equity shares, you can go for the registered valuer and he will decide the value. So what are the important points? Legal provisions, special resolution must be passed. That's it. And there are 3 points. One is, once you passed a special resolution, within 12 months that you have to allot sweat equity shares. Second thing is, whenever you want to give sweat equity shares, that sweat equity shares shall not be more than 15% of the existing paid up share capital or 5 crores, whichever is higher. That is the limit. It cannot be more than that. And then when company offered any sweat equity shares, there is a period of 3 years lock-in period. They cannot transfer to anybody else. So I think these legal provisions are not that much important, but anyway, I discussed. But I think you understood the concept of sweat equity shares. See, simple. One company, any employee who has some intellectual property rights, out of his intelligence, out of his knowledge, he developed something, he makes some value addition. Now that value addition we want to acquire now. So that we want to take it out. That asset we want to take it out. For that we issued shares. Now here there are 2 possibilities here. One is company issues sweat equity shares for consideration other than cash. Sometimes sweat equity shares are issued for consideration of cash. So company issues sweat equity shares to employees for cash. That is one case. Another case is company is issuing shares, sweat equity shares for consideration other than cash. Now see, when company issuing sweat equity shares for cash, generally at a discounted price. That discount is our asset, what we are acquiring from him. We will see the accounting treatment, you will understand it better. See here, accounting treatment. See, accounting for sweat equity shares. I told you there are two cases. First case is issue of sweat equity shares for cash consideration, for cash consideration at a discount. Sweat equity shares are issued for cash. That means we are taking cash from employees, but at a discount. For example, 100 rupees share price, we are giving it 50 rupees. So here, when sweat equity shares are issued for cash consideration at a discount, the difference between cash consideration and the nominal value of equity shares shall be considered as the value of intellectual property provided by employee or director. So therefore, the accounting entry will be bank account debit, intellectual property account debit to equity share capital. Sir, what is this? I will explain. Listen. Suppose Nana, here there is one employee, company wants to give him sweat equity shares. Company wants to issue sweat equity shares to him because he developed something, he makes some value addition. For that, we want to allot him shares. And how we want to allot the shares? We want to issue sweat equity shares for cash only. For cash only. We want to issue for cash, but at a discount. At a discount. At a discount. Suppose, for example, company wants to give company, suppose A Limited, there is an employee, suppose for example Mr. P. Now for him, company wants to give 1 lakh equity shares. 1 lakh equity shares. Company wants to give 1 lakh equity shares. And suppose for example, we want to give at a discount, not see discount. Suppose the face value is 100 rupees. We want to issue share at, suppose for example, 70 rupees. Okay, 100 rupees share, we want to give 70. And these shares are what? Sweat equity shares. Now, if they are sweat equity shares, what is the accounting treatment? Simple. How much company will receive? Tell me, from employees. Bank account debit. 1 lakh shares we are offering na, into each share he will pay 70 rupees. So therefore 1 lakh into 70, that means 70 lakh rupees bank account will be debited. And through equity share capital, we are issuing equity share capital. Therefore in our books equity share capital will be created. How much? 1 lakh into 100 rupees, because shares are always created with face value. So 1 lakh into 100, that will be 1 crore, 100 lakhs. Now they say if these are sweat equity shares, then what we need to do, the difference. This is the actually loss. We are offering face shares below the face value. This 30 rupees is the discount loss, right? This will be treated as intellectual property right. Intellectual property right. Property. So this is nothing but the asset. See, this is the value. See, that means how much amount of value we are paying for the employee, for what he has generated, or for what intellectual property he has added. 30 lakhs. Because we are receiving 70 lakhs from him na. See, we are issuing each share at 70 rupees. Only 30 rupees benefit we are giving. That benefit, what we are giving to him, his point of view, that is benefit. Our point of view, that is loss. See, that loss what we are giving, that discount loss, same, is nothing but the property we are receiving from him. This is called Intellectual Property Act. I mean intellectual property. That is what exactly they are saying. See here. In our example, I told you. Bank account debit. How much? 70 lakhs is the bank account. But you are issuing equity shares 100 lakhs. How much? 30 lakhs is the discount actually. This discount we want to treat it as intellectual property. This is asset to the organization. Here that means you want to say when company issued sweat equity shares to its employees at a concessional price, at a discount, you want to treat the discount as asset of the organization. Yes, because why you are giving discount? Because employee had something, you want to acquire it by issuing shares, and of course you are charging something. What is the amount you are not charging? That is the asset, that is the value addition he is bringing. That's why it is intellectual property. So 100 rupees share you are giving at 70 na, 30 rupees is what? The value addition, that intellectual property rights, for that you are paying that 30 rupees. So therefore we need to recognize it in the books as intellectual property. So bank account debtor, intellectual property to equity share capital. This is when issue of equity shares for cash at a discount, that means you are receiving the cash but there is a discount. That discount is nothing but for the asset what he is bringing in, that is intellectual property. Now sometimes we issue sweat equity shares for consideration other than cash. That means we are not giving shares for cash. That means we are not receiving anything. That means the entire shares what we are issuing is for the asset only. Suppose for example company is giving 1 lakh shares, each share 100 rupees for consideration other than cash. That means nothing will be charged from the employee. That means whatever the shares we are issuing na, that is nothing but what? The asset, for the asset only. Therefore answer is, the entry is intellectual property account debtor to share capital account. Intellectual property account debtor to share capital account. See here, sweat equity shares issued in pursuance of an acquisition of an asset other than cash. For example, employee is having one asset, we want to acquire that asset. So employee is having one formula, intellectual property, technical no. So intellectual property account debtor to equity share capital. Sir, what is this employee compensation expenses or director compensation expenses? See, suppose what is the value of the asset you are acquiring? For that, what is the equity shares you are issuing? What is the type of equity shares you are issuing? The difference may be treated as employee compensation expenses. Employee compensation expenses. For example, you are issuing shares, equity shares worth of 150 lakhs. And the asset value is 140 lakhs. This is the intellectual property. Now the 50 lakhs, 10 lakhs is nothing but the difference, that we will treat it as what? Employee compensation expenses. Compensation expenses is a kind of benefit we are issuing, because 150 lakhs is what? The worth of shares we are issuing. But the asset is giving only 140 lakhs. That means 10 lakhs extra we are giving him na. So company point of view, that is employee compensation expenses, that will be transferred to P&L account. You know that this employee compensation expenses, because in employee stock option plan, employee stock purchase plan, both the plans also, whatever the discount we are offering, whatever the less price we are offering than the market price, we treat it as employee compensation expenses. Same also here. But remember Nana, see, the moment you see the question relating to sweat equity shares, in your mind you have to think whether sweat equity shares are issued for cash or other than cash. Suppose if sweat equity shares are issued for cash, only the discount shares, sweat equity shares issued for cash at a discount, the discount is asset, intellectual property right, because 100 rupees share you are giving at 70, that means 70 rupees you are charging, only 30 rupees you are not charging. That 30 rupees is the value of asset what he is bringing in. Second, when sweat equity shares are issued for consideration other than cash, you are not charging anything. The entire shares what you are issuing may be treated as intellectual property right. Of course, the value of the asset and the equity share capital, if there is a difference, that will go to employee compensation expenses, and later that will be debited to P&L account. Sometimes sweat equity shares are issued not in pursuant to acquisition of an asset. They are not in pursuance of acquisition of an asset. So he is not having any asset, but he may brought some value addition to the organization. That value addition you are measuring it in the form of compensation. So therefore employee compensation to share capital you can directly write. Okay, and this employee compensation expenses will be included in P&L account, and the details of sweat equity share shall be disclosed in the balance sheet, like how employee stock option plan, employee stock purchase plan, we have recorded in the books. Sweat equity shares details also we need to record it in the books. Okay, so when sweat equity shares are issued for consideration other than cash, there are two possibilities. One is when sweat equity shares are issued in pursuance of an acquisition of an asset, when employee is having an asset and we are acquiring that asset, for that we are issuing share capital. So intellectual property account debtor to share capital, the difference is nothing but employee compensation expenses. What is the worth of asset we are receiving, what is the worth of share capital we are issuing, the difference is nothing but expenses, compensated expenses to the company for the employees, so that will be debited to P&L account. Suppose if there is no asset, company issuing sweat equity shares not in pursuance of an acquisition of asset. See, intellectual property rights they may not be always in the form of assets. Sometimes the value addition which is given by the employee, so for that company is giving you directly the compensation in the form of equity shares. Now then in such a situation, if there is no asset company wants to recognize, then the entire shares what company is allotting is employee compensation expenses, and that will be directly debited to employee compensation expenses account, and later it will be transferred to P&L account. Suppose if the asset involves this one, if the asset does not involve this one. So if the asset involves intellectual property account debtor to equity share capital, the difference is compensation expenses. If asset does not involve directly employee compensation expenses account debtor to equity share capital, that's it. So this is the sweat equity shares treatment. So sweat equity shares treatment, there are two possibilities. So accounting of sweat equity shares, there are two possibilities. What are the two possibilities? Can you tell me? What is the first possibility? When sweat equity shares are issued for sweat equity shares issued for cash, issued for cash at a discount. Tell me, when sweat equity shares are issued for cash at a discount, so we will write here bank account debit. How much you will write to bank account? The issue price. And intellectual property account debit. What is this intellectual property? Discount portion. Important here. We are issuing shares at a discount to employee. That discount is the asset he is bringing in to equity share capital account. Okay, this is the face value. This is the issue price, and this is the discount. So this is the first case accounting treatment. Bank account debtor, intellectual property account debtor to equity share capital. Next, sometimes we may issue sweat equity shares for consideration other than cash. Sweat equity shares issued for consideration other than cash. Other than cash. See, that means we are not issuing any shares for cash. Now in this there are two situations. One is asset involves. Then in such a situation, intellectual property, that asset is called intellectual property account debit. Employee compensation expenses account debit to equity share capital. Whatever the worth of equity share capital we are issuing and what is the value of asset we are recognizing in the books, the difference is nothing but employee compensation expenses that will go to P&L account. Sometimes we are issuing sweat equity shares does not involve any asset, no asset. Therefore, then in such a situation, entire share capital what we are issuing is employee compensation expenses. See, employee compensation expenses is nothing but company point of view. This is a kind of benefit we are giving to employees. That is what we want to say. So therefore, this will be our expenses loss. That's why it is debited to equity share capital is created. Later, these employee compensation expenses will be transferred to P&L account. That's it. So this is the accounting treatment of and theory discussion of sweat equity shares. Now relating to sweat equity shares, sir, there is one question. We'll try to solve this question. Now see this question, sir. Problem number 5. Show the accounting entries for the following. Accounting entries they're asking, sir. First, Tinku Limited allotted 500 sweat equity shares of 100 each to its directors at a discount of 6%. So Tinku Limited allotted 500 sweat equity shares of 100 each to its directors at a discount of 6%. That means whether sweat equity shares are issued for cash or not. Yes, they are issued for cash, that too at a discount. So therefore, when sweat equity shares are issued for cash at a discount, what is the entry will come? So bank account debtor, intellectual property account debtor to equity share capital. So that is the entry we need to pass here. So bank account debtor, see here in this problem what we can write is, so the A bit answer is bank account debit. How many shares we are issuing, sir? Here 500 sweat equity shares, right? And each share issued at a discount of 6%. So 100 rupees share issued at a discount of 6%. That means we are issuing at 94, right? So 500 into 94, that will be 47,000. And most important thing, I told you when sweat equity shares are issued at a discount, that discount is nothing but intellectual property. Intellectual property account debit, the discount portion. So 500 into 6 rupees. 3000 is the intellectual property. 2 equity share capital account. How much? 50,000. Because we are giving 500 shares, each share 100 rupees. 500 share, each share 100 rupees. Okay. So being 500 sweat equity shares were given to directors at a 6% discount. So at a 6% discount, we have given 500 equity shares. So this is the first bit answer. Very, very simple. See, sweat equity shares are issued for cash at a discount. Now the second bit, 800 sweat equity shares of 100 each allotted to employees at par. So at par, in consideration of know-how. See, whether sweat equity shares are issued for cash? No. They are for consideration other than cash. Because they are issued in consideration of know-how. That means asset involves. Other than cash. Asset involves. So in such a situation, what we write? Which asset we are taking, sir? Technical know-how. So technical know-how account debit to equity share capital account, or nothing but intellectual property account that are to equity share capital account. Technical know-how, sir, we are not taking any cash, sir. We are not giving a shares, sweat equity shares for cash. So we are giving sweat equity shares for asset. So therefore directly asset involves. Asset account that are to equity share capital. What is the worth of assets, sir? Actually 800 equity shares of 100 each. So 800 into 100, and each share allotted at par only. So therefore 80,000. So 800 shares into 100, that is 80,000 is the asset value. Being 800 sweat equity shares of rupees 100 each allotted for technical know-how. So the technical know-how which is brought by the employee, for that we are issuing the shares. So this is what they have given, sir. This is problem number 5. So that means we have completed sweat equity shares also. So therefore in this chapter, sir, there are 3 topics: ESOP, ESPP, sweat equity shares. Now all the 3 topics we have completed, sir. So employee stock option plan. So it's an option which is given by the company to its employees to purchase or subscribe the shares of the company in future at a concessional price. In this plan, there are 3 stages: grant date, vesting period, exercise period. Grant date, no entry will be passed. Vesting period, whatever the loss is there, that loss we need to amortize over the vesting period. How to find out that loss? Gross value is equal to number of options expected to be vested into market price minus issue price into expiry period divided by total vesting period. See, we have solved some questions also. So on grant date, no entry will be passed, and during the vesting period, what is the entry we will write? Employee compensation expense or employee stock option expenses account data to employee stock option outstanding account. And once employees exercise their options, bank account data, employee stock option outstanding account data, 2 equity share capital, 2 securities premium. Now to the extent of the unexercised portion, whatever the loss we recognize, we need to reverse it. So what is the entry? Employee stock option outstanding account data to general reserve account. And today we discussed employee stock purchase plan. See, under employee stock purchase plan, whenever a company is going for public issue, along with the public shares are also offered to employees. Now in this case, we need to find out the fair value of the options. What is the fair value of the options? Number of shares issued into fair value, I mean market price minus issue price. Now that loss we need to directly recognize at the time of allotting the shares. So that the bank account data, employee compensation expenses, 2 equity share capital, 2 securities premium. This employee compensation expenses we need to debit it to the P&L account. And then sweat equity shares. Sweat equity shares, those employees who is bringing some value additions, who is bringing some intellectual property rights, company can issue shares to them. Those shares are called sweat equity shares. Now the accounting treatment of sweat equity shares is simple. Whether sweat equity shares are issued for cash at a discount or whether sweat equity shares are issued for consideration other than cash. When sweat equity shares are issued for cash at a discount, the difference between the issue price and the face value is treated as discount. That discount is intellectual property. That is bank account data, intellectual property account data to equity share capital. When sweaty equity shares are issued for consideration other than cash, you have to see whether asset involved, we are receiving asset, for that we are issuing sweaty equity shares, then intellectual property account debtor to cash or bank. The difference may be employee compensation expenses, employee or director's compensation expenses, that will be debited to P&L account. And suppose when sweaty equity shares are issued and no asset is involved, simply whatever the total value of sweaty equity shares you are issuing, you will credit to equity share capital and the entire amount is debited to employee compensation expense. And we have solved all the sums. So that's it. This is ESOP, ESPP and this sweaty equity shares chapter. Thank you. Now the next chapter for discussion is underwriting of securities, sir. Sir, what is this underwriting of securities? See, there is a company A Limited, suppose, which is going for a public issue. Okay, is going for a public issue. How many shares? 10 lakhs, 10 lakhs equity shares they are issuing. They want to issue to the public. Now see, this A Limited is a listed company. Only listed companies can go for public issue. Now, as per the SEBI guidelines, at least 90% of the shares must be subscribed by the public. Otherwise, the entire issue will be, the entire amount, whatever we received, we need to refund it back. Entire expenditure will be waste. So therefore, generally what companies will do is, so they know that they are taking a risk. So suppose if the public response is good and if the entire shares are subscribed, that's different matter. But we don't know how public will respond, whether they will subscribe the shares or not, whether there will be over subscription or under subscription, we don't know. So therefore, what the facility is provided here is, these companies, whenever they are going for public issue, they can enter an agreement with one entity called underwriting entity. There is an underwriter. There is a person called underwriter. So with him, the company will enter the agreement. Let's see, I am going for a public issue of these many number of shares. For example, 10 lakh equity shares, we are going for a public issue. Now, can you underwrite the liability? Can you ready to take the liability? So there is an agreement between the company and underwriters. Now the underwriter job is, see, he entered an agreement with the company to subscribe the shares. Suppose for example, out of 10 lakhs, the 10 lakhs was underwritten by underwriter, Mr. X. Now that means he is giving a, so as per the agreement, he is saying that I am ready to accept the liability of 10 lakh shares. That means if public not subscribed, I will subscribe. So this kind of agreement is called underwriting agreement. Now this chapter is all about determination of the liability of underwriter. So as an underwriter, how much will be your liability? Okay. Sir, you said suppose he has underwritten 10 lakh shares. So his liability is 10 lakh shares. See, this is gross liability. We need to find out the net liability. Because see, he gross liability he accepted is 10 lakhs. So now the company went for public issue. So suppose for example, public applied for 5 lakh shares. Now remaining 5 lakhs only will be his liability. His gross liability, see, that's why as an underwriter, his liability will be always subject to agreement. Okay. And for his services, company will pay some commission. Yeah, he has taken a, underwriting agreement, na? He has taken a risk that if public not subscribe, I will subscribe. So for that, we will pay some commission. That commission is called underwriting commission. So therefore, there is a company which is going for a public issue and they enter an agreement with an underwriter. Who is an underwriter? Maybe a broker, maybe an insurance company, maybe a bank, maybe a financial company, maybe NBFC. Anybody can be an underwriter who has to take the prescribed permissions from the authority, SEBI. Okay. Now types of underwriting agreement. Sir, I said underwriting agreement is entered between the company and underwriter. Now these agreements can be divided from different points of view. For example, based on the extent of liability undertaken, how much liability is undertaken by the underwriter. Based on that, if you see that there are two types of underwriting. One is full underwriting, another one is partial underwriting. Full underwriting means entire public issue was underwritten. Partial underwriting means only part of the public issue was underwritten. For example, we are going for a public issue of 1 lakh shares. Out of this 1 lakh shares, 50% of the shares were underwritten by the underwriters. So therefore, his liability will be restricted to 50,000. So 50,000 shares. That is partial underwriting. Now, if you see based on number of underwriters, there may be single underwriting agreement, there may be multiple underwriting agreements. It is not that we have to appoint only single underwriter. We can appoint multiple underwriters also. For example, A Limited here appointed XYZ Associates, PQR and Company, two underwriters. Each one has taken 50% underwriting liability. Now, based on degree of commitment, if you see the liability, underwriting agreement can be divided into two types. One is firm underwriting, another one is regular underwriting. So, what is firm underwriting? See, firm underwriting is a firm commitment which is given by the underwriter that irrespective of the number of shares which is subscribed by the public, I will subscribe this many number of shares. That is called firm underwriting. And what is regular underwriting? See, I am giving a agreement. I am giving as per the agreement. This is my liability, and if the shares are subscribed by the public, whatever the remaining shares are there, I will subscribe subject to agreement. Okay. Now the most important part of this chapter is this one. Determination of liability of underwriter. If at all there is a question, the question will come from this. Determination of liability of underwriter. How much number of shares underwriter has to purchase. How to determine the liability of underwriter. See, simple notes I have provided. See, first of all, you see whether underwriting is full underwriting, partially underwriting. That means entire shares, entire public issue is underwritten, or only part of the underwriting is public issue is underwritten. You see full part. Suppose full underwriting. In that there are two situations. One is without firm underwriting, with firm underwriting. Suppose in the question there is a firm underwriting, there may not be firm underwriting. Suppose if there is no firm underwriting, that is one case. So full underwritten without firm underwriting, this is one combination. Full underwriting with firm underwriting, another combination. So in the question you have to see because questions answers will change depending upon the combination, whether underwriting is full or part. Full, sir, in the question without firm underwriting, with firm underwriting. Without firm underwriting, sir, one combination. Full underwritten, fully underwritten, without firm underwriting. Fully underwritten with firm underwriting. And partial underwritten. Suppose the entire issue is not underwritten, it is a partial underwriting. Again, in partial underwriting also there are two things: without firm underwriting, with firm underwriting. So therefore there are four cases will come. Four different types of problems for determination of liability of underwriter. Can you tell me what are the four cases? First case, fully underwritten without firm underwriting. Second, fully underwritten with firm underwriting. Third, partial underwritten without firm underwriting. Then partial underwritten with firm underwriting. So these are the four cases will come. Next, sir, in this one more important thing is in determination of the liability of underwriter, the concept of marked applications and unmarked applications. See, what is marked application? Simple. Whenever a company went for public issue, so public will apply for shares, right? So the share application form will have the stamp or will have the mark of a particular underwriter. Now that is called marked application. The application which bear the mark of an underwriter. Now the benefit of these shares will be given to the particular underwriter. The benefit of these shares will be given to the particular underwriter. So that means what? This underwriter maybe either himself directly or through others, he makes an application for shares. Now that credit will be given to that particular underwriter. So suppose for example, there is an underwriter. So Mr. A is there. Now he may say to his friend, Mr. X, that you apply for shares on my behalf, or you apply for shares, so I will have my stamp on your application. So that is called marked applications which bear the mark of an underwriter. Now tell me, if any application bear the mark of a particular underwriter, that means he himself is making the purchase of the shares, right? So that's why the benefit, the liability of the underwriter will be reduced by marked applications to the extent of marked application. What is unmarked application? See, unmarked application means general public applied. They are not connected with any underwriter, which will not bear the stamp of any underwriter. That means these are the shares which is applied by public. Okay. See, suppose for example, there are two underwriters, Mr. X and Y. See here. Suppose we are going for a public issue, 1 lakh shares. Two underwriters we have appointed, X, Y, X 50,000, Y 50,000. So it is a gross liability. From that gross liability, first we need to reduce marked applications. Mr. X 10,000 marked application, Mr. Y 20,000. What is the meaning of marked applications? That means shares applied which have the stamp of Mr. X. So the credit will be given to X only directly. And similarly for Y, shares application received which have the stamp of Mr. Y. So the credit will be given to Mr. Y. So therefore, once you reduce the marked applications, the remaining liability of Mr. X is 40,000, Mr. Y is 30,000, right? Now unmarked applications. Unmarked applications, the applications which is applied by public, they are not having the stamp of the underwriter. Now the benefit of this unmarked application will also be reduced, because anyway the shares which is purchased by the public, so to that extent the liability has to be reduced. Sir, in what manner this benefit will be given? See, this unmarked applications, for example, total 70,000. This 70,000 generally will be apportioned based on gross liability. So therefore gross liability is 1:1 ratio na? So this is also 1:1 ratio we have allocated. Now once you reduce it, then X liability is 5,000, Y liability is minus 5,000. That means in Y account there is a surplus. Now this surplus will be transferred to other underwriter, that is excess of Y given to Mr. X. Therefore his liability will be nil, his liability will be nil. So you can see total 1 lakh shares. How many shares applied by the public which is having the stamp of an underwriter? 10 plus 20, 30,000. How many shares which is applied by other unmarked applications? 70,000. Therefore the liability of underwriter is nil, we can say easily, because the entire shares are subscribed by public only. Public 70,000 is subscribed, in the name of underwriter 30,000 subscribed. So therefore 0 is the liability of underwriter. Okay, so this is one main thing. Now firm underwriting I will explain, very important. See, I told you how to determine the liability of underwriter. Fully underwritten or partial underwritten. First you have to see. Fully underwritten, there are two situations. What is that? Fully underwritten without firm underwriting, with firm underwriting. Okay, so firm underwriting. Firm underwriting is, the benefit of firm underwriting is not given to the underwriter. The benefit of firm underwriting is given to underwriter. See, listen. In firm underwriting, suppose in the question there is a firm underwriting. Firm underwriting is what? It's a firm commitment by the underwriter. Irrespective of the shares subscribed by public, he has to subscribe certain number of shares. He gives an assurance, that is called firm underwriting. Now, when you are calculating the liability of underwriter, there are two possibilities. One is the benefit of firm underwriting is not given to the underwriter. What is benefit is not given to the underwriter? I will tell you, wait. Second situation is the benefit of firm underwriting is given to underwriter. So what is this benefit not given, benefit given? Simple. See, I have taken one example. Suppose there is a company ABC Limited which is going for a public issue, 3 lakh equity shares. Underwriters 3 people, PQ are 3:2:1. So there is a firm underwriting, P 20,000, Q 14,000, R 10,000. That means P, irrespective of the shares subscribed by public, he will subscribe 20,000, Q 14,000, R 10,000. Applications received for 2,40,000 shares excluding firm underwriting. So excluding firm underwriting, because firm underwriting means anyway he has to subscribe now. So excluding firm underwriting, we received an application for 2,40,000 shares, and marked application 60, 50, 60. So liability of underwriters you need to decide. So in this question, first of all, is it fully underwritten or partial underwritten? Fully underwritten, because 3 lakh equity shares underwritten by PQR 3:2:1, fully underwritten. Without firm underwriting, with firm underwriting, with firm underwriting. In the question there is a firm underwriting. Okay. Now if there is a firm underwriting, you have to see whether benefit will be given or not given. Suppose if the benefit of the firm underwriting is not given, then how to determine the liability of underwriter? First take the gross liability of underwriters. PQR, 3 people is there now. Take gross liability. 3:2:1. Total public issue 3 lakh shares. So 3:2:1. 1 lakh 50, 1 lakh 50,000. From that, always reduce marked applications, excluding firm underwriting. Marked applications you have to reduce. So which bear the stamp of a particular underwriter, minus it. Then you will get 90, 50, minus 10. So in the name of R, there is a minus 10,000. That means the benefit of in his account, there is an excess credit. So what we have to do is, next marked applications we reduced. Next, unmarked applications in the ratio of gross liability. Unmarked applications you take. So what are the unmarked applications here? So we received total applications 2,40,000. From that, marked applications you reduce 60, 50, 60. So I have calculated here, see, unmarked applications. So total subscription 2,40,000, marked applications 1,70,000. So unmarked applications from public 70,000. Now this 70,000, what we need to do is, we need to allocate 70,000 and applications under firm underwriting 44,000. Total 1,14,000. This will be shared in the ratio of 3:2:1. What is the meaning? See, here the benefit of firm underwriting is not given means the firm underwriting, which is a shares which is compulsorily required to be purchased by the underwriter, we will not reduce directly from that particular underwriter's liability. What we will do is we will include it as a part of unmarked applications. That is why the benefit is not given to the firm underwriter. The benefit of firm underwriting is not given to the underwriter. The meaning is whenever there is a firm underwriting, the benefit is not given means this firm underwriting, the shares under the firm underwriting will be included as a part of unmarked applications and they will be apportioned on gross liability ratio. See, I told you unmarked applications will be shared between the underwriters in which ratio? Gross liability ratio. Similarly here, if you see total 2,40,000 minus 1,70,000 marked, unmarked application 70 plus firm underwriting also we have added. What is firm underwriting? Compulsorily commitment 20, 14, 10. So therefore 44,000. You add this 44,000 also. This is called benefit is not given to underwriters. Then you will get total unmarked applications. These unmarked applications 1,14,000 has to be allocated based on 3:2:1 ratio. This is called the benefit is not given to the underwriter. Now, then you will get 3312 minus 29. See, surplus of R is allocated to P and R in 3:2. Sir, if any underwriter's account, if there is a surplus, this surplus will be apportioned to the other underwriter. Suppose here 29,000 shares is there. This 29,000 shares will be apportioned between X and Y. In what ratio? In their gross liability ratio, 3:2. Okay, now his account will become nil and the remaining net liability is 15,600, 400 nil. Now, finally you add firm underwriting. So, above you reduced firm underwriting. Along with unmarked applications, you included in the unmarked applications, you reduced. But firm underwriting means definitely they have to purchase now. So therefore, first I find out the net liability excluding firm underwriting, then firm underwriting I have to add, then I will get the total liability of the underwriter. Okay, this is what this situation is what the benefit of firm underwriting is not given. Benefit not given means the firm underwriting is included as a part of unmarked applications and it is allocated between the underwriters. Now suppose the benefit is given. See here I have taken the benefit is given. Benefit is given means same, first take gross liability minus marked applications minus unmarked applications. See, when benefit given means in unmarked applications don't include firm underwriting. Firm underwriting you have to reduce separately. See here 20, 14, 10. Only unmarked applications excluding firm underwriting you apportion. I mean you give them in their gross liability ratio. Then you see surplus account of R is distributed to P and R. Then net liability came 16 nil nil. Then add firm underwriting. So therefore firm underwriting conclusion is what? Whenever you see in the question fully underwritten, firm underwriting, there are two possibilities, two way. Benefit is not given, benefit is given. So if benefit is given, firm underwriting benefit is not given, what we need to do? This firm underwriting is treated as what? Unmarked applications and allocated in gross liability ratio of underwriters. Therefore, what will be the underwriter's liability? The net liability as per the agreement plus firm underwriting. So, gross liability. See, remember these steps. Gross liability minus marked applications minus unmarked applications including firm underwriting in gross liability ratio. Then, any account surplus will be distributed to others in their gross liability ratio. Then, you will get net liability. For that, you add firm underwriting. Suppose if the benefit of firm underwriting is given to individual underwriter means the benefit is given means this firm underwriting is directly reduced from the underwriter's account. Don't include it as a part of unmarked applications. Here, firm underwriting not treated as unmarked applications and reduced from individual underwriters. So therefore, underwriters liabilities, net liability as per the agreement plus firm underwriting. So therefore, I think you understood the concept. This is very, very important. Now, this is one aspect, sir. This is one aspect. The combination you have to see. Fully underwritten, partial underwritten, fully underwritten. Fully underwritten, firm underwriting is there. The benefit is given or not given. Benefit given, so not given. Benefit not given means it is included as a part of unmarked applications. Benefit given means it is separately deducted. And at the end we need to add to get the liability of underwriting. Now, let us see the partial underwriting, sir. So, we have completed full underwriting. Two situations we have discussed. when firm underwriting is there and there is no firm underwriting. When there is a firm underwriting, two situations. Benefit of firm underwriting is not given, benefit of firm underwriting is given. Now, partial underwriting is very, very important, sir. First of all, what is this partial underwriting? Suppose there is a company A Limited, sir, which is going for a public issue. Now, suppose they are going for public issue of 1 lakh shares. Out of this 1 lakh, 50% of the shares are subscribed by, underwritten by A, 30% by B. So that means 80% of the shares were underwritten. So this is called partial underwriting. Okay. See, in case of partial underwriting, how to determine the liability of an underwriter? See here, there can be single underwriter, there can be multiple underwriters. Suppose you take the situation of single underwriter and there is a partial underwriting. So I told you in the question you have to see whether it is fully underwriting or partial underwriting. If it is fully underwriting, you have to see whether there is a firm underwriting or not. If there is a firm underwriting, again you have to see whether the benefit is to be given or not to be given. Benefit is to be given means that firm underwriting is directly reduced from the underwriter's liability. Not given means it is included as a part of unmarked applications and it is deducted from the underwriter's liability based on gross liability ratio. Now see, in case, suppose if you see partial underwriting, then you have to check. In case of partial underwriting, is there a firm underwriting? No firm underwriting. Here suppose for example, first I am discussing there is no firm underwriting. Okay. So partial underwriting, there is no firm underwriting. And single underwriter. For example, see here, there is a company X Limited, which is going for a public issue of 1 lakh shares. Okay. Now A and Co underwriter, 80% of the issue was underwritten. So out of 1 lakh shares, 80% was underwritten. Okay. Now see, that means this A and Co is a single underwriter and this is a partial underwriting. And we received applications 70,000 from public. Okay. Suppose 90,000, 1 lakh 10,000 also received. What will be different situations? Marked applications 50,000 shares. Sir, what is marked applications? So which will bear the stamp of the particular underwriter. The benefit will be given to that underwriter only. So that means we have to deduct from the particular underwriter liability. Now calculate the net liability of A and Co. Underwriter's liability we need to determine. Now very important. Please listen to me carefully. Here first of all, underwriting is full underwriting or partial underwriting. Okay. So when there is a partial underwriting, how to determine the liability of an underwriter? If he is only the underwriter, single underwriter, how to determine is very simple. First you determine, you take the gross liability. Here 1 lakh into 80%, 80,000 shares, right? From that marked applications as usually you have to deduct 50,000. So 30,000 is the deficit of underwriter. What is this deficit, sir? That means the remaining shares he has to subscribe as per the agreement, because his gross liability is 80 and marked applications in his name is 50. So therefore 30,000 is the deficit of underwriter. Point number 1. Now you need to decide what is the total number of shares we offer to public. 1 lakh. For that, for how many shares we received application from public? For how many shares we received application from public, sir? Actually, we received application for 70,000 shares, right? So 1 lakh minus 70, 30,000 is the still the shares to be subscribed, balance of unsubscribed shares. Now you tell me A and Co liability is what? According to his agreement, 30,000 and the balance shares unsubscribed also 30,000. So A or B, whichever is lower. A or B, whichever is lower. So A 30,000, B also 30,000, whichever is lower means 30,000. So in first case, the liability of the underwriter is 30,000. Now come to second case. Suppose instead of 70,000, if public applied 90,000, then A will same according to his agreement, 80,000 marked applications has to be deducted. See, in case of single underwriter, partial underwriting, the benefit of unmarked applications we will not reduce from the underwriter. Only marked applications will be deducted. So this A will remain same, 30,000. Now come to B. How many shares we offered? 1 lakh to the public. How many shares public applied? 90,000. That means still unsubscribed shares 10,000. Now A or B, whichever is lower, B is the liability of the underwriter. A or B, whichever is lower. Sir, what is this, sir? See, as an underwriter, it is partial underwriting. I agreed 80%, 80,000 shares, and market applications 50. Therefore, my liability is 30,000 shares. But public itself applied for 90,000 shares out of 1 lakh. Therefore, 10,000 shares unsubscribed overall. Now, according to my agreement 30, unsubscribed 10. So, whichever is lower, if I purchase, that will be sufficient. Therefore, my liability will be A or B, whichever is lower. Now, suppose for example, tell me if public applied 1,10,000 shares. That means over subscription. See, actually the shares we have issued is 1 lakh. Public subscribed 1,10,000. So, as an underwriter, my liability is nil. As an underwriter, my liability is nil. A 30,000, B nil. So, whichever is lower means nil. So, therefore, understand, Anna, suppose in the exam, they have given partial underwriting. See, first of all, when you solve a question relating to underwriting, see whether it is fully underwritten or partial underwritten. Fully underwriting, I explained, very simple. Partial underwriting, you see single underwriter or multiple underwriter. If he is a single underwriter, then you have to check A or B. A means his gross liability minus market applications. B means what is the total number of shares we are issuing, how many shares application is received, minus it, that one. A or B, whichever is lower, will the liability. Okay. So therefore the conclusion is, in case of partial underwriting, unmarked applications is not given to the underwriters. You should not deduct unmarked applications from the underwriter in case of a partial underwriting. Okay. So therefore same thing I have explained here, A or B. For example, gross liability 80, market applications 50, so 30,000 deficit. A. B, public issue 1 lakh, public applied 70, so 30,000. So A or B, whichever is lower, 30,000 is the liability. Second situation, A will remains constant. Come to B, public issue 1 lakh. Suppose we received applications from the public 90,000, including market. So therefore 10,000 will be the unsubscribed shares. So A or B, whichever is lower, 10,000 is the liability of underwriter. Come to situation C, nil, because public itself has applied 1,10,000 shares. Okay. So this is how you determine the liability in case of partial underwriting, single underwriter. Okay. A or B, whichever is lower. Now see, suppose in the question there is a firm underwriting, what we do? If there is a firm underwriting, what we do? See, in case of full underwriting, if there is a firm underwriting, what we have done? One is benefit is not given. Second one is benefit is given. When benefit is not given, the firm underwriting we have included as a part of unmarked applications, and we apportion between the underwriters based on gross liability ratio. If the benefit is given means the firm underwriting we have directly deducted from the each underwriter. Okay. Now, same manner, sir, in case of partial underwriting, what we need to do? See, treatment of firm underwriting. This is very, very important, sir. Treatment of firm underwriting. Suppose in the question you see partial underwriting with the firm underwriting. So here also two situations will come. First situation is no abatement is allowed for firm underwriting. Situation number 2 is abatement is allowed. Nothing but the benefit is given, not given. Same manner, in full underwriting the benefit of firm underwriting is given, the benefit of firm underwriting is not given. Here they use the word abatement. No abatement is allowed for the shares taken up firm. Abatement is allowed for the shares taken up on firm. So therefore, this is the treatment of firm underwriting. What is the treatment of firm underwriting? See, two possibilities. So no benefit is allowed to the firm underwriting. What is that? See, I told you what is firm underwriting, right? This means that shares underwritten firm will not be adjusted against net liability under the underwriting contract. And the underwriter will have to subscribe them additionally. See, they will not be adjusted against the net liability because you have given a firm commitment. You have to subscribe them additionally. Therefore, here the number of shares to be taken up by the underwriters is net liability. Gross liability minus market applications. So whatever the liability, net liability will come, that net liability plus firm underwriting. Then you will get the liability of the underwriter. Now suppose the abatement is allowed for the shares taken up firm. Benefit is given. This means that shares underwritten firm will be adjusted against net liability under the underwriting contract. Hence, in this case, the number of shares to be taken up by the underwriter is net liability under the underwriting or firm underwriting, whichever is higher. So the benefit is given. The firm underwriting benefit is given. Abatement is given. What is this abatement given? Means the shares, whatever the firm underwriting is there, that will be adjusted against my net liability. So therefore, in this case, the number of shares to be taken up by the underwriters is his net liability or firm underwriting, whichever is higher. Whichever is higher, he has to take. So this you will understand only with one example, one question, sir. I will try to solve one question here for you. See here, I think question number 5. Question number 5 will explain both the things. See here, Mr. X underwrites 60% of the issue of 20,000 shares of 100 each of ABC Limited. That means this is what? Partial underwriting. Partial underwriting. Definitely you see 60% of the issue was subscribed. He has also agreed. See, Mr. X, only Mr. X, okay? Mr. X underwrites 60% of an issue of 20,000 shares of 100 each of ABC Limited. He also agreed for a firm underwriting. See, in the question, firm underwriting is also there. Firm underwriting is also there. A firm underwriting for 1600 shares. The company received applications for 13,600 shares, out of which 8,000 are marked applications. Determine the number of shares to be taken by Mr. X. If the underwriting contract provides that abatement will be allowed in respect of shares taken of firm. If the contract provides that no abatement would be allowed in respect of shares taken on firm. So partial underwriting, with firm underwriting, and there is a single underwriter. Not multiple underwriters, there is a single underwriter. See, in the question you have to check all these things. So partial underwriting, yes, 60% of the shares. Firm underwriting, yes. How many shares firm underwriting? 1600. Now, this 1600 shares firm underwriting, whether this will be the benefit of the firm underwriting is given or not given, abatement allowed or not allowed. Suppose if the underwriting contract provides for the abatement to be allowed, that is one case. If the underwriting contract provides no abatement would be allowed in respect of the firm underwriting. This is second case. See here. Suppose question number 5. See here. Suppose there is a gross liability. What is the gross liability? 20,000 shares, 60% is subscribed, right? 12,000. Okay. Now, see, first number of unsubscribed shares I have arrived. Because usually how to find out the liability of underwriter? A means deficit of underwriter. How many shares? What is his gross liability? 12. Minus marked applications. In the question, marked applications. The company received applications for 13,600 shares, out of which 8,000 marked applications. 8,000. So 8,000 we need to deduct. Plus 1600 also deducted. What is this 1600? Because this benefit of firm underwriting is given. Abatement is allowed. Allowed means it has to be deducted. So deducted. So therefore his liability is 2,400. So therefore this firm underwriting is included as a part of market applications. The benefit is given. And normal unsubscribed shares. How many shares company went for public issue? 20. How many shares applications received? 13,600. Therefore 6,400. So A or B, whichever is lower, 2,400. That will be the liability of underwriter. That will be the liability of underwriter. Now see here. First case, if abatement allowed in respect of firm underwriting. Suppose the firm underwriting abatement is allowed. Then in such a situation, what is your net liability? 2,400. What is your firm underwriting? 1,600. Whichever is higher will be your liability. If the abatement is allowed. If the abatement is allowed. See here. This one. Abatement is allowed for the shares taken of firm. This means that shares underwritten firm will be adjusted against net liability under the underwriting contract. Hence, in this case, the number of shares to be taken by the underwriter is net liability under the underwriting contract or firm underwriting, whichever is higher. Net liability or firm underwriting, whichever is higher. Because see, when we arrive the liability, already firm underwriting is deducted. See here, from 12,000, we deducted market applications plus this firm underwriting. That means the benefit is already given. Benefit is given, abatement is given. So 2400. So this is my liability. So when the benefit of firm underwriting is given, how to determine the liability of an underwriter? Simple. What is your net liability? What is the firm underwriting? Whichever is higher. 2400. That means his liability is 2400. Already in the form of firm underwriting, he has to subscribe 1600. So therefore, this 2400 will be his net liability. Suppose if the benefit is not given, if abatement is not allowed in respect of the firm underwriting, there is no abatement, then in such a situation, this firm underwriting is not adjusted against his net liability. So therefore, his net liability, see here, net liability 2400, and you should add back this firm underwriting because it is deducted now. So add back, therefore it will be 4000 in this case. See here. This means the shares underwritten firm will not be adjusted against net liability under the underwriting contract. The underwriter will have to subscribe them additionally. Therefore, here the number of shares to be taken by the underwriter is net liability under the contract plus firm underwriting. So we should add back these two. Sir, what is the conclusion, sir? The conclusion is very simple. If I am an underwriter and if it is a partial underwriting and if there is a firm underwriting also, that means it is a firm commitment I have given. I have to subscribe this many number of shares. So generally, what is my liability? What they will say is simple. Whether the benefit of firm underwriting is given or not given. If it is given, means it is deducted. So from my gross liability. Therefore, my net liability or this firm underwriting, whichever is higher, will be my gross liability, my net liability at the end of the year. In this case, if the abatement allowed in respect of firm underwriting. If abatement is not allowed, benefit is not allowed, then we have to consider firm underwriting as a separate liability. That's why you first find out net liability plus 1600 you add. Then you will get this one. So this is the concept of partial underwriting. Suppose in partial underwriting, there may be multiple underwriters also. Like here, in next problem, A, B, C. So gross liability 75, 30, 30. Market applications including firm underwriting you have to deduct. Then surplus you allocate. Finally, you add back the firm underwriting. Because see here, the market applications including firm underwriting, that means the benefit is allowed. So we are deducting along with market applications, this firm underwriting also. So therefore, how to determine the liability? Net liability plus firm underwriting. Net liability plus firm underwriting. Whichever is higher.